health insurance and so on. And they worry that with the loss of that job, if they get caught, if they get sick or whatever, that would set them back, thousands of dollars.
But then this comes back to the argument about safety nets. And if you want safety nets, that involves a taxation system, which is something which is the very essence of why many people choose to base their businesses and their personal lives here. So it's not it's not a straightforward decision, is it? There's a balance to be had, Zainab. What do you feel, you've spoken to a lot of people, what's the tipping point for the exit?
For a lot of families, it's really coming down to how long they can hold on here without jobs. How long can they wait for the economy? For some, the calculation is very simple. I have children, let's say, and that means soon I'm going to have to commit possibly over 100,000 dirhams to put my kids through another school year, of which I'm not sure that I'm going to be, able to get more money as I get a job, because the economy is not doing so well. And the outlook for oil prices is another factor that is making a lot of people think that the pickup in the economy may not be so soon and may not be so fast, like in 2009, where we saw the economy pick up quickly. But this time, for many people also who don't have that pressure of job, of schooling, they're thinking maybe I got a pay cut, my partner still works, or I'm out of a job, my partner still works. We can still hang on for a while. If we go back to the U.S. or other countries where there are a lot of job losses there too, and the economy is reeling, we may be, competing with millions of others who lost their jobs, and it's very unlikely for us to find jobs there. So a lot of people are trying to weigh their options. Some of them will stick it out here for as long as they could, while others will feel that there is no option, that just the amount of money they will have to shell out next year will mean that they can't really stay.
And staying with the UAE, Mubadala Investment Company, an Abu Dhabi sovereign investor, released its 2019 annual review this week. It achieved a total comprehensive income of 53 billion dirhams for the year. That compares to 12.5 billion dirhams in 2018. And that was driven by Mubadala's public equities portfolio and funds, as well as the company's assets across various sectors. Mana spoke exclusively to the Deputy CFO, Saeed Mazroui.
Today, equity market plays a major role in our positions on the equity market. And as you know, we have seen a great recovery in 2019 for the equity market. As you would recall, we have struggled at the end of 2018 with the volatility in the equity market, but the market have recovered since then. But overall, we have seen really a great performance in different parts of our portfolio.
When you look at the divestments, you're obviously building up a sizable cash pile. Give us an indication, how much cash are you sitting on, and is that a cash pile for deployment?
We need to look at Mubadala today at the size of the investment, at the size of the portfolio that we have today. Today, we need to understand that Mubadala has an investment strategy, and that investment strategy has an asset allocation that has been allocated for the different asset classes and sector. So the recycling of capital, it's not something systematic. It's something based on allocation that has been given to the different business units, and they are playing tactically, either on the private equity side through the funds and the co-investments, or through the public investments, which is today a sizable. Today, if we look at our public investments and the overall portfolio is 21%, so recycling that within the public investments, it creates a large recycling capital for us.
Well, when it comes to doing deals, I look at your debt to equity ratio. It's 11.8%. The deputy CFO, is the ambition to take that ratio higher, the debt to equity ratio higher? Where is your comfort level on that going into 2020?
Remember, Mubadala has been always prudent when it comes to their balance sheet. We are not looking to have an excessive leverage in our balance sheet. Today, when we look at our cash in the banks, or even assets that are highly liquid on the public equities, we can easily meet our debt obligations. That's one. Two, we have built a dry powder over the last 2 years. Mubadala have gone through a lot of monetization in 2018 and 2019. We have anticipated a market correction, but definitely not COVID-19. And maybe to some extent, we had that luck of raising also money from the debt capital market back in November. We have raised 3.5 billion Also, last May, we have raised 4 billion. All this dry powder have built a strong cash position for Mubadala, where we're looking to deploy that across different sectors and asset classes in Mubadala.
Which naturally brings me, is 7 billion the right number for you? Do you want to come back to the debt markets? Money is cheap. It makes sense. Will you return to the debt markets in the second half of the year?
You are absolutely right. If I will look at the cost of funding for Mubadala on the money that we have raised on the last two issuances of the $7.5 billion, it's 3.2%. Way too cheap compared to the issuances that we had few years back or relative to any investment companies in the region. So far, we don't have any plans to come to the market.
And I want to get a sense from you. What are the businesses saying? Are you moving more towards a V-shaped recovery? What is the narrative that your businesses are telling you about the global recovery in a post-COVID world?
I think within Mubadala as a group, the first thing that we try to do with these businesses is to tap into the RCF and the line of credit to ensure there is enough liquidity, especially companies that have been impacted by the lockdown or by the COVID-19 because of the shutdown in operations. Clearly, when you look into the US market today, the equity market has almost erased all the losses that they have incurred on the back of COVID-19. Now the question is the real economy. Are we going to see that catch up? If I take an example, the US market, which is a huge market that we invest in, I believe the US market is very resilient. I mean, the US market pre-COVID-19 had a very low unemployment rate. It's the lowest on the last 50 years. We don't see any systemic risk. We have seen a strong capitalization in the banking system in the US. And more importantly, the US government, as well as the monetary policy, has been very supportive of the capital market. I think it would go down to, on the next few weeks, which we have really a limited data, is are we going to see another lockdown? It seems the US President, Donald Trump, he is not going to close down the economy because of the next election that is coming in September. So I think our eyes should be on the job creation and the acceleration of job creation in the US, which will actually increase the consumer sentiment and spending, which is 60% of the US GDP.
Up next, Egyptian stocks soar after the country reaches a preliminary agreement with the IMF for COVID-19 aid. We hear from the Minister of International Cooperation next. This is Bloomberg. Welcome back to the best of Daybreak Middle East. Egyptian stocks rose the most in more than 2 months on Sunday after the country reached a preliminary agreement for a $5.2 billion standby arrangement with the IMF that seeks to alleviate the economic impact of COVID-19. We got more with Rania Nashat. She's the Egyptian Minister for International Cooperation.
It's not just that we are focusing on the immediate impacts of COVID, but we're actually looking forward. And that is very important because countries post-COVID are going to be distinguished by how much effort they put in trying to implement structural reforms that help put the economy on a path for more employment and more inclusive growth. So this is something that we have been able to do pre-COVID. We had concluded a very successful reform program by summer of 2019, and that has allowed us to enter into this crisis with a very good fiscal as well as foreign exchange position. And the government during the crisis has taken very important steps and policies, both on the monetary side, the fiscal side, but also more importantly, when it comes to structural reforms related to widening the social safety net, mitigating the impact on informal employment, creating also women-specific policies related to COVID. So there's so much that has happened, and what we want to do going forward is build on that in order to help not just rebuild the economy, but really reshape it.
Minister, you say you want to build on that. So let's flesh this out a bit more in terms of the kinds of targets you've set yourself for this year and beyond. Have you been able to secure some of the financing? I mean, we know that you have been able to do that. What else is in the pipeline in terms of that finance?
So it's, I used to work in the IMF before, and something that is very important, and I'm sure that all of you cover, any IMF program has to be fully financed. And that's where other multilateral and bilateral partners of development come in. In the case of other finances, and that is whether we're talking about the African Development Bank, we're talking about JICA, the French, the World Bank, etc. What we have been working on in the Ministry of International Cooperation is to make sure that the Sustainable Development Goals are not overlooked in the midst of all of this. So you will find that we have created a multi-donor platform for very specific sectors that will help actually push the economy forward. That includes electricity, transportation, the health sector, given the focus globally now on that and also nationally. We also have not only help or support to the sovereign, but also to the private sector through credit lines to Egyptian banks that are availed through the EBRD and the EIB. So it's really a multi-dimensional and a multi-sectoral effort to create sort of more impetus into sectors which are going to help the economy. So for instance, when I talk about electricity, Egypt has just received 2 awards from EBRD, one in terms of sustainable energy, the other one in terms of gender. When we come to solar and renewable, Egypt is the #1 in the Middle East. So we want to build on this. And that's why in the multi-donor platform, the energy strategy for 2035 is being pushed. These are very good opportunities where private-public partnerships can take place. Similarly for transport, when we are talking about expanding the metro lines, more connectivity, all of this is quite important for investments going forward. When we talk about the support to the private sector, it's not just the big companies, but also the small and medium enterprises, which are really going to be the engines of growth going forward, particularly given the global shock that we've seen.
Minister, we need to push you a little bit in terms of the timing. When will you have these funds on the books? And let's press you a little bit. How confident are you that you will get all the money that we just listed in terms of the multilateral agencies? When, Minister, and how much?
You know, it's very important to mention that Egypt has a very successful record with all our multilateral and bilateral development partners. We have been able to, push through with lots of programs and projects with them. We have already board dates set up with many of the items that you put on your screen. This is happening very soon, and you will see in the press that they have been secured. The other thing which is important, I want to use this opportunity to mention it, we have created a new global partnerships narrative, which is people, projects, and purpose. And the idea here is that each and every project and each and every development partner that we just talked about comes under this umbrella. How many beneficiaries are going to be affected? What is the type of the project? Is it a PPP project? Is it the nature of its financing? And then third, purpose, which SDG does it really meet? All of these that were on your screen have been secured. We're in the final stages of finalizing it, and actually we have board dates for many of them already.
Up next, more from Egypt as inflation slumps to its lowest level since November. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Welcome back to the best of Daybreak Middle East. Inflation in urban parts of Egypt decelerated to its lowest level since November, with the rate declining to 4.7% in May. That is well below the central bank's target of 9% by the end of the fourth quarter, and it's welcome news at a time when authorities are seeing economic growth projections getting revised down due to the coronavirus pandemic. We got more with Arti Chatrasekaran. She's the Portfolio Manager Vice President at Shua Asset Management.
Inflation definitely came lower than street expectation, Yusuf, and this is despite weakness in EGP. But we think this is largely one-off. We don't think inflation is going to remain at these levels going forward. We do expect it to pick up in June. We expect MPC to actually hold on. Yes, there is a lot of upside. There's a lot of room for CPE, but the Monetary Policy Committee will probably hold rates in the coming meeting.
Arti, good to have you with us this morning. You paint a particularly bleak picture economically for Egypt. Tourism, remittances and canal revenues. So the backdrop to the economy is far from assured as we begin to deal with these new headlines about potential wave 2 of COVID this morning. Give us your view on the economy.
So tourism revenues will be close to zero probably in the second quarter and third quarter. We do expect probably a loss of $6 to $8 billion. If you were to assume 20 to 30% hit on remittances, Swiss Canal revenues will have another loss of $5 to $7 billion. Yes, this is partially mitigated by the savings from lower oil prices, but overall it's definitely not looking good. Egypt has to mobilize close to about $2 to $3 billion more. They have $2.5 from IMF. They have already done $5 billion from Euro bond dollar issuance, but they still probably need $2 to $3 billion for the rest of the year.
So is there anything left in the playbook in terms of clients looking at exposure into Egypt for their portfolios in the equity or fixed income space?
The growth engine for Egypt is definitely strong, as in it's one and only positive GDP growth country in the MENA region for this year, but the risk is also very high. Look at where CDS is. We're talking at 520, 530 bips, up from 250 in the beginning of the year. So definitely the risk-reward match is not really good, and it's not sitting well. The headwinds in currency is also there. We do expect pressure on pound to further depreciate, probably towards EGP 17 by the end of the year. And because of this, we are a bit skeptical to enter the market. The only place that we want to be there is in equities and Comi. Comi is a blue chip name we like, and we have given their low exposure to retail and SME sector.
Let's pivot to the Kuwaiti story this morning. A number of different facets at play. The Kuwaiti Prime Minister last week saying the country's expatriate population should be more than halved to 30%. So that message is about go home. When it comes to how that plays down to the real economy, I'm interested to see how it plays out for the banks. We've got the dividend story, but you say we should never have been playing Kuwaiti banks on a dividend play anyway, relatively speaking. Would this message from the Prime Minister bear down on the banks?
Well, Kuwaiti banks on the dividend story, definitely we have never played Kuwaiti banks for dividend story, but it's definitely a negative news. I mean, dividend cut is prudent, no doubt about it, but I hope it doesn't create a panic in the market, because all the Kuwaiti banks, with an exception of Burgan Bank, has a very robust CET1 ratio, which is your capital ratio. So essentially what this move could possibly do to the investors is they could possibly extrapolate a worse than expected profitability numbers for the Kuwaiti banks for this year, which might not be the case. We do expect profitability of the Kuwaiti banks to decline substantially by 20 to 30% for NBK, KFH, Burgan and Gulf Bank, but it is not going to dent their capital. It is not a capital event. So we do expect more pressure for the Kuwaiti banking sector stocks, especially the high-yielding dividend plays, the likes of Burgan. The retail investors will churn more into the telco names, but for a company like NBK, we like the story, and it's a good entry point if we see more pressure.
Arti, the Central Bank of the United Arab Emirates has put out a statement on some of its expectations for the remainder of the year, and some of the key points they made was that the fiscal growth will average about 28%, credit expansion is going to slow, followed by a recovery. And then property prices are seen declining with a sharper drop in Q2 and in Q3, followed by a gradual recovery. Does that align with what you've penciled in for the remainder of 2020 into 2021?
To a large extent, Yusuf, it's right. I mean, DFM is down like 23% and 18%. There is no immediate catalyst at the moment. Investors are definitely and very keenly watching all these macroeconomic data coming out, some concrete numbers in the sector data, the banking space, the money supply, any of these numbers, especially like what you said now, the UAE Central Bank coming out with putting those kind of numbers. I think these are the numbers that basically tells us how to gauge where the market is. It's definitely not it's not an outlier. We did expect these kind of numbers, so it's not going to be a great surprise to the market. That being said, given that there is no catalyst, the market will remain sideways for a period of time. Unless we see improvement in the PMI numbers, in the sector numbers, and the retail and the consumption numbers, which is unlikely to happen up until the quarter 3 to quarter 4.
Remember, you can catch Daybreak Middle East every Sunday to Thursday morning right here on Bloomberg Television. That's at 8 a.m. Dubai time. Do join us then. This is Bloomberg.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Founded more than a century ago from humble origins, L'Oréal is now the world's biggest beauty products company. Specializing in cosmetics, hair, and skincare, it boasts an international portfolio of 34 brands and has a market cap of more than 105 billion euros. At the helm, a man who's dedicated his entire career to the company. Over 4 decades, he's covered all facets of the business. Today, on Leaders with Lacroix, we meet Jean-Paul Agon, Chairman and CEO of L'Oréal. Monsieur Agon, thank you so much for speaking to Bloomberg.
Pleasure.
What happened to L'Oréal in the last 10 years? Innovation, your share price has grown. Was it exciting times?
Yeah, very exciting. You know, I started as a CEO 10 years ago. It has been 10 years very exciting. Of course, we had a crisis in 2008 and 9. But globally, the business has been very good. We have been growing, acquiring brands, launching new products, gaining market shares everywhere in Europe, USA, China. No, very exciting, fantastic.
What's been the most fun?
In fact, the most fun has been the past 3-4 years, because thanks to the digital revolution, everything has been transformed. And as I tell my teams, I think that this industry, our business, our company has more changed in the past 3 years than in the previous 30 years. So it's an amazing time, extremely exciting.
So is this the way you sell, or is it the way that people actually look at makeup?
No, in fact, it's the relationship between brands and consumers. In fact, the digital has completely transformed the relationship between the two. Before that, you know, the brands were talking to consumers, pushing towards them information or whatever. But now the consumer has taken the power. The consumer decides how he wants to see the brands, what he wants to know, what he wants to discover them. Digital, in fact, creates a relationship that has nothing to do with what existed before.
But isn't it much more difficult, therefore, to control your brand?
Yeah, but at the same time, it's more exciting, and it enriches the relationship. So now, thanks to digital, we can communicate the content of our brands. We can do tutorials to explain how the products work, how they should be used. We can have a personalized relationship with consumers. So it's a completely new dimension. It's much more rich and exciting.
So what sells at the moment? Is it the luxury brands or is it the more consumer brands?
This year, luxury. This year, luxury has been booming everywhere, mostly with Chinese consumers. You know, Chinese consumers are fantastic. They love beauty, they love luxury, they love our brands, and our business with Chinese consumers everywhere has been booming.
L'Oréal's global reach stretches across 140 countries. About 2/3 of its sales are generated outside of Europe. Much attention has shifted to China,
欢迎来到上海。
where strong demand for high-end lipstick and perfume is driving growth.
谁说爽肤水都一样？不。
In 2015, China surpassed France to become the group's second biggest market behind the United States. Some of the success is being attributed to selfies, with camera-conscious millennials buying more makeup than ever before to look good instantly. Have you had to adapt to the Chinese market?
Yeah, in fact, the products we sell, not for all brands, because the luxury brands, for example, are the same all over the world, of course, but for our mass brands like L'Oréal, like Maybelline, the product that we sell in China are formulated in China by Chinese, in our Chinese labs.
Because of regulation?
Not only, but also because we want to create the products that are absolutely right for them, especially skincare, because their needs, their skin, their aspirations are specific, are different. So we formulate in our Chinese labs, we manufacture in our Chinese factories, and L'Oréal now L'Oréal Paris is the #1 beauty brand in China.
I've also been reading that one of the most popular products is actually a homemade, I guess, range of cosmetics wear, which is favored by the wife of the president, President Xi.
Yeah, it's a great brand, but still the #1 beauty brand in China, the preferred beauty brand by Chinese women is L'Oréal Paris. They call it with the Chinese name, it's Pali Olaya, which is beautiful, by the way. And it's great because, you know, the L'Oréal Paris is the #1 beauty brand for Chinese, for Americans, for Europeans, for Russians, everywhere. So it's a great
not bad.
Satisfaction. Yeah,
so,
not bad.
So tell me about your success in China. Is it through distribution? Is it through ads? Is it through celebrities? What's the attraction for your brand by the Chinese?
You know, the reason of success of our brands everywhere is always the same. It's #1 quality. You know, we for all our brands, our absolute priority is the quality and safety of our products, and it's something that the Chinese respect a lot. It's very important for them. #1, innovation. Innovation is extremely important. It's an industry where you have to innovate a lot. You know, more than 15% of our products every year are new in order to keep innovation flowing very strongly. Of course, it's the imagery of the brands. You know, brands like Yves Saint Laurent, Lancôme, Giorgio Armani, L'Oréal Paris. It's a beautiful imagery, and Chinese consumers are very sensitive to that. They like it.
Is the U.S. tough? A tough market?
The U.S. this year is a bit tougher, a bit softer, let's say. It's not really tough, but it's a bit softer. Certainly softer than China. But it depends. You know, last year the U.S. was very good. So every year, it's funny because every year the market, roughly globally, is more or less growing at 4%, but it's never made exactly the same way.
But so how difficult is it to predict what will work and what won't? Why am I using this mascara, not the other mascara? Why am I using this foundation, not the other?
Again, it's very, you know, when you know well your consumers, when you understand their desires, when you can guess their dreams or expectations, then you can really create what they will love.
What will the next 4 years bring? Is there a specific market that you think will grow more? Is it, you know, for example, men's cosmetics or something else?
You know, digital, I think, will be the most important element of transformation of the market. So definitely we're going to see the e-commerce growing. For example, e-commerce in China is already more than 30% of our sales for our mass market brands. So it's huge. So we're going to see digital growing. We're going to see probably new channels also emerging, like specialty stores, our own stores. A very big and also growing segment is the travel retail, the stores in the airports, because more and more people are traveling. So I think there will be new channels. In terms of regions, of course, the emerging markets are still growing, and our categories are growing too. Makeup has been booming for 2 or 3 years. I think it's going to keep booming. Skincare is growing too. So honestly, I'm very optimistic about the short-term, middle-term, and long-term perspective of this industry.
What do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends. We were talking about what the next 4 years will bring, and it's a lot more e-commerce. How do I choose my makeup online? It must be difficult to choose the right coloring.
No, because now you have some technologies that are amazing. You can test online on your cell phone, for example, simulate the application of the makeup on your face, and then you see yourself with the lips covered with the lipstick you want, the shade you need, the powder, the mascaras. I did a demonstration of that to my board, completely made up, and it was they were ecstatic.
Was that for the launch of the app?
Yeah.
And so they said yes.
Yeah, I wanted
fantastic.
I wanted to share with the board the fantastic progress of technology. It's amazing.
Oh, I could look like pure reds. Oh, wow.
The lipstick is moving with my mouth, and I know that I don't have any on.
It's like Amy Winehouse flicks. It's brilliant. I can't stop looking at myself.
So this is amazing because you also have to then change, I guess, your research and development. How much of the overall cost goes on actual digital products?
Well, it's difficult to say because it's everywhere, in every brand, in every division. But what I can say is that now, more in terms of media, 1/3 of all the media that we do now goes on digital. In terms of e-commerce, 7% roughly of the sales that we do go on e-commerce through digital, and it's growing 30% a year. So there is a shift happening, which is extremely fast, extremely strong.
The company that invented the platinum blonde is constantly innovating and developing new products as consumer demand changes. At its lab in Paris, scientists have studied more than 7,000 types of hair and are now experimenting with 3D printing. The hope is to one day help people suffering from hair loss. L'Oréal's already created fake skin to avoid testing products on animals and invented a UV patch to monitor exposure to the sun's rays.
We have the #1 R&D facilities in the world. We are spending roughly 3.5% of our sales in research and innovation. And obviously, the most important topics are hair, skin, and hair. This is where we invent and create new formulations for hair care, hair color, all type of hair products.
You also have a patch?
Yeah.
Is that right?
UV patch.
A UV patch, so you put it on to see when you're overexposed to the sun.
Yeah, it's a creation that was made 2 years ago that we presented at the Consumer Electronics Show in Vegas last year. And it's a UV patch, you put it on your skin, and it's linked to your cell phone. And it calls you or it rings when your exposure to UV has been too high. It's a fantastic tool.
So do you think there's going to be more of a trend, which I guess is between the cosmetics and the healthcare?
Yeah, absolutely. Yeah, and also with internet, you know, this triangle between beauty, health of the skin or hair, and Internet of Things is creating new opportunities, and that are going to be very useful for consumers.
What do you like about your job the most?
I love understanding people. You know, I think that one of my strengths is the capacity of empathy with consumers. So I have this capacity to understand, to feel, to guess what consumer want, what is their desires, sometimes their dreams, and then to be able to formulate products that will respond to these dreams.
Do you believe you have to take risks to innovate, or
yeah.
actually, do you?
Oh yeah, of course. Yeah, because every innovation by definition is a bet. Every launch is a bet. It's like a new film or a new movie or new music. You never know in advance. But that's the magic of it.
So what do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends.
No, we are working on all categories. You know, we have 3,500 researchers from many departments, and they are all working on all type of cosmetics: skincare, hair care, hair color, all sun care. And because fundamentally, as I told you, we really believe first and foremost in terms of efficacy and quality. So the mission of the company, which is beauty for all, is also not only beauty for all, but the best of beauty, the best quality, the best performance, the best efficacy, the best safety, and that keeps us busy.
3,500 researchers.
Yeah.
How long does it take from, I don't know, who has a concept of, for example, a new product, until that product being on the shelf for someone to buy?
Depends. Can be very quick when the formulation is easy. Can take maybe 6 months. Or when for example, the marketing guy has a vision, has a dream, but the labs don't know exactly how to formulate it, can take 2 years, 3 years. Really depends.
Mega volume on top, mega volume on bottom. Share it with your friends and buy makeup instantly.
One of the criticisms often leveled at the beauty industry is that it's only for young people. Is there any truth in that?
No, not at all, of course not. First, that would be stupid, because we are addressing all needs for all people, and look at our ambassadors. For example, Jane Fonda, Helen Mirren, they are not millennials. So no, honestly not.
Do you sell more to millennials or to people of a more certain age?
No, we sell to everyone. It depends the brand. The brands, of course, some of our brands like NYX, Urban Decay are more targeting young people. Biotherm or L'Oréal Paris may target other categories of consumers, but no, we cover the whole scope of consumers, and in terms of age, in terms of diversity, in terms of countries, Chinese, Brazilian, Europeans, everyone. It's a beauty for all.
So how do you sell to the emerging markets?
We adapt the product that we sell, of course. We make sure that they are affordable and that people can buy them. Brazil, for example, is very interesting because Brazil is the country in the world where the hair is completely unique, because it's such a mixed country in terms of ethnic origins that the blend is completely amazing, and that you have to create for Brazilian hair care products that are completely specific. And by the way, it's very interesting because sometimes they are the most demanding consumers, and so when you can create in Brazil a product that is good for them, then you can make it for the world, because it's going to be great for everyone.
Do you think Generation X cares more about this than millennials?
There is an urgency, clearly. We are not talking anymore about a potential threat. I mean, there is a clear and present threat.
For Jean-Paul Agon, life at L'Oréal began in sales 39 years ago. he quickly understood the power of advertising.
Read my lips.
I'm worth it.
The company obviously thinks it is worth it, spending more than $8 billion a year selling and marketing its brands. A third of that on digital media.
When I was 20 years old, I was in a business school, and at the end, I knew I wanted to do marketing. And for me, beauty is the supreme art of marketing, because it's a marketing that is not only about understanding, analytics, but it's also about emotion, guessing, creation. So I think it's a fantastic marketing. There is no better marketing than beauty marketing.
And from that 20-year-old Jean-Paul Agon, what have you learned about yourself?
My God, a lot, a lot, because it was a long time ago. No, it took me, many years to get where I am today. But I was always passionate. I think that the incredible part of L'Oréal also is that every day is a new adventure. Every day is a passion. It's a company made of really passionate people, and every new mission is an adventure.
So what are you like as a leader, micromanaging or overview?
I like overview, and from time to time I'm tempted to do micromanagement. But when I do that, my team say, Jean-Paul, you should not, you should not bother with that. Let us do it.
Do you review though the end product every time, or how does it work?
As much as I have meetings with, of course, with all the brands. Not all the time, of course. I travel in many countries around the world, and I'm just trying to help to make sure that we are taking the right directions, pushing in the right innovations, understanding enough the consumers we are dealing with, trying to pilot the ship.
L'Oréal's Sharing Beauty with All program, launched in 2013, was designed to transform the business. Jean-Paul Agon was determined to make the company ethically and environmentally sustainable. It's been recognized for its efforts, awarded a AAA for water management, climate, and action against deforestation.
So when did you start thinking about sustainability?
Pretty a long time ago, especially when I came back from the USA and I took over as a CEO. I really understood at the time that for a company like L'Oréal, especially because we are the leader of the beauty industry, we had to make sure that also we would do the best and the most to make the planet a beautiful place.
What started it? Is it because you say we sell so much so we have to make sure that it doesn't go to waste? Or is it also because the consumers want something that's more sustainable? Or is it because the employees you hire want something more sustainable?
Very good points. I think it's all of that. First, because we have a moral duty. Secondly, because it's what our employees are asking for. Third, because it's what consumers want. Fourth, because it's what the society expects from a big company like us. So that's why we really went into this direction.
Does it make a difference for the consumer? I remember you telling me a couple of years ago, that if a consumer has a choice of a sustainable shampoo or a shampoo that makes our hair better, we'll always go for the shampoo that makes our hair better.
Yeah, but now what we want to do is to make a shampoo that makes the hair better and sustainable. Because now in fact, you're right. Our vision is that we have to find a way that it's not opposite, that it goes in the same direction. And it's the same for economic performance. For example, the sustainability performance should not be opposite to the economic performance. And in fact, we are able to prove that. For example, in the past 10 years, we reduced our carbon emission by 67%, when at the same time we were able to increase our production by 30%.
How do you do that?
We work a lot. We transform all our factories. We have now 10 sites that are carbon neutral. We completely transform the way also we engineer with water. We have what we call dry factories, that they don't use water at all. They completely recycle the totality of the water that they use. We eliminate waste. So it's a very comprehensive effort on all fronts to transform completely the way we produce, we distribute, etc.
And shareholders are behind you every step of the way for sustainability?
Yeah, absolutely. They are very, I think that our shareholders are very proud of what we do. I cannot say that they are pushing us hard to do it, but they are happy and proud.
Do you think Generation X cares more about this than millennials? The younger you are, the more you think about this?
I think that everybody now cares. You know, I think that it's very well understood that there is an urgency. Clearly, we are not talking anymore about a potential threat. I mean, there is a clear and present threat to the planet, and if we are not all doing the maximum in the very short term, it's going to be very difficult. So I think that every generation now understand that.
If I speak to you in 5 years, what will be your story?
In 5 years, probably I will tell you that the most important mission has been the transmission. Because, of course, I will not be CEO forever. And I will be, by the way, very glad to pass the baton one day to my successor.
So if you think a lot about succession, what kind of successor would you like, and what would you like your legacy to be?
I will be proud to have been able to adapt L'Oréal to the new world. I think that we are living in a very special period. The world tomorrow will be very different from the world we knew a few years ago. And you know, my absolute priority right now is to adapt, transform the company in order to make it as successful as a leader, as performant in the new world as it was in the world before. And I'm very confident about it, because that's what we are doing. You know, we are doing a cultural revolution, a digital revolution, a sustainability revolution, and so the L'Oréal will be a fantastic company. And then someone else will take the baton and will drive the adventure further.
Jean-Paul Agon, thank you so much.
Thank you very much.
What do the world's tallest building, KFC in the Middle East, and e-commerce site Noon all have in common? They're all owned by billionaire Mohammed Al-Bar. His investments like the Burj Khalifa and the Dubai Mall have become iconic landmarks, and he's diversified into hospitality, retail, and e-commerce. He was named the most influential man in Dubai and consistently ranks amongst the top 5 most powerful Arab business leaders. But it's not all business all the time. He's also a sportsman. He's an active member of Emirates' horse racing community. Today, on Leaders with Laqwa, we meet Mohammed Al-Bar, the founder and chairman of Amar Properties.
Thank you so much for joining us. You've really built a conglomerate. You've built a company that has multiple interests, multiple units, multiple portfolios. Did you diversify because you saw an opportunity or because you had to?
Well, I think all of us, we look at opportunities. We don't really have to do anything. But I think looking at the Middle East and looking at the industries that I went in with my team, I think we saw amazing opportunities in the Middle East in these sectors. And I'm glad that even though we've got difficult years, the past 2 years have been difficult years for us, still these businesses are operating well. So definitely it's based on opportunities and the sector's long-term growth potential.
Where do you see the most growth coming from? Which portfolio, which part of your business will do better than others?
The food operating well and strong in the region as a whole, especially with the food delivery business, and that's another story. I would say that our real estate business is still flying really strong. I mean, last year we grew about 28% in the region as a whole. Our e-commerce business is something that's very, very interesting. And we've got an amazing team looking at it, and that's also growing quite fast. But even with this growth, I think one have to be realistic as well. So you look at this growth and you look at what's going on in the Middle East, government policies, look at the world economy and what changes might take place. So you have to be alert at all times.
Okay, what does that mean? Do you expect a lot of the growth, in the Middle East? If you look at e-commerce, and we'll talk a little bit more about that, do you expect it to go threefold, fivefold over the next 5 years?
Well, I would say that our real estate business should continue to grow at about 20% a year. And that's the shareholders' expectation. And it's hard work to achieve that number and keeping cost under control, margins under control, and political and macroeconomic issues in hand. So food business, I think we should be growing 10% a year, year on year as well in the region. And keep in mind that we're talking about the Middle East, where there is a need for most of industries to grow, just because that I think the Middle East still has room to grow. And the other thing is that if you look at the population in the Middle East as well, and the whole demographics is in our favor.
Because they're young, and therefore these are, I guess, the youth will spend a lot more in 5-10 years.
Yes.
How will the economy shift?
Well, I think the economy will shift positively only because I believe Middle Eastern governments are really working harder than any other time in the past, and you see the changes that are taking place, positive changes that are taking place in Saudi Arabia. I think that's the same thing within UAE. I would look at Egypt. I'm quite interested in Egypt as well, and the change that's taking place in Egypt, with all the other issues that we have in the Middle East, where I believe that I don't think it's going to get any worse than this. I think we're looking forward to a more positive trend in policy and in politics and economic growth as well.
In terms of growth, country by country, which is a country that will outperform the others in the Middle East?
The majority of our focus is Saudi Arabia, UAE, Egypt. And I would say Egypt is going faster now. Saudi Arabia, I'm quite optimistic with the changes that you see taking place within the coming 24 months. I think you'll see quite a good trend, and the UAE as well. You've got, of course, the other Arab countries who are some slow, some moving forward, but majority of our business are in these countries.
I mean, you're holding a big investment with the PIF on e-commerce for Saudi Arabia. Will there be more, for example, on property in Saudi Arabia?
Well, the Public Investment Fund, they are with us in our e-commerce business, but they are also with us in our food business. Now, are we going to do more together? I think there's a possibility. There's a lot of work that they're doing in Saudi Arabia and outside Saudi Arabia, in the region and outside. So I would expect that maybe we should look at real estate together as well, because I think Saudi Arabia will look very interesting the coming years.
How much can it grow, property in Saudi Arabia, over the next 5 years?
Oh, Saudi Arabia, I think it's at infant stage. I think Saudi Arabia can really grow. If you talk about pure infrastructure, if you talk about retail, industrial, hospitality, residential. So you just have to make sure that you are going at the right category of residential or the right category of retail. So there's plenty of room to go that way.
When you look at how you spend your time for each of the units and also each of the countries, how do you do it? How do you keep on top of it all?
Well, I try. I still say that the real estate takes a majority of my time.
Is that 50%?
I would say the real estate takes about 40% of my time. And then the rest is a split. Noon takes a lot of my time as well. The food takes the least of my time, because the team that sits on top of that business is really world-class team. And they've been in the industry, they know the industry well. Noon is a vibrant team. It's a new organization. I need to give it more time. While my real estate business, I have an A team, but you know, I'm emotional about real estate.
Yeah, I mean, this was like the foundation of it all, right? Do you still see it as your baby?
I think my name is really linked to the real estate more than anything else, while all these other businesses have been with them now for about 2 years. So it's a new brand of product that's associated with me.
When you look at the various IPOs and the various units, was it to unlock value, but did you ever feel like it was also high risk?
I think mainly to unlock value, and we have investors who have put in their money with us, and it's time for them to get rewarded. But at the same time, I really like putting management under pressure, because IPO is quarterly results. You're out there in the public eyes, under pressure to perform. But mainly value creation. I think that's the business we're in.
A value creation, because what shareholders understand what you do more, and it almost focuses the mind of managers more?
Well, that is one, but many of our units, that if they're under the mother umbrella, I think value-wise, they're not fairly valued. So as we put them on the side and put them as separate entities, I think you create better value that way, and then you cash out a little bit and put management under pressure.
Are you looking at IPOing any other units or portfolios?
When you look at our business, we have businesses. We have India, we have our hospitality business, we have Turkey business, we have another business in Saudi Arabia. So the reality is that you can take all these businesses public at the right time. I think within the coming 3 years, we'll probably have India going public. We'll probably have hospitality as well going separately to the public route.
But so how much bigger will you be if I speak to you, and I hope to speak to you before, but if I speak to you in 5 years, how much will your holdings be worth?
I think we should be double in value, because we should be growing in value 20-25% on an annual basis. And I hope that my management and my boards really put that as a focus. And to be honest, I think we're capable of doing that. We just have to focus and have to make sure that we have the right people to do it. And we do this day and night. And that's really how we do business in our region.
But that's acquisitions or that's organic growth?
I would look at organic growth. If you talk about acquisition, which we have not done much of, I'm expecting that we do more acquisition in the coming 2 years.
Mohammed Alabar, thank you so much. Coming up next, going from bricks and mortar to clicks, we talk Mohammed Alabar's big push into e-commerce and how his company Noon could become the Amazon of the Middle East.
Mohammed Albar is not only a titan of property, he's also betting on e-commerce. His startup, Noon, launched its operations in the UAE last year. The site is described as an Arabic-first e-commerce platform and is rivaling the Amazon-purchased Souk, looking to take over 15% of the growing market. One of the biggest investors in Noon is Saudi Arabia's public investment fund, which put up $500 million. But Albar is not just competing against Amazon. He's also a major player in the luxury space. He's partnered with Yux Net-a-Porter Group to offer a premium retail service to the Middle East's fashionista set.
So Mohammed Albar, do you ever feel like there's a conflict that you actually own Dubai malls, but at the same time you're trying to sell on e-commerce platforms?
The issue is that, are you relevant? That's really the big question that we have, is that I don't think it's if there's a conflict or not, but are you relevant to the space? So are we really relevant in this retail scene, or in the whole, the economy is becoming so digital? If you are not thinking about it, if you're not acting to do something about it, I think there is a risk of your business, being probably at huge danger the coming 24 months.
And so how do you stay relevant?
I think staying relevant, first of all, I have to talk to my kids all the time. And I learn from them because, I have a little girl that sells jewelry to women in Korea out of Dubai on her Instagram. I mean, what type of world is this? So therefore, I think all of our business, from real estate to retail to hospitality, I think the digital scene is changing all that. So if we talk about e-commerce specifically, or if we talk about Net-a-Porter, it is just moving your business to the digital scene. And I think the whole economy is moving that way, from healthcare to education to retail. So therefore, I think we just want to be relevant. And I don't think there's any conflict, because at the end of the day, there ought to be a collaboration or connection between the real world and the physical world. And can we really try to find a solution and work them together and stay relevant in our business?
But so how much of your sales will actually be done on your e-commerce platform in 5-10 years? And in general for the Middle East, are you a step behind in actually selling on e-commerce? And so is the potential much bigger than here in Europe or in the US?
Well, remember, I mean, when I look at the Middle East right now, I mean, e-commerce is between 1.5% to 2%.
Tiny.
Which is tiny compared to the rest of the world. So there is room for all of us to grow. Where will this be? I think it will go much faster than the rest of the world, and it will get into the 10-15% quite fast, again, because of the demographics of the region. So we owe it to our society, we owe it to our 300 million Middle Eastern Arabs, that there ought to be a native organization that look after this sector and participate and learn and serve.
What will Noon become? And are you nervous at any point that you're going to head-to-head with the most successful retailer of all times, Amazon?
Well, Noon, of course, it will be an ecosystem. And am I nervous? Of course I'm nervous. I'm nervous from everybody. In my real estate business, I'm nervous. In my e-commerce business, I'm nervous. In my Net-a-Porter business, nervous, because competition is severe and markets are open. Anybody can come in. The big players are going to come in. Some of them came already. More are going to come to the region. But I am from that part of the world, and I think it's our duty to participate in the scene. And remember, we as Arab businessmen, we're a bit tribal, which means that I am from this society. I have a duty that get into business and be aggressive and achieve the numbers, achieve success. But that's a duty that I feel responsible for, that competition is good for the consumer in the region, rather than one player come and controlling the life of our customers. I think it's fair to have competition and let the customer win at the end of the day.
Okay, but how do you decide? I mean, how will you go against Amazon? Do you have to convince retailers to sell on your platform instead of Amazon's platforms, or is it a price war? I mean, how do you see the kind of the fault lines?
Well, we are working with the local retailers, and we are their partners. Now, how other international players, they do it through sourcing overseas or working some other methods, that's their business. But we differ is that our partners are the local retailers. Maybe our margins will be a little smaller, but that's okay. We'd rather win on the long term rather than alienating the local retailers. Now, Will there be a price war? Well, the past 2 months there's a price war. Customers are winning. Everybody's 20% or 15, 10% cheaper on some of the product. So I'm so happy that people in my region, they don't have to buy milk for their kids at 10% more expensive. There was one operator or one monopoly controlling, the human life. I think this is good for all of us. So of course there'll be a competition. But the amazing thing is that the world is open. So much new technologies are being provided to everyone that want to go into the scene. But are you planning long term? You have good people with you. Are you serious about it? Are you willing to provide quality service?
But is it the service or is it the products? How does the Middle East actually shop? What's selling at the moment and what will sell in 5-10 years?
Well, if you look at the mix of what's happening on the e-commerce scene, it's not much different from what's going on in the world. People want delivery, fast delivery. People want quality.
Will they pay for the delivery?
For the time being, we're subsidizing delivery. Because, as I said, people are just learning the art of e-commerce, and that's what global companies are doing. They give it to you for free first, they get you used to this way of life, then later on take a little bit of margin, maybe control market, the usual trick. But what I'm saying is that people want it all. Want quality, want value, want consistent, want delivery time that's fast, and we want the product that they want, which changes from 1 month to another month. And therefore you have to provide that and then get ready to provide the new thing that might be happening next month.
Okay, how important is market share? And how important is market share right at the beginning so that people get used to your platform and not Amazon's?
Market share is very important, and at the beginning you have to be aggressive and you have to probably provide the best service ever. You will be cutting prices as usual because we see it, it's a live competition, there's nothing wrong with that. But the good thing is that the market's big enough. 2 players can come in. But imagine if you do business in UK and there is only one operator. How fair is that to your family?
But isn't there only Amazon here?
Well, there are many other players, I think, in UK as well. I prefer that more than one player in a market. And in the Middle East, there will be more than one player and will be one of the major players in the market.
Up next, we talk the leadership skills it takes to create both the world's largest mall and the tallest building in the world. More with Mohammed Alibar next. Emaar Properties has grown more than threefold since 2011 and expanded heavily in the Middle East and North Africa despite political instability in the region. So what kind of leadership does it take to shepherd a global company through turbulent times? Well, Mohammed Alabar, chairman and founder of Emar Properties, is here. What kind of leader are you? Throughout the program, we were talking about encouraging your leaders, your regional leaders, and also your portfolio managers to be aggressive. Do they always need to be on their toes?
Well, I think, number one, they have to be relevant because the change that's taking place in the world. So are you relevant? And the other thing I like is that I think we have to believe in the reset. Are doing this upgrade? Are we upgrading every 1 month? Because there's so much happening. And do we really act? I mean, that's, so we have to be relevant, we have to act, we have to have discipline, we have to believe in the best people, and we have to take care of our society. These are things these are the elements that I really depend on to manage my business.
Okay, but what does it mean being relevant? Because in more traditional times, you could, ask a customer what they wanted, and you're saying, okay, I'm relevant. But now the change of pace is so fast. Well,
relevant is that, are you watching social media daily? What's going on with your customer? And what's going on with your business? There's no more, I'll do a research and I'll wait 30 days. How alert are you? And how alert about how your customer feel, or alert what's going on to the industry, what's going on with politics, what's going on with the economy, what's going on in new tools of management, how fast can you go? So I think, are you awake?
What do you need to be awake for more? Is it for your clients, or is it politics, or is it how your business interests are going?
Well, it's about my customer, number one, my people, number two, the society, what's going on in politics, what might happen to interest rate. You almost have to have all that construction risk in my business, what's going on in technology, what's going on in digital. You almost have to be alert of all this but number one, people. And then you have to make sure that you share with them this environment, and are they fit in this environment?
So what does that mean? What do you see your role? Are you putting the fire under your manager's feet to kind of keep them going, or do you micromanage?
I don't think I micromanage, but there's a situation where I do have to go and micromanage, and I think that's we should be able to go down in case we want to. And remember, I came from my mom's kitchen. I used to work in my mom's kitchen when we were all 13 kids living in one room, So I know how to do that. So I can pull back and be the chairman of the organization. But if there's need to move in, I can comfortably move in. But I have reasonably good qualified people with me. But I really think that I'm the target creator. I'm the guy who does the monthly performance reviews. I'm the guy who push the limits. I want people to work hard, because I think we as human beings, our productivity is still low.
I mean, you spend a lot of time in property because that's where you came from. That was the first company. But what excites you the most in all the others that you're doing? So hospitality, retail, e-commerce.
I would say e-commerce excites me a lot, because when I look at how the digital world is changing our lives, I come back to my real estate business and I say, maybe this office is nil and void. Maybe this is all not required anymore. But also, if you look at the digital guys and you see how fast they work, or the process they use, or the age of people in these offices. Therefore, I really believe that the younger generation are running the world, and they run it extremely well. So much learning in the digital side of the e-commerce. But I think my investment in MEVP, which is a private equity firm that specializes only in digital and technology in the Middle East, with almost 80 ventures, that's amazing learning about what's going on in the Middle East as well, and the industry that are about to come.
Do you focus a lot on diversity for your companies? Is that important?
Yes, very important, very important. And I think it's happening naturally. I mean, we don't even have to do it anymore. It's just naturally, that's how.
So do you have metrics?
We have metrics, we have KPIs for that. But as I said, it's so nice that it's really embodied in the organization. It's happening automatically, and I like that.
Do you think it'll increase with time, or are you going to see more female workers?
Well, the female workers are really taking charge. I mean, if you look at the people who run my organization, most of our organization, I would say most of our organization, our food boys have to have more of that. But look at our government. Highest percentage of senior people in government anywhere in the world.
Mohammed Alabar, thank you so much for joining us. He is, of course, the chairman and founder of of MR Properties.
Thank you so much.
Thank you.
Thanks.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live from London alongside Matt Miller in Berlin.
Anna, today the markets say, was that just a blip? European stocks and futures are on their longest losing streak since March, but U.S. futures are pointing higher after the big drop yesterday in U.S. stocks. The cash trade is now an hour away. Let's get your top headlines for you from the Bloomberg terminal. A $2 trillion wipeout. U.S. equities see their worst rout in 12 weeks as sentiment suddenly turns sour. Is the worst over, or is there more to come? The precipice of disaster. America's fourth largest city says it may reimpose stay-at-home orders as coronavirus cases surge. But Steve Mnuchin says the country cannot close again. U.S. futures, as we said, are up this morning. Plus, European banks are close to getting relief on capital requirements after the EU agreed to sign off on legislation to mitigate losses on government bonds. Just under an hour away now from the start of trading in continental Europe and the UK. Let's take a look at futures after the big drops that we saw in America yesterday. And we saw drops in Asian stocks overnight. Futures, in that case, don't look so bad. But if you looked at yesterday's cash trade, if you weren't there for the close, you saw a drop on the DAX already of 559 points. Basically a 5% drop on the IBEX 35. That compares to the 5 to 6% losses we saw on the S&P and the Dow yesterday. In terms of U.S. futures, though, today we see a little bit green on the screen, so you can see 1.5% gains on S&P, Dow, and Nasdaq futures. Anna?
I've got some breaking news on the UK economy. Matt, let's get straight to that, shall we? The UK economy shrank by 20.4% in the month of April. That is versus the previous month. So that's a month-on-month figure. The estimate for what it is worth had been for a drop of 18.7%, so 19% or so. So it's not a million miles away from where economists had expected that number to be, but it does show a stunning drop in output for the UK economy during specifically the month of April. And the UK, remember, went into lockdown around the 23rd of March. So this is the first full month for which we have the most severe lockdown picture and what that does to the UK economy. We're getting some other numbers as well. Industrial output falling 20.3% month on month. Again, that is more than the estimates had penciled in. Estimates were for a drop of 15% on that particular measure. Just looking at some of the other details coming through, we're getting construction numbers, we're getting services. So the services part of the economy in April falling by 19%. Construction, though, falling by 40% in that particular month. Such was the effect of the lockdown on that particular sector. So we'll get back to the UK economic story and how you plot a path out of lockdown, first off, and out of recession, secondly, I suppose. We'll get to that conversation with David Owen, who'll be joining us shortly from Jefferies. Let's get back to the markets, Matt, because you talked about the heavy selling that we saw in the US session yesterday, and we saw a lot of that in Europe. As you rightly pointed out, some European markets were down by more than 5% in the session yesterday. So there is a sense that perhaps we pause for thought. The US futures, as you point out, some of those turning positive after those heavy losses, in particular for travel and leisure stocks and for oil stocks. The focus does seem to be on a second wave and a host of other factors also being probed to see if they were at fault, if they were to blame for the heavy selling we saw yesterday. Was it all about second wave infections? Was it about what the Fed said about the economy? Was it about retail traders, fake news, or even the presidential race in the US? I've seen all of those talked about in the last 24 hours or so.
All right, so a lot going on in markets as after you say the U.S. had its worst sell-off since March in yesterday's session, Anna. Almost $2 trillion erased from equities. What drove that sharp switch in sentiment?
Today was a classic risk-off day.
We shouldn't be surprised by a reprieve after a parabolic rise.
The fact that we're seeing ebbs and flows shouldn't come as a surprise.
Today, we got some statistics on infection rates in the United States that caused real concern.
The conversation has shifted from this economic reopening to, is there a second wave?
And on top of what we heard from Jay Powell yesterday, really changed the mood.
And it's also obviously attributable to sobering comments out of the Fed.
Chair Powell put a dose of cold water on what has been happening.
I don't think that this can be blamed on the Fed. I think more likely we got really lulled into complacency on the virus.
It could, in fact, be a healthy thing that the market either marks time sideways or drifts a little bit lower.
I don't think it's that surprising that we're taking a step back, and I wouldn't necessarily think that this is a sign of panic either.
This is the reckoning that, a lot of us are just sort of waiting for, and we waited a long time.
All right, let's get into the markets now with Laura Cooper, our Bloomberg MLive macro strategist. And we'll have to kick it off with the question of the day, Laura. Was that a rout, was that a blip, that rout, or was it a sign of more to come?
Well, I think, like Anna said, it's really a host of factors that contributed to the sell-off yesterday. And there's speculation, was it this markets coming crashing down to the economic reality? Was it the gloomy Fed? Was it this rising risk of infections? And I think ultimately, there isn't really an obvious catalyst beyond a flushing out of just this too much, too soon sentiment-driven rally. So yes, COVID-19 cases and fresh lockdowns, does warrant caution, but it's hardly looking like a spike in major U.S. states. And I think just the overstretched valuations after really a 45% bounce from the March lows just leaves equities vulnerable to negative news flow just after this period of just ferocious bullish sentiment in recent weeks. And I think, blaming the Fed, the gloomy Fed, and the signal that they're not going to raise rates till 2022 really was more of a fuel than a spark for the sell-off. Because if we look at European equities, for example, those actually began to sink lower on Tuesday, so before the FOMC. So I really think that this tells us this is just more of likely a blip, some shaking off of the recent rally, more of a healthy correction than necessarily this bear market rally that we're going to see kind of a significant sell-off going forward.
Yeah, do you see Asian equity markets, good morning to you, Laura, do you see Asian equity markets sort of taking this in their stride? I mean, we did see sell-offs into the Asian session, but then they seem to be recouped. Is there a sense that maybe if this is about a second wave or maybe even a continuation of the first wave of infections of COVID-19 in the United States, then that starts to become, notwithstanding the size of the US economy on the global stage, of course, but it starts to become a US story rather than a global one?
Well, I think that is the case, because if we look at what's happening, for example, in Europe, we are seeing these, these indications that the recovery is starting to take shape. We are seeing that, yes, virus infections are slightly ticking higher in some areas, but ultimately they do remain contained. And then overlay this with just the valuation story in Europe relative to the U.S., I think that if we do see a flare up in U.S. infections, and that really does kind of materialize in a U.S. equity sell-off, then I think still this search for yield and these kind of improving backdrop in Europe does still support this cyclical rotation there. And I think, yes, potentially Asia is already ahead of this curve as well. Laura,
not really improving in the UK, right? I mean, I realize it's separate from Europe now post-Brexit, but 20.4% drop in April GDP. Is the UK worse off than anywhere else?
Well, I think when we look at the April figure specifically, that really does capture the peak impact of the lockdown, because the economy was essentially closed for the entire month. And, we saw indications of this previously with car production is down nearly 100% in the month. So I think, it's a bit of a backwards-looking indicator. I think going forward with lockdown measures being gradually lifted in mid-May, that we would expect to see some of this ease. I think going forward, really crucially for the UK now, is how we kind of escape from this lockdown, and then overlay that with just the intensifying Brexit risks that are starting to come back to the surface. I really think that the UK is going to be more challenged through the end of the year than perhaps mainland Europe, given what the dynamics occurring there.
Yep, and a lot of focus on that 2-meter rule then, Laura. A nice domestic reference for us. Thank you very much. Laura Cooper, Bloomberg Markets Live strategist. Remember, you can join in with the question of the day. Is the rout a blip or a sign of more to come? If you want to get in touch with us at Bloomberg TV and the M Live team, IB plus TV Go is the function to use on your Bloomberg. Up next, the IMF says the global economy is recovering more slowly than expected. Its chief economist also said it will bear lingering scars from the pandemic. We'll have more on that next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are 47 minutes away from the start of cash equities trading across Europe and in the UK. Here you can see European futures are down. Not huge drops, but we had a horrible day yesterday, both in terms of European and UK index losses, and then even worse in the U.S. To get the Bloomberg First Word news for you right now, here are today's top stories. The UK is planning to introduce soft border checks with the EU, deal or no deal. The measure is temporary in an effort to avoid hitting business already suffering due to the pandemic. The new policy comes as Britain and the EU step up the pace of trade negotiations. Boris Johnson is set to hold a call with Ursula von der Leyen on Monday. Houston may be approaching the precipice of disaster, according to a senior local official. The city is close to reimposing stay-at-home orders as the number of virus cases spreads. The warnings highlight the danger of a second wave of infections beyond the initial hotspots. The virus has so far killed more than 113,000 Americans. And the U.S. can't shut the economy again, even if there is a second wave of infections. That's according to Treasury Secretary Steve Mnuchin. Speaking on CNBC, he said shuttering again could just cause more damage, but also he says it won't be necessary. Testing and contact tracing are improving, and officials have a better understanding of how to contain an outbreak. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, let's talk about the global economy and the extent to which it is recovering or not. The IMF says that the global economy is recovering more slowly than expected from the coronavirus pandemic. Its chief economist, Geeta Gopinath, said that it will bear lingering scars from the experience.
Given the depth of this crisis, given the need for reallocation of labor across sectors, because some sectors like tourism, transportation are going to be hit in a big way, given this margin for bankruptcies and insolvency issues coming up, and prospects of changes in consumer behavior, one has to be quite concerned about the path of recovery, and many of these variables point to significant scarring effects.
Let's get to our conversation with our guest this hour, David Owen, Chief European Economist at Jefferies. David, very good to have you with us. We're definitely going to get to the UK data, which we just had out, and the shrinkage in the UK economy. But there's a lot going on in markets right now, and so we wanted to start with a bigger picture conversation, given the concerns around global recovery and the sell-off that we saw, quite stunning sell-off that we saw in equities and risk assets yesterday. Clearly, that raises questions about wealth effects. How do you put into context the big moves that we're still seeing in markets and the slow pace of recovery for the global economy?
Yeah, and we always try and step back from these things. So we're not really following the markets when we're thinking about how economies painfully, slowly reopen, but it's quite clear that there'll be setbacks for markets along the way, even assuming that economies all neatly reopen and life slowly but surely returns to normal. There's no concept from our side of lingering scarring. This is going to be very, very deep scarring. And I think COVID is going to lead to a fundamental reappraisal of many things going forward. Many sectors in the global economy won't go back to normal at all. And I think, the market has to work its way through this. There'll be some sectors which actually, within there, there'll be companies that actually do well. And obviously, crises always bring innovation, but always bring change. We're seeing absolutely unprecedented policy responses across the piece. That also will lead to repricing over time in terms of markets. So, you can see the market move overnight or over the course of a week or so. But the bigger picture is the market is going to have real difficulty working out exactly where the world's going to be over the next 3 to 5 years. And, this is completely unprecedented.
And I mean, obviously not following the minute-by-minute moves of markets probably makes everyone's job a little bit easier, but central bankers certainly have learned you've got to follow the markets at least broadly. Spreads, for example, Italian spreads are important to the ECB. Powell has to watch liquidity in the U.S. How much do you think these central banks are concerned, though, not about disastrous drops, but about blowing up bubbles, David?
Well, the important thing for the central banks, and it's very obvious with the Bank of England, but it's obvious with other central banks as well. They want the banking sectors to remain part of the solution. So unlike the great financial crisis, the banks then were the epicenter of the crisis, and you saw the money supply and you saw bank lending collapse. And there were all these parallels with the Great Depression of the 1930s, where the money supply in the US fell by 30% and US GDP also fell by 30%. So they had to ensure the banking sector in the Great Financial Crisis didn't go down. The situation right now is banks are lending out. There are credit lines being extended. The money supply has accelerated everywhere in the US, in the UK, in the Eurozone. And bank lending to non-financial corporations in particular is increasing. So in Spain, for example, bank lending to non-financial corporations currently growing over 7% year on year. This is in a major downturn. So that's one thing that the central banks are very keen that continues. The banks continue supporting the economy as economies slowly or surely reopen. And then we've got the concern that the Bank of England again expressed recently, John Cunliffe, about the shadow banking sector being part of the problem. And these very crowded trades, leverage, volatility being introduced into markets. So central banks are looking at that. They're looking at the spread, obviously, between Italy and Germany. But at the end of the day, they can't do everything. And as I say, the markets have to work out. The world in the next 3 to 5 years may look very different to what it was last year.
David, thank you very much. David Owen, Chief European Economist at Jefferies. Stay with us. We'll talk about the UK next. We've had the data out on how the economy contracted during the month of April. So cushioning the blow coming up next in conversation. The UK plans for temporary light border checks with the EU next year to help businesses suffering from the COVID fallout. We've seen that in the GDP data today. Is it enough to avoid a more painful recovery? We will discuss where COVID meets Brexit trade talks next. This is Bloomberg. Welcome back to the European Market Open. Still 40 minutes to go until the start of the European trading day. The Asian session was very weak, and then we pulled back from some of those earlier losses. European futures do suggest we need to see a little bit more selling at the start of trade. By a little bit, I mean more than 1%. So we could be down by more than by 1.1% according to Eurostoxx 50. Now, the UK plans for temporary light border checks with the EU next year. This move, which will happen whether a trade deal is agreed or not, is an attempt, we understand, to soften the blow to businesses already struggling with the impact of the coronavirus. That comes as the UK economy shrank by 20.4% in the month of April, more than analysts had expected. Let's get back to David Owen, who's still with us from Jefferies. And David, I was looking at your notes ahead of our conversation today. Do you think it is possible that we see some sort of extension to the Brexit or post-Brexit trade conversations later than this month? Because in theory, the end of this period is supposed to come this month, and there's supposed to be a decision on whether there'll be any extension at the end of this year. But you seem to think that that could still come later in the year. Why so?
Well, as ever with the EU and Brexit, everything can be fudged. And also politics in all this, the optics of the politics matters hugely. So at the moment, I think there's very little chance that obviously the government here is going to ask for an extension, and Michael Gove, again, making that clear. But it can be fudged, and constitutional experts, will tell you that. I mean, there's, studies published recently by the Institute for Government, the sort of constitutional lawyers who work alongside UK and a changing Europe as well have grudgingly accepted it. It can happen. Obviously, the politics are very interesting because the sectors which are going to be most impacted potentially by a really hard Brexit, and the regions which are going to be most impacted are the ones which unfortunately have been impacted obviously pretty badly by COVID. But they also gave Boris Johnson his 80-seat majority in the House of Commons in part. So you've got to think, well, this could all change. We know voting intentions suggest that people in those regions now do not want a no-deal Brexit. And it'll be very interesting to see the reaction to this proposal that actually we will be a light touch customs checks on our side, because obviously trade goes both ways. So, I'd be interested to see the EU27 response, but also the response of trade economists and trade lawyers to what the government here in the UK is currently proposing. They'll probably go, well, actually, that isn't really going to work in practice. You can say it as a negotiating tactic, but really, it's not going to fly. That's the trouble with all this. There's so much politics wrapped up into it.
How bad, I understand your point about certain people not wanting a no-deal Brexit, but how bad would it hit GDP?
Well, nothing like the hit to GDP from COVID, but the problem is it's Brexit's for life. And what we really would wish to stress is that most discussion is about trading goods, agricultural trade going between borders, the North and South of Ireland, whereas for the UK and indeed for Europe going forwards, it's the service sector which is so important. The embedded services and the manufactured product, the intellectual property, the research development, the licensing, the financing, everything to do with that. And the UK wants selected access for services, but equivalence is not the same as mutual recognition. And there's too much focus around the financial service sector. The UK excels at services, full stop. And we need access to continue trading with the biggest market on our doorstep, which is the EU 27. So,
okay.
I think all these things are going to be worked out.
Yeah, really interesting. I learned all about Mode 5 services and the export of those attached to goods from reading your notes. So, David, thank you very much for joining us. David Owen, Chief European Economist at Jefferies. Thanks for bringing us your insights on global growth and indeed the UK story there as well. French call centre operator Teleperformance will join the CAC 40. That conversation with the CEO and founder, Daniel Julien. That conversation is coming up next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open, 30 minutes from the start of cash equity trading after a day of huge losses. And we're looking at futures, at least here in Europe, that are still pointing down. U.S. futures a little higher this morning. Now, French call center operator Teleperformance will replace the catering company Sodexo in the CAC 40. That's as call volumes are continuing to increase due to COVID-19, expanding Teleperformance's essential services role. The index change will come into effect on Monday, June 22nd. And of course, a lot of funds that track the CAC will have to, for that reason, add Teleperformance shares to their portfolios. We're joined now by the CEO of Teleperformance, Danielle Julien. And Danielle, let me first ask you what this means. Obviously, a lot more fund managers are going to be buying your shares. A lot more investors will be watching and participating in the Teleperformance business. What does this change for you?
I think it's very positive for us, of course, because it gives us more visibility globally. You know, our shareholder base is made of roughly 50% Anglo-Saxon, 25% French, and 25% other European. So I expect it to enlarge. And to me, the fact that we joined the CAC 40 is a representation of three power of today. It's the telecommunication power, the computing power, and the consumer power. Because if we exist, it's thanks to these three power converging together.
Your business, good morning to you, Daniel. Your business is all about customer interaction. Businesses need to interact with customers, whether they're working from home or working from the office. So what difference has the work from home trend actually made? Can you give us any numbers?
Oh, yeah. First, you know, we have been disrupted, like absolutely everybody, by the pandemic. The fact is, as we have an operation in China, we saw very, very early what was going on, and we decided to move heavily to rebalance our operation from brick and mortar to remote working. And in fact, in less than 2 months, we have passed 80% of our people in work at home, which means, as you can imagine, a lot of technology, a lot of logistics, a lot of discipline. But then we have been able to continue to serve the customers and the citizens, because we also work for the government. And it has been a very interesting eye-opening, because, in fact, we were able to get the same kind of quality, key performance indicator, with the work at home than what we had traditionally with the brick and mortar.
Do you think you're going to be doing, Danielle, with likely the boosted shareholder, the broader group of investors here, some M&A? I mean, does this give you the opportunity to make purchases? Have you got your eye on any targets?
You know what? Over the decades, the growth of Teleperformance has always been organized between to have a strong organic growth, significantly higher than the average of the market, and to make targeted, specific acquisitions that bring us values, more knowledge. And recently, we made an acquisition in India, a large acquisition of a company that has really developed digital integration in service. And yes, we are going to continue our growth strategy, but this growth strategy, we are not looking at weak companies or so. We are looking at companies that have the DNA to build the future, and so to enlarge our scope of services.
Daniel, you founded this business back in 1978. Since then, it seems to have been a fairly bumpy but very positive ride in terms of the stock price performance. How much does it mean to you to now be in the CAC 40, to have got your business to that point?
Yeah. You know what? I started this company in a small meeting room with 10 telephone lines. Today we are in 80 countries, 330,000 people, hundreds of thousands of net computers, sophisticated network. So it means a lot. It means a life. It's not a job. It's a life. Now that's for me. Now I think that it means also a lot for the team of Téléperformance. They are proud to be TP, like we say, and it's going to give them even more energy to continue to succeed and better serve customers and citizens. No, we are extremely happy, but now we know what? This is just the beginning of a new chapter of our life. And now there are more expectations and we need to deliver.
All right, Daniel, thanks so much for joining us. It's been a pleasure having you on this morning. Daniel Julien, the CEO of Teleperformance, got a huge boost, obviously, from the work from home changes that we've seen. The question is, how long will they last? What we know for sure is Teleperformance will be added to the CAC 40 on June 22nd. So stepping up to the big leagues in index terms after its business already showed a big pickup. Up next, snubbed by America, Germany turns to China as Merkel pushes for access to foreign companies. We'll talk next with one of the chancellor's wise men. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. Right now, we are 20 minutes away from the start of cash trading. And after the huge rout we saw in equities yesterday, both here and in the U.S., we're seeing futures point down again today for Europe. If stocks fall today, they will have lost ground every single day this week in a European trading. You can see here, U.S. futures are actually pointing up after the 5 to 6% drops we saw yesterday on U.S. indexes, but European futures are lower. Let's get the Bloomberg First Word News for you. Here are today's top stories from the Bloomberg Terminal. The global economy is recovering more slowly than had been expected and will bear lingering scars from the coronavirus pandemic. That is according to the International Monetary Fund. The IMF is set to release its latest growth projections on June 24th. They're likely to be worse than the 3% contraction it predicted back in April. West Texas crude is heading for the first weekly loss since late April. That's on fears a second wave of virus infections in the U.S. could derail a fragile recovery. Swelling stockpiles are also raising concerns about excess supply. Markets shrugged off a pledge by OPEC and its allies to extend their output cuts. The UK economy shrank a record 20% in April. That's as businesses reeled under the coronavirus lockdown. The contraction follows a nearly 6% drop in March. Those figures come in a difficult week for the Prime Minister. He's under pressure to reopen the economy more quickly while facing criticism for his handling of the crisis. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries, including Germany. And here, Angela Merkel has reached out to China, urging Li Keqiang to allow market access to foreign companies. She spoke with the Chinese premier yesterday to discuss an ambitious investment accord between the EU and China. Thursday also marked a 500 million euro deal between Volkswagen and its Chinese partner Jinghuai, making Volkswagen the number 2 foreign car maker in that nation. This comes just days after President Trump stunned Germany by revealing a plan to pull troops out of the country without any forewarning, and Russia's been involved in this whole drama as well. Let's talk through some of it with Lars Feld, chairman of the German Council of Economic Experts, one of the so-called wise men. Lars, thanks so much for joining us. Let me first ask you about this bridge to China. It looks as if the Chancellor is and the EU really are building bridges to China where the U.S. may be burning them.
Well, this is one of the programs that Germany and the EU have followed for quite some time. They wanted to have an investment agreement with China for a longer time, and now try to conclude it in such difficult times as we are due to the corona pandemic. But I don't think it is a reaction to the difficulties that have arisen with the US in recent times.
You don't. So where do you see the relationship between Germany and China heading then, Lars?
Well, the problem with China has been until recently that they wanted to invest considerably into firms in European countries. The EU and Germany have reacted with further restrictions on these foreign direct investments from China. And now they try to have a kind of reciprocity agreement in order to access the Chinese market more considerably, and then on the other side also be able to remain open for Chinese investors.
Where do you see the relationship between Germany and the U.S. headed? I mean, we have reports of President Trump really snubbing Angela Merkel as she's trying to step up to Vladimir Putin. Pulling troops out of the U.S. is really not a good look at a time like that.
Well, I have the impression that some people in Germany still wait and see what the presidential elections are going to bring. I think that the relationship with the US is going much deeper than only looking at the heads of state. So I think that there's going to be a further cooperation between us. I must say that the US is the most important market for German products. I can't imagine that there's going to be a real conflict between the US and Germany, or the US and the European Union.
Is it still advisable, though, for
we've seen, of course,
Angela Merkel and Germany to push for this pipeline between Russia and Germany? Is it still advisable to, make sure that Putin and Russia are paid tens of billions of dollars for their for their petroleum products while trying to stand up to them, and it's clearly made the U.S. unhappy.
Yes, I know it's making the U.S. very unhappy. But on the other side, it is very important for energy support in Germany in particular, but also in other parts of Europe. And I guess that the German government still wants to pursue this road. The contracts are closed, so we want to stick to the contracts we have agreed upon, and we don't think that we are going to back down just because the U.S. is unhappy about it.
Lars, we've seen the European governments, to some extent at least, coming together to announce a rescue fund for the Eurozone economy, and lots of people talking about this as the start of a debt sharing. You don't like some of that, I understand. Some of the elements of debt sharing you don't like. Would it still be possible to amend this package to make it sit more comfortably with you? What is it about it you don't like?
Well, I've always made clear that Corona bonds, in a sense of joint and several liability, is a no-go for us. It would finally hurt Germany, but in particular also the Netherlands or Austria. But the suggestion that is on the table, the proposal by the EU Commission, but also the Merkel-Macron plan, they show that this should be a 500 billion or even 750 billion if you take the EU proposal. Rescue fund, which is allowing the EU to issue bonds in the markets, which are guaranteed by the member states. And the guarantee by the member state is something which is quite different from joint and several liability. And therefore, I think it is a kind of compromise proposal that is worth pursuing. Very much depends on the way the money is shared to countries particularly hit by the Corona crisis. I think we cannot go on without any conditionality. I think there should be something the southern European states are offering to the north.
We see a second wave, what looks like possibly a second wave of the coronavirus going through the U.S. And we've seen recently an increased number. Some of the red lights have been going on in certain cities and states in Germany. Are you concerned about that possibility here in Europe?
We are pretty much concerned that there's going to be a second wave of infections. What I learned from my colleagues from epidemiology, from the virologists as well, is that a second wave of infections will not be avoidable at the latest during the winter term. And I think the question is not whether we can fully avoid such a second wave of infections, but whether we are better prepared to cope with it in order to avoid the lockdown that we have currently seen. So when you think about the South Korean strategy, it worked pretty well. And South Korea didn't have to lock down its economy as much as Germany did. Of course, in France, in Italy, in Spain, the lockdown was even harder than it was in our country.
We've talked a bit about the pan-European response. What about the German response, the German fiscal stimulus, Lars? Do you think that are there elements of it that worry you in terms of the government directing the economy to a larger degree than it did previously, taking stakes in businesses, bailing out businesses, picking champions in certain sectors? Are you concerned about the role of the state here?
Well, I am concerned with the role of the state, and I'm always looking very carefully what the government is doing in that regard. I can fully accept that there is a huge fiscal stimulus needed in order to cope with this crisis. But it should not be used to conduct a particular industrial policy while closing down to some extent the German economy to investors from abroad, in particular investors from China or the US. So this is something we have to be very cautious about, that nothing like that happens.
Well, what do you think we're going to need in terms of stimulus when the second wave then hits? I mean, how do you expect that to affect the economy further?
Well, the goal is to avoid a lockdown during a second wave and to be able in the health system to cope with a second wave fully if it's coming up. Then we perhaps don't even need a second or third package of fiscal stimulus. Perhaps then everything is working out quite fine, and we can have this V-shaped scenario of economic growth in Germany. This is something we are still trying to realize. And when you look at the most recent figures, they reported about April, it shows this big breakdown of the German economy. But when you look at figures from May, from last week and so on, you already see the take-up of the German economy as well. So it very much looks like that we can realize a V-shaped scenario, and then avoiding a second lockdown will be sufficient.
Yeah, in pursuit of that V-shape. Lars, thanks so much for joining us. Lars Feld, Chairman of the German Council of Economic Experts, often advising the government. So thank you very much for joining us. Minutes away from the open of the European equity markets for this Friday. Up next, from Lufthansa to Renault, value shares were crushed in yesterday's trading. Will they see any reprieve today? We'll look at those stocks and factors to watch. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are just about 6.5 minutes away from the start of cash trading, and we're still seeing red arrows here, even after the big drops that we had yesterday. Looks like a little bit of a bounce in U.S. futures, but European futures are still down. Let's get the Bloomberg Business Flash for you. Today's top corporate stories from the Bloomberg terminal. Hertz is asking a judge to let it take advantage of a surge in its stock by selling up to $1 billion of new shares. Bankrupt companies are technically wiped out, but Hertz has seen a 2-week rally. Investors are bidding up bankrupt travel companies on optimism the economy and the market are poised for a rebound. A hearing is scheduled today to consider that idea. Yum Brands is suing Grubhub over the cancellation of a 5-year deal to deliver food from KFC and Taco Bell. Grubhub declared the deal invalid, citing Yum working with rival delivery platforms. Yum says the move will hurt customers who will end up paying more. The suit comes a day after Just Eat Takeaway agreed to buy Grubhub for $7.3 billion. And that's your business flash. Anna?
Minutes away from the open of equity trading, stocks that trade at a steep discount, Matt, were punished in yesterday's sell-off. Value was one of the worst performing factors in Europe, with cyclicals from airlines to autos being crushed. What does that mean for today? Danny Berger's here. Danny.
And that's right. And I don't mean to toot my own horn here, but I have to say last week on the show, I talked about the fact that value had been performing really well without much of a reason. And it almost seemed like the last gasp of a rally. Well, that sort of came to fruition yesterday, and value was really what was concentrated in the pain of yesterday's sell-off. So what does that mean for today? Well, it's likely that some people are going to look at some of these value shares in Europe and say, okay, maybe they don't deserve to get as punished as they did. I mean, Renault, look, dropping 14% yesterday. But looking at the Asia session so far, value is still getting punished over there. European futures are down again today. So it is likely we're going to continue to see pain in value. If you want to bet on the other side of that, look for momentum shares to do better today. Matt, Anna.
A minute to go until the start of the cash equity trading session for this Friday morning. Let's get to your headlines. The $2 trillion wipeout. US equities see their worst rout in 12 weeks as sentiment suddenly turns sour. Is the worst over, or is there more to come? The precipice of disaster. America's fourth largest city says it may reimpose stay-at-home orders as coronavirus cases surge. But Stephen Mnuchin says the country cannot close again. US futures rise. Plus, European banks are close to getting relief on capital requirements after the EU agreed to sign off on legislation to mitigate losses on government bonds. A lot going on this morning then, Matt. What do the futures look like?
Well, we're seeing futures down here in Europe, and it's a little bit surprising because we had losses on almost the same scale yesterday as the U.S. then had them overnight. Not quite as much, but we're still seeing an indication of a very risk-off open today, even though U.S. futures are higher. Here you can see the left-hand column, the FTSE opening up down 0.25%. And then in terms of equity futures, you can see they're still all down on the right-hand column there. Back on the left, we see the IBEX open down 0.5%. You see the Euro Stoxx 50 benchmark there down about 1/3%. But these losses are accelerating a bit with the FTSE now down more than 1%. The DAX opens up down 0.75%, and the CAC down about 8 or 0.9%. And keep in mind, this comes after big drops yesterday. The DAX was down yesterday more than 500 points. It was approaching 13,000 when we closed on Friday last week, and now it's back down into 11,865. So we've lost a heck of a lot in 5 days of losses this week. Fears of a second wave of the coronavirus spurring some of those losses. Also, Jay Powell's warning of lasting economic damage spooked U.S. stock markets yesterday, causing them to wipe out $2 trillion of value. Joining us now is Janet Mui, Bruin Dolphin Investment Director. And Janet, let me start off with our MLive question of the day. Do you think the drop that we saw yesterday and really being extended now this morning in Europe, was that a blip or is it a sign of more to come?
Well, hi, good morning. So we think that, markets have rallied quite significantly since the trough on March 23rd. So the S&P has rallied over 40%. So I think investors have baked in a lot of optimism on the reopening of the economy and also the various stimulus that the central banks and governments have put in place. So, they're always concerned about the potential for a second wave or whether the recovery of the economy is going to be persistent. So I think because of the news coming out that some U.S. states are having some spikes in cases, I think it is not a surprise that markets are having some correction because of the massive rally that we've seen. So what we are confident is that we are probably not going to test the lows that we've seen back then in March because, we're having the reopening of the economy. We've got support, stimulus, and what we think is that even though we may see second wave of infection, it will probably be better managed than before. And we think that as the U.S. Student Mnuchin has said, they probably will not stop the economy from running in. So what we think is that there may well be some small correction going forward just because so much optimism is baked in. But we think that ultimately we don't envision another correction like we have seen before.
You say that maybe the worst is over. Is it difficult to be overweight equities, or is it easy to be overweight equities then, if that's the case, given the heavy selling we saw yesterday?
Yes. So I think the risk to the outlook now is roughly balanced at the moment. Like we see some positive points. For example, the worst is over. The economy is gradually reopening. We saw from some high-frequency data that the data is picking up and stimulus in place. And but we also see downside risks, like we have mentioned before. So we think the risks on balance are quite neutral. But overall, we are adding a bit of equities now, primarily to the U.S. and emerging market ex-Asia.
Janet, we just spoke with the head of Angela Merkel's Council of Economic Advisors, Lars Feld, and he told us basically that they expect a second wave here in Germany. Is that for you a risk in terms of your investment strategy, or do you believe that the stimulus put in place so far and the rules that we've seen will help us to avoid a bigger drop in GDP?
Yes, absolutely. I think the worst in the economic situation is probably past now. I think going forward with the stimulus in place and the reopening of the economy, and as I mentioned, we think that even though there may well be a second wave of infection, we cannot really predict that. But we think that this time around, the governments will have better measures to cope with it. And also, the trend is people are now wearing face masks more often in public, and I think that could be better at stopping the spread of the disease, unlike previously. And also, there are also positive developments on the medical side. I mean, I know a vaccine is still far from being developed, but there's progress going on. So I do think that the worst is over. And I think with the stimulus in place, I think the economy can get back into a better footing.
Yeah, that's going to be really interesting, isn't it, to see the extent to which governments deal with this differently. If there are confirmed persistent second waves taking place, how governments manage to deal with that in a perhaps more granular fashion than the very blunt instruments they've had to deal with full-on lockdowns of the economy. With all of that in mind then, Janet, do you sell gold? Is the rally in gold over?
So we still like gold. I think the debate is because gold has really rallied quite a lot as a safe haven. So basically, if we continue to see better economic data coming through, if the uncertainty on the outlook is reduced, then I think it may be harder for gold to get a big upside in the near term. But we do continue to like gold. We think gold will continue to have a place in our client portfolio. Is really because of the low interest rate environment that we are going to be in. And I think with bond yields being so low and negative in some areas, we think gold is potentially a better hedge for portfolio than traditional safe havens like government bonds.
All right, Janet, you're going to stick with us. We got more with Janet Mui, Bruin Dolphin Investment Director, on what to expect coming forward. Is visibility clearing up? How to invest as well. We've got some headlines coming out in terms of the very hot airline sector during this crisis. Ryanair and EasyJet, as well as British Airways, launched legal action against the UK government. We are fortunate enough to have a former airlines analyst here with us, so we are going to continue to cover that for you. Plus, coming up, cushioning the blow, the UK plans for temporary light border checks with the EU next year to help businesses suffering from the COVID fallout. Is our guest right to be cautious about the United Kingdom? We'll discuss. This is Bloomberg.
Welcome back to the final European trading day of the week, of course. Stocks in Europe down by 0.6%. Bear in mind the heavy losses of yesterday in the US and in Europe. US futures, incidentally, pointing upwards now. Dow futures up by 1%, as are E-mini futures. Let's talk about what's going on in the UK. The UK plans for temporary light border checks with the EU next year. The move, which will happen whether a trade deal is agreed or not, is an attempt to soften the blow to businesses already struggling with the impact of the coronavirus. That comes as the UK economy shrank by 20.4% in April. Let's talk to Janet Mui, Brewin Dolphin Investment Director. And Janet, we know very well that the FTSE 100 and even parts of the 250 and smaller are not measures of the UK economy. They're more global. So where do you stand on UK assets as a result of this understandably, but still dramatic, weak growth picture in April?
Yeah, so I mean, the UK economy is suffering the worst GDP since post-war period. So this is definitely very devastating. Well, I think the equity markets in the UK may have previously priced in this very weak economic growth. So it is not apparent how weak economic data is going to impact the UK stock market. But what we think is that the UK stock market generally, they're a value trade. So they are more heavily weighted in banks and commodities, which are more difficult to perform well in the environment of low interest rates and also low commodity prices. So generally speaking, we think that UK, if you talk about equity assets, is probably less attractive than their counterparts in the US, where there's more heavy weights in growth styles such as technology. And in terms of government bonds, we think that with the yields being so low at the moment, although we don't actually foresee much upside or downside in the yield at the moment, we think that the risk reward of holding government bonds is just not good enough. And on the property sector, we have actually turned a bit more negative on UK commercial property. It's just because we think the fundamentals are pretty poor. Especially after COVID-19, we think the demand for commercial property on the retail sector as well as the office sector is going to be a bit more uncertain and probably be more difficult going forward.
You were saying that you prefer the U.S. to the U.K. right now, Janet. When does the political situation become important for investors to pay attention to? You know, we have... I mean, November isn't that far away already.
Yeah, absolutely. So, I mean, we think that the US-China tension is going to remain fragile, actually, especially after the COVID-19. So, but we think that it is probably very unlikely to have the extent of political tension flare up like at the peak of the trade war last year before we got to the phase one trade deal. It is really because I think the US is already very preoccupied with dealing with the health crisis right now. I think it is more important for the president to sort out the economy at the moment. I think really, unless Trump's approval rating slides to an extent that he really has to throw in the towel, then we think that the political risk is going to emerge after the US election rather than before that.
Yeah, interesting. John Authers, our colleague, with an interesting piece on the way that the election expectations might be working their way into the stock market. That was out overnight. Janet, thank you very much. Janet Mui, Brewin Dolphin Investment Director. Janet will be continuing her conversation with us here at Bloomberg on Bloomberg Radio at 9 a.m. UK time. Coming up on the programme, European banks are close to getting relief on capital requirements after the EU agreed to sign off on legislation to mitigate losses on government bond holdings. That doom loop. Will we manage to break it? That conversation next. This is Bloomberg. Welcome back to the European market open, and things moving pretty fast on the markets this morning. Yesterday, devastating selling, down 5% or so on some of these markets in Europe, 6% nearly in the US on the S&P. Today, US futures pointing higher by 1.3 to 1.6%, and that seems to be turning around the fortunes of European equities. We started off very much in negative territory. Now we're back in the green, up by 0.1%. The FTSE lags, but elsewhere we see decent gains coming through across European markets. Now, Ryanair, EasyJet and British Airways have started legal action against the UK government's quarantine rules for international arrivals. They want the government to re-adopt its previous quarantine policy introduced in March, which limited self-isolations to passengers from high-risk countries. That's as the aviation sector has already been hit hard, of course, by the coronavirus. We spoke to the COO of the US low-cost airline JetBlue. Joanna Gerati of JetBlue Airways spoke to us exclusively about what it will take to get passengers back in the sky.
What we've learned is the only thing certain is that there is a lot of uncertainty. So as you see things folding in the news media today, regarding increasing cases in certain parts of the United States, our focus has really been on how do we build customer confidence in flying again. We've seen small glimmers of hope in the leisure sector. JetBlue is largely a domestic carrier, and we think that domestic travel will come back sooner than international travel, and leisure obviously coming back sooner than business travel.
Just in terms of how the business is ultimately going to evolve, though, there are some key dates coming up. And one of those comes at the end of September when the CARES Act money and the restrictions that it brings start to expire. You will then have the freedom to start to change this airline to fit the new reality. What is JetBlue going to look like in that environment?
Correct. So first, I'll just say, we've been very lucky to be a recipient of CARES Act payroll dollars. It covers about 76% of our payroll. After September 30th, when the CARES Act payroll dollars cease, we're looking at what the size and shape of JetBlue will look like. We're obviously going to be a smaller airline, but again, it's so difficult to predict that far out. Every week we learn so much more about the impact of the coronavirus. We're really looking to June and July as signals as to demand recovery and what we think the coming months are going to look like.
In terms of what that demand is looking like right now, you say that at the moment, as you kind of are positioned in the leisure market, that's where the primary kind of area is. Is it people going to see sort of friends and family that you're seeing demand from at the moment, or is it genuine kind of leisure travel?
So it's a combination of two things. So we are seeing a pent-up demand for leisure travel, but we're also seeing customers going back and seeing their family and friends. And we've seen this in prior events, whether there's political unrest or whether there are hurricanes and whatnot, that, the VFR customer segment of people really going to visit their friends and relatives tends to come back earlier than, for example, the business sector.
Just in terms of the concerns that passengers have, what are you seeing at the moment? What feedback are you getting from the passengers that you are taking on board at the moment? You referenced safety a little bit earlier on. What feedback are you getting?
Sure, we're measuring very closely every week what is important for customers to rebuild their confidence in traveling again. Obviously, some of the top items are cleanliness of the aircraft, social distancing and physical distancing is also very high on the list. We've built a program that will continue to evolve around those very things our customers are telling us will make it confident for them to travel again. They want our crew members to be healthy when we're serving them, a focus on air and clean surfaces, reduced service touch points, so we're no longer providing some of our higher touch service, and then obviously travel flexibility is also an important component.
What are your staff telling you, Joanna?
Our staff are very focused on the success of JetBlue. Everybody is focused on trying to ensure that we're doing everything we can so that customers start feeling comfortable flying again, whether that's how we serve them, whether that's the cleaning products and policies and procedures we have in place. Our crew members are very dedicated to JetBlue. We have a unique culture here. It's very much a family, and everybody is rowing in the same direction, trying to make sure that JetBlue weathers this storm and emerges as strong as it was when it entered.
How do you think the network is going to change as a result of COVID-19? I want to come on and talk about London. You have the banner behind you in just a moment. But within the United States, you are largely, as you say, a domestically focused carrier. How does the network change? How does the offering change? Do you think things like your front of the plane Mint offering changes? How are you going to reconfigure?
I'll speak to network first. So as you mentioned, we're largely a domestic carrier. 70% of the seats we fly are in the domestic markets, and then 80% of customers that we carry are leisure. So we feel that we're set up for a recovery sooner than some other airlines. We do think that domestic will return quicker. We think that short haul international will return quicker than longer haul international. Right now, international is sort of a patchwork of different openings, and so we're watching that very closely. But I think from JetBlue's perspective, as customers start getting confident traveling again, we do think that we're well positioned to take advantage of that.
That was Joanna Garati, JetBlue Airways President and COO, speaking with our own Guy Johnson. Now, European banks are close to getting relief on capital requirements. That's after the EU agreed this week to sign off on legislation that would offset the considerable negative impact stemming from losses on government bonds, according to a document that summarizes the deal. The package is on course for a final agreement within days. Joining us now on this is our European economy reporter, Alex Weber. Alex, what's this change then all about? Break it down for us.
So this helps banks deal with volatility in sovereign bond markets specifically. And if you remember, a few weeks ago, Spanish and Italian sovereign bonds fell pretty sharply in the wake of the virus outbreak. Normally, that means that banks take a hit to their capital ratios. And temporarily, they don't have to take this hit, and it helps them keep credit flowing to the real economy. That's the hope. And Italy and Spain were also the countries that pushed for this.
And Alex, how does this tie in with everything else that regulators are doing to help banks? Because there's definitely a push to help banks to help the economy, to make banks be part of the solution here and not become part of any problem.
Exactly. So after the last financial crisis, regulators have, of course, tightened the rules in many aspects and raised capital requirements very significantly. And now the concern is that this would keep banks from borrowing to small, medium-sized companies, because that's exactly what happened in the last financial crisis. And now regulators are quickly trying to get rid of any constraints, like temporarily reducing capital requirements, also in anticipation of a rise in bad loans. So all of this is really meant to make banks kind of part of the solution. That's what we keep hearing, and make sure that they don't become a bottleneck and companies have access to credit to survive the shutdown.
It seems like slightly the rules that we saw imposed after the financial crisis, though, Alex, are now being loosened. Is that the case? We just got 30 seconds here.
Yeah, you could get that impression, but there are some expiration dates built into these rules that we will go back to normal in a few years' time. But of course, we've often seen that this proves to be difficult in reality, and especially so if the economy doesn't recover quite as quickly as regulators are hoping at the moment. So we'll see.
All right, great. Yeah, definitely great to get, and we'll have you back on when we find out as well. Alex Weber, our European economy reporter, joining us there out of Brussels. Up next, the $2 trillion wipeout. U.S. equities see their worst rout in 12 months as sentiment suddenly turns sour. But futures are up today. Is there more to come? This is Bloomberg.
Welcome back to the European Market Open. And that European Market Open started in very negative territory, but we have since clawed our way back. US futures are positive, and that possibly is helping. So the Stock 600 in Europe, pretty flat right now. Up a touch, up 0.1%. The CAC 40 in Paris doing quite nicely, up 0.4%. The FTSE 100 a bit of a laggard. When it comes to the sector picture, of course, it was some of those value stocks, some of those really beaten up travel and leisure and oil stocks, in fact, that were weak in the US yesterday. What have we got today then here in Europe? Auto parts, real estate and banks all to the upside, not by much, but a percent or so. To the downside, telecom and healthcare. So we do have a fairly risk-on sector breakdown when we look at the Stock 600, even if the overall numbers on the Stock 600 are fairly muted in terms of the size of the gains. But you know, Matt, we'll take it. After the heavy selling of yesterday, being flat to positive seems decent for a Friday morning.
Yeah, absolutely. I mean, we were on pace for a whole week of losses here in Europe. Let's get the Bloomberg First Word News. These are today's top stories from the terminal for you. The U.S. can't shut down the economy again, even if there is a second wave. That's according to Treasury Secretary Steve Mnuchin. Speaking on CNBC, he said, shuttering again could just cause more damage. But also, he says, it won't be necessary. Testing and contact tracing are improving, and officials have a better understanding of how to contain an outbreak. The UK economy shrank a record 20% in the month of April. That's as businesses reeled under the coronavirus lockdown. The contraction follows a nearly 6% drop in March. Those figures come in a difficult week for the Prime Minister. He's been under pressure to reopen the economy more quickly while facing criticism for his handling of the crisis. Ryanair, EasyJet, and British Airways have launched legal action against the UK's quarantine rules. They previously threatened the move against rules, saying the international arrivals have to isolate for 2 weeks, people arriving from international locations. The airlines think it will further damage an already struggling travel industry. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, now stock markets in Europe, as we've just highlighted, mostly in the green after a negative open. That is after yesterday's sell-off, which saw $2 trillion wiped off the value of US stocks. The pullback was the largest since the height of the coronavirus crisis from a market perspective in March, and some have said it was long overdue. But the question now is, was this just a temporary blip or the sign of more to come? Let's put that Markets Live question of the day to our colleague, Ven Ram, who joins us from the Markets Live team, currency and rate strategist, of course, Ven. But looking at assets as a whole, you must be mindful of the sell-off we saw in risk assets yesterday. What did it mean to you?
Morning, Anna. What it means to me is that there's going to be more and more volatility, bouts of volatility coming our way. If you look at it, Thursday's meltdown was a train wreck waiting to happen in one sense, and would not have taken place had it not been for the melt-up we saw in the few weeks earlier. Even after yesterday's sell-off, the combined earnings on S&P 500 is $125, which means that even at current levels, the PE is a staggering 25 times. Isn't that insane? Yes, of course it is. But if you think that 10-year treasuries offer less than 70 basis points, fund managers have no choice but to buy stocks at insane levels. So if you bring all this together, what is the picture that you see? The picture that you see is a recipe for heightened volatility, not just once, but over and over and over again. Anna, Matt?
Then we've heard more concerns about a second wave, first out of the U.S. Today we spoke with the head of the Council of Economic Advisors for Angela Merkel, Lars Feld. He said Germany's expecting a second wave, but that he's not expecting, or he's hoping not to have to lock down again. He's hoping not to have to get more stimulus. And Janet Mui from Brewin Dolphin also said she thinks governments are better prepared to deal with a second wave. Is it possible that investors are too concerned about a second wave?
Investors have every reason to be concerned about a second wave, Matt, because what it means for industry, what it means for travel and leisure industries, what it means for the hospitality industries, the economy is going to bear the brunt of all this impact. But from a policymaker perspective, they are probably thinking we can't get the economy to shut down every 2 months forever, and maybe, just maybe, the virus is less potent this time around. So on the one hand, policymakers are grappling with hope, but on the other hand, investors are having to confront the reality of anemic earnings. And that is why we are getting this dichotomy. Matt, Anna?
Yeah, don't say the word forever. That's a worrying thought, isn't it, Ven? Let's talk about where the dollar heads then, because, of course, it's been a haven through the crisis. We saw that yesterday as well as risk assets sold off. Today it is flat. Where do you expect the dollar to head next, Ven?
I think what has happened in the markets is in a sense, good thing, because the dollar, the premium that the markets have attached to the dollar has actually shrunk in recent weeks, despite yesterday's rally that you mentioned in the dollar. And that is a good thing. And that has come about because of the Fed's very effective backstop that has included purchases of treasuries to credit and just about everything in between. But for the Fed's backstop, we would perhaps be having a very different kind of conversation today about the dollar. And all that it means is that the dollar is likely to stay supported for now, but I don't see a huge rally on the cards. Anna, Matt?
Ven, thanks so much for joining us. Great to get your insights today. Ven Ram is Bloomberg MLive currency and rate strategist. You can check out his work and the work of his colleagues by typing MLIV Go on your Bloomberg terminal. Coming up, La Liga restarted with an Andalusian derby in an empty stadium. Up next, we discuss the reopening of European football with Paul Barber, the CEO of Brighton and Hove Albion. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 40 minutes into the session right now and back to red arrows. We've seen a lot of volatility this morning, and we saw obviously massive routes yesterday, big point losses here in Europe, 5 to 6% drops in U.S. equity indexes, and now we're seeing a continuation of those drops here in Europe. If you take a look at U.S. futures, you still see gains there. Now, La Liga returned to action with an Andalusian derby between Sevilla and Real Betis in an empty stadium. The Spanish top flight is the second major European league to return after the lockdown. The French league is the only one of the so-called Big Five that called off the competition. La Liga president Javier Tebas told Bloomberg that the French government's decision was a mistake.
The day when the Prime Minister of France said at Parliament that he was going to suspend the competitions, well, we said that we thought this was a big error because they were anticipating things. At that time, nobody knew what was going to happen, that there was plenty of time to think about what could be done. So, in fact, we have demonstrated that the European competitions could go back because 4 have started. You know, they say it was, we don't know if it was for health reasons, for other internal pressure, which hasn't been talked about. When we talk about the damage, we calculated that the damage for this season, that's the first thing we were worried about. If we didn't start the competition, so the TV rights and the loss in ticketing income, we thought it was 1 billion euros of losses. But if we restarted the competitions without people or behind closed doors and without the sale of tickets, we're talking about 400 million.
When you were looking at when to reopen, what was the cost benefit details that you looked at?
Regarding to financing, well, there's all different types. Certain funds have been financing Spanish football. We've got a very healthy financial structure because we have got an economic control of the Spanish clubs, and that's very important because that means that the financial markets have been financing football, but also they've got access to other Spanish banks who are offering finance. So today, I can't say exactly that Spanish football have actually needed to go and finance the deficits, but the clubs are very aware that the deficit has to be financed, not just by getting loans, but also because they have to reduce their expenses. And so obviously we help them, we go over their financial control to help them. Obviously there could be timely cases, one-off issues that we help them. But in general, I think that we are not going to have a big problem with the finance in Spanish football.
That was the La Liga president, Javier Tebas, of course, speaking through a translator. So, Spanish football is back. German football is back. Now 5 days until the return of the Premier League here in the UK. Let's continue this football conversation then and speak to Paul Barber, the CEO of Brighton and Hove Albion Football Club. His team currently sits 15th in the top flight. Their first game back is at home against Arsenal next Saturday. Paul, great to speak to you today. Given the decisions that we've seen by the French and also the League One and League Two leagues in the UK, in England, would you have preferred actually if this season had been cancelled entirely, given the relegation risk?
No, there's a risk of relegation every year if you're a club in the lower half of the table, as we are. We're a small club. We're building our reputation and building our brand at the top level. So we go with that risk every season. I think from our point of view, we're very keen to finish the season. We always have been. We're very much looking forward to playing again in about 7 days' time.
How do you think the fans have taken this, Paul, and how do you think their loyalty has evolved?
Well, I think like all football fans, sports fans the world over, that the most enjoyable part of the experience is obviously being in the stadium. Obviously, TV viewers are very, very important to all of our sports at the top level, but having that great atmosphere in the stadium is what makes the TV production as well. So I think fans are disappointed they won't be able to come into the stadiums for the remainder of our 9 games this season, but I think they certainly understand that this has been a very difficult and very unusual situation that we've all been facing for the past 3 months.
Do you think it's going to make a difference that a lot of these games are going to be shown free to air? That hasn't been the case, of course, for a lot of the Premier League in recent years. Is there an opportunity in that somewhere?
I think so, because I think we give an opportunity to generate opportunities for new fans to come and watch our sport. I mean, we have a huge domination of live sport in this country. Football is our number one sport, it's our national sport. But there's still a lot of people that perhaps might get turned on to football over the next two months or so as they see games that they might not otherwise be able to see. We're looking forward to just getting back to playing and giving our business a chance to recover. We've worked very hard on all of the safety aspects of returning to play. And now I think from the players, the coaches, all the way through to the executives, we're all just looking forward now to getting on with the season and hopefully playing out the next 9 games as safely as we can.
Can you quantify, Paul, the financial damage that's been done to your club, to the league, and what kind of recovery you expect?
Well, it certainly runs into hundreds of millions of pounds. For our club, I think, we were projecting to lose a significant amount of money this year. That loss will probably be increased by around 50%. And that's with all of the terrific work that the Premier League have done to try and protect our TV revenues as far as they can. But unfortunately, we've got 9 games to go. 5 of those for us were in our home stadium. We would look to generate around 7 figures in revenue from each of those home games. So that's a significant amount of money that we won't be able to recover from not having fans in the stadium, buying food and drink, buying merchandise, selling corporate hospitality, selling match sponsorships. All of those things will be lost for this season. And obviously, if we go into next season without fans in the stadium, those losses increase further. So we're very much hoping that we don't get a second wave of the virus, that we can slowly but surely start to bring fans back into the stadium next season and start to actually reduce those losses.
Yeah, I understand that for smaller clubs, perhaps in the Premier League, it is the attendance revenues that matter, as a percentage of revenues more, I suppose. So is it a real priority for you then to get fans back? And do you have any visibility as to when and how that might be possible?
Well, for the Premier League clubs, all of our income is largely dominated by the TV revenues. But fans in the stadium is important for a couple of reasons. First of all, the TV, the broadcasters want those stadiums to be full. The Premier League has got a wonderful record over the last 28 years of playing its games in front of full stadiums every week, every game, which generates a great atmosphere, which creates a great TV product, which of course then helps us sell that TV product around the world. So that's the first and most important reason for getting fans back in the stadium. But fans make the game, and that atmosphere and that sort of special attraction that we have for football in this country is not the same without the fans. And of course, when they do come to the stadium, they're also spending a lot of money on tickets, on hospitality, on merchandise, on food and drink, and all those sorts of things. So it is very important for lots of reasons for us to get fans back in the stadium. When that will happen, I think it's very, very much down to the government. We would like to see it happen as soon as it's possibly safe for it to do so, even if that means starting with a small number of fans in the stadium, socially distanced, so that we can manage that process. And then as we build confidence, bringing more fans back into the stadium over the course of the season. Ideally, we would like to start next season with some fans in the stadium, but we're going to be totally governed by what the government and what the Premier League say. And of course, most importantly, when it's safe and if it's safe for people to do that.
Paul, if I look through a bank of private equity news headlines on the Bloomberg, I see a lot about football in there. Blackstone's interested. CVC is looking at deals across Europe. Bain Capital is looking at Italian possibilities. Do you see a pickup in private equity interest? They've obviously got a ton of money, and a lot of these clubs are in financially difficult situations. Are the vultures circling, so to speak?
Well, I'm sure, as always, there's going to be people looking to take advantage of the difficult situation, and perhaps some clubs are going to be more vulnerable now or more open to that kind of investment than they might have been. football is the #1 sport in the world. It's always going to be attractive to investors, particularly in Europe, where the game is an obsession for most people in most countries. So I always think that our industry, even in these most difficult times, even in recessions, has been attractive to investors, and I don't see that changing anytime soon.
Paul, thanks very much. We'll see what difference it makes to the national mood, shall we, when football restarts. Paul Barber, Brighton and Hove Albion Football Club CEO, thank you very much for joining us. Coming up, Nike takes a knee. The company has made Juneteenth a paid holiday commemorating the end of slavery in the United States. We'll look at the corporate responses to race tensions in the United States next. This is Bloomberg. Welcome back to the European Market Open. It is Friday. We are 53 minutes into the session, flat for European equity markets. US futures still pointing to the upside after the heavy losses of yesterday on these stock markets. Let's get to another story now. Nike has told employees that June the 19th will become a paid holiday. The date, also known as Juneteenth, marks the end of slavery in the United States. It's the latest in a series of moves from big corporations to address racial injustice in the wake of the killing of George Floyd. Joining us now is our Quick Take reporter, Jennifer Zabasaja, and she's got the latest for us on the corporate response here. So what other kinds of corporate response have we seen, Jennifer, to the protests and the Black Lives Matter movement?
Yeah, I think corporations are really realizing they can't sit back and be silent when millions of people are protesting. Consumers want to see them actually make actionable change and actionable commitment to the Black community. And so, one designer I spoke with this week started an initiative where she's calling on big brands like Whole Foods and Target to pledge 15% of their purchasing power to Black-owned businesses. And her first business that she signed with is Sephora, of course, owned by LVMH. But she also wants to see more companies taking action. And it's not just retailers that are doing this. Netflix, HBO, they've taken their own action, pulling shows from their networks. And CrossFit, the CEO resigned earlier this week after a controversial tweet. And so companies, I think, are getting the hint that consumers want to see that they're committed to the moment that we're seeing right now.
Jen, there's been calls for police reform for a long time, now calls to defund the police. John Oliver dedicated his entire show to it last week, tonight. What's the story there? What are the ideas, and what kind of progress are you seeing?
Yeah, I mean, I think defund the police, this whole discussion is going to be something we're talking about well into November, the November election. But it's important to remember that activists don't want police departments, for the most part, to go away. They really want funds to be redirected into the Black community to help these communities out. But as far as legislation goes, we're seeing some cities start to take action. Minneapolis, New York City, Houston, they banned chokeholds. And overnight, we saw Louisville actually ban no-knock warrants, which was something that we saw in the case of Breonna Taylor there. And on the federal level, we're seeing Republicans and Democrats put forward their own legislation as far as it goes with police reform. So it's something that we're going to be discussing, and I think something that the protesters are going to continue asking about as we move forward.
All right, Jennifer, thanks so much for joining us. Jennifer Zabasaja there, our quick take reporter, coming to us out of 731 Lex in New York. That's it for the European Open, but stay with Bloomberg Television. There is a lot going on today as equity indexes bounce back and forth. Was yesterday's big rout a blip, or was it something longer term? We have some great guests coming up today. I know Mohamed El-Arian is coming on a little bit later. I know we're going to hear from Ed Hyman a little bit later here on Bloomberg Television. So definitely want to stick with us on a day like today. If we're down here in Europe, it'll be the 5th consecutive day of losses for equity indexes. This is Bloomberg.
red. Wall Street has its worst day in months. The S&P plunges nearly 6%. Futures are higher this morning. Fears of a second wave. Houston weighs a new lockdown as the city says coronavirus cases are getting out of hand. Treasury Secretary Steve Mnuchin argues the U.S. can't shut the economy again. And free fall, the UK economy shrinks a record 20% in April, rounding out a difficult week for the Prime Minister amid mounting criticism over his handling of the crisis. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. The focus, of course, is on the markets. There was the rally that we talked about extensively, and now a bit of a correction. Certainly, it started in the U.S. If you look at U.S. futures for the moment, they're actually gaining, and if you look at European stocks, they're pretty much flat. Now, there are much more concerns which led to the sell-off about the second wave of infections, but also the prospect of a protracted economic recovery that seems to be easing. Treasuries and the dollar slipping. And then the other thing that I wanted to show you, because there's UK-EU negotiations on Brexit, but also because we had that pretty incredible figure, the UK economy shrinking a record 20.4% in April as businesses and workers reeled under the lockdown designed to control the coronavirus pandemic. You can see pound 126.25. So we'll have extra data checks throughout the hour, but now let's get straight to the Bloomberg First Word News. Here's Danny Berger. Hi, Danny.
Hi, Francine. The global economy is recovering more slowly than expected and will bear lingering scars from the coronavirus pandemic. That's according to the International Monetary Fund. The IMF is set to release its latest growth projections on June 24th, and they're likely to be worse than the 3% contraction it predicted back in April. The UK economy shrank a record 20% in April. That's as businesses reeled under the coronavirus lockdown. The contraction follows a nearly 6% drop in March. The figures come in a difficult week for the Prime Minister. He is under pressure to reopen the economy more quickly while facing criticism for his handling of the crisis. Houston may be approaching the precipice of disaster. That's according to a senior local official. The city is close to reimposing stay-at-home orders as the number of virus cases spreads. The warnings highlight the danger of a second wave of infections beyond the initial hotspots. The virus has so far killed more than 113,000 Americans. And even if there's that second wave, the U.S. can't shut down again. That's according to Treasury Secretary Steve Mnuchin. Speaking on CNBC, he said shuttering again could cause more damage, but also he says it won't be necessary. Testing and contact tracing are improving, and officials have a better understanding of how to contain an outbreak. Global news 24 hours a day on air and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Danny Berger. This is Bloomberg. Francine.
Thank you so much, Danny. Now, U.S. stocks seeing their worst sell-off since March in yesterday's session, with almost $2 trillion erased from equities. So what drove the sharp switch in sentiment?
Today was a classic risk-off day.
We shouldn't be surprised by a reprieve after a parabolic rise.
The fact that we're seeing ebbs and flows shouldn't come as a surprise.
Today, we got some statistics on infection rates in the United States that caused real concern.
The conversation has shifted from this economic reopening to, is there a second wave?
And on top of what we heard from Jay Powell yesterday, really changed the mood.
And it's also obviously attributable to sobering comments out of the Fed.
Chair Powell put a dose of cold water on what has been happening.
I don't think that this can be blamed on the Fed. I think more likely we got really lulled into complacency on the virus.
It could, in fact, be a healthy thing that the market either marks time sideways or drifts a little bit lower.
I don't think it's that surprising that we're taking a step back, and I wouldn't necessarily think that this is a sign of panic either.
This is the reckoning that, a lot of us were just sort of waiting for, and we waited a long time.
Well, joining us now for more on the economy is Michaela Marcussen, Chief Economist at Societe Generale. Michaela, thank you so much for joining us. When you look at, what we're left with after the great lockdown, how worried are you that it's going to take much longer than maybe previously expected for this recovery to take hold?
So I think when we look at the current situation, we can really think about the policy response that we have seen so far as being in two phases. The first phase has really been about shoring up the economy, ensuring liquidity, ensuring furloughed workers and people who have become unemployed are supported through various means. And now I think we're getting to that more critical point where we need to shift to policy stimulus to actually support the recovery phase. Now, we have seen a number of economies come out with those policy packages for the recovery phase. We saw some measures coming out, for example, of Germany. We've seen the initiatives here in Europe from the European Commission. And I think over the summer, we're going to see a lot more on the policy front. And that's really going to be critical to what happens coming into 2021 on the slope of the recovery. But I think most economists, including myself, expect this to be quite a slow recovery. We have to remember that many of the losses that we've incurred have basically been transformed into debt either on public balance sheets, debt on private balance sheets. And even though we are in a very low interest rate environment, we won't be able to expand that debt indefinitely. And that's really going to be the critical debate as we come into 2021.
Miguel, there's a number of institutions, including the OECD, that basically have, forecasts for the economy and then a worst case economy forecast in case there was a second lockdown. Is this just because, institutions are being very cautious, or is this because the second lockdown, given what we know about the rate of infections, is quite likely?
So I think it's very, very difficult to predict the health crisis. I'm an economist and certainly not a medical expert and don't pretend to be one. But I think what's quite interesting is we see that as we've learned from this experience, and we see that here in France, there's really a strategy today in terms of tracing and identifying, testing, and also in terms, as you know, here in France, for example, we're required to wear face masks in a number of public buildings, in a number of workplaces, and also on public transport. So there's clearly an effort to say that if we can change our behaviors, perhaps that can help to contain the virus. And then there's the second thing, which I think is very important to be focused on as well, is in terms of the health sector capacity. It'll be very important to see what happens in terms of medical progress over the coming months and quarters. It's not just about developing a vaccine, but it's, of course, about are some of these treatments that are now being explored sufficiently efficient that the consequences of catching coronavirus could become less severe. And I think those developments are going to be very important. And I would expect, at least what I'm reading from various medical news flows, is that over the coming months we'll have at least some better perspectives on how we can understand these treatments and the prospect potentially also for a vaccine coming into next year. And that, to my mind, is really the critical thing to watch. So if these new methodologies prove efficient, hope is that we can indeed avoid a second lockdown of the same severity as we saw the first time round. Nonetheless, I think it's important to keep in mind that if people are concerned about catching coronavirus, this has a very big impact on behaviors in terms of going and enjoying restaurants, going out to cinemas and theaters, traveling and tourism. So even if we don't have a second lockdown per se, if the concern on the virus re-intensifies, people's behaviors could simply respond accordingly. So that would give us a very slow recovery.
Thank you so much. Michaela Markussen there from Societe Generale stays with us. Now, coming up, a record plunge. The UK economy shrank just over 20% in April under the virus lockdown. We'll talk about the outlook as businesses start reopening. This is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg Business Flash. Here's Danny Berger. Hi, Danny.
Hi, Francine. Ryanair, EasyJet, and British Airways have launched legal action against the UK's quarantine rules. They previously threatened the move against rules which say that international arrivals have to isolate for 2 weeks. The airlines think it will further damage an already struggling travel industry. Yum Brands is suing Grubhub over the cancellation of a 5-year deal to deliver food from KFC and Taco Bell. Grubhub declared the deal invalid, citing Yum working with rival delivery platforms. Yum says the move will hurt customers who will end up paying more. The suit comes a day after Just Eat Takeaway agreed to buy Grubhub for $7.3 billion. Renault is expecting ferocious competition in electric cars. That warning from the automaker's chairman, Jean-Dominique Senard. There's a flood of Chinese models coming to the continent into a market that's increasingly crowded. It comes as Europe's manufacturers roll out more e-cars in the midst of a deep slump brought on by the coronavirus. And that's the Bloomberg Business Flash. Francine.
Thank you so much, Danny. Now, the UK economy shrank at just over 20% under the virus lockdown in April, more than analysts had expected. It follows a nearly 6% drop in March, wiping out almost 18 years of growth in just 2 months. Meanwhile, in Brexit news, the government is planning for temporary light border checks with the EU next year. The move will happen whether a trade deal is agreed or not. It's an attempt to soften the blow to businesses already struggling with the impact of coronavirus. Well, still with us, Michaela Markison from Societe Generale. Michaela, when you look at the UK, I mean, a 20% drop is actually, quite an extraordinary number. Is it an economy that can pick up quite quickly? Or because of, the kind of lockdown and it's had, it's much more up in the air what kind of economy we'll be left with in 2-3 years?
So I think if we look at the UK today, the severe drop in April was very much to be expected, given the extent of the lockdown. Critical now is, as we discussed earlier, the ability to avoid a second wave of coronavirus, and also the speed at which consumers feel comfortable and confident coming back to various activities. So that will really determine the near-term path. Looking further out, of course, it's the policy response that becomes absolutely critical. But also in the case of the UK, there's a looming issue of Brexit. Now, personally, I believe that Brexit will mark a headwind to the UK economy, and I've had a long-standing view that Brexit will take about half to a full point off trend potential growth of the UK economy. Now, in terms of the short-term implications of a harder Brexit, which is the concern at the moment, clearly the initiatives around the border could soften some of that blow. But I think the longer-term reality is that it is going to be a structural headwind for the UK economy, and with the economy also dealing, like everyone else, with the fallout of the coronavirus crisis, it does raise a number of concerns.
Michaela, when you look at actually your forecast, are they with a deal in terms of Brexit between the UK and the EU, or is this actually with a no-deal Brexit?
So what we've been factoring in is basically a view that there would be some kind of compromise, but we're not looking for, it was already quite clear that some of the better Brexit deals have already been excluded by the UK government and by the position taken. So we built into our forecast not the worst case deal, but some kind of sensible deal. But it's clearly not the same trading relationship that the UK previously enjoyed with Europe. So it's really the idea of a more difficult trading relationship moving forward in terms of the conditions around it. And I think also importantly, when we look to the medium term, there's that risk of drifting further apart.
Yeah, Michaela, when you look at central banks around the world, how much more will they have to do to make sure that there's not the specter of deflation taking hold?
So I think clearly the coronavirus shock is a deflationary shock by construct. But as we look further out, one of the things we probably need to be aware of is how different trading arrangements, how different tax arrangements, and how different social arrangements evolve. If we imagine that we're in a world that becomes more protectionist with higher tariffs, more reshoring of supply chains, potentially also carbon border taxes, there is actually a risk longer term that we could see some higher inflation, but not necessarily for the good reasons that we'd like inflation to be tracking higher. In view of the size of the deflationary shock, I'm not worried about inflation anytime in the near term, and I think central banks will continue to provide ample liquidity support. The key point to my mind is that central banks alone, and central banks tell us this, we had as well a very clear hint from Powell at the meeting last week. We've heard this from Lagarde as well. We've heard it from all the central bankers, basically. There needs to be more done on the policy front. And I think what's really critical is in terms of the fiscal policy response, we need short-term stimulus to lift demand. We need long-term focus on investment to lift structural growth. And here I'm talking about investment, of course, in digital, education, and green transitions.
Thank you so much for joining us today, Michaela Markussen, their chief economist at Societe Generale. Coming up, we talk about the IMF and world growth. This is Bloomberg. is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, as U.S. cities continues to protest police brutality, Democrats on Capitol Hill introduced a sweeping reform bill that could make it easier to prosecute and sue law enforcement officers. Well, House Speaker Nancy Pelosi spoke exclusively with Bloomberg.
It's so much stronger if we can work in a bipartisan way. So far, what we've seen from the Senate is weak, but nonetheless a recognition that there has to be some change. But I'll leave that up to the Karen Bass, our distinguished chair of the Congressional Black Caucus, as well as the chair of the Crime Subcommittee of the Judiciary Committee, working with Jerry Nadler, the chair of the full Judiciary Committee. I'll leave it up to them to have their interactions with the Republicans in the House as well as in the Senate, and hopefully with the White House. We do have an issue that relates to a qualified immunity doctrine that protects some police officers found to be engaged in misconduct from any, shall we say, exposure from families that are affected or lawsuits. So that is one area that has perhaps an area where we'll have some differences, but hopefully on the others we will not, and that we'll be able to find common ground. American people deserve that. American people expect it. American people are watching. We want to show them we've heard you, we see you, we've listened, we've learned how important this is to you, and we're going to do something about it. That's the question I was asked by George Floyd's brother yesterday when he came to testify before the Judiciary Committee in the Capitol. He said, I have one question for you. Will this become law? What makes you think so? What is different now? Well, different is the complete public awareness of the injustice of it all and the complete public outcry for change.
Any of us who've seen the video, not just of George Floyd, but also of other instances of police misconduct, know that there are some police we really have to correct. We have to get rid of them. We have to amend their behavior. At the same time, I'm sure you'd agree, the vast majority of police officers are doing a hard job and doing to the best of their ability. How difficult is it, on the one hand, to really police the police, but on the other hand, not be seen as really undermining them and being anti-police?
Well, I think that most of the police officers who are conducting themselves in a way that could be viewed publicly as responsible do not want to be painted with a brush of some bad apples that might be there in the mix. And so, again, policing the police is a responsibility that they have. But I also think that we have to recognize there's some racism that has to be addressed in our society as well as within our law enforcement community. And when we can rid ourselves of that, we'll go a long way to having justice in our policing.
Are the police unions a help or a hindrance in the reform of policing?
I've had a conversation with the president of one of the police unions, and they put out a very positive statement about our legislation. We didn't know what they might say, but it was very, shall we say, open to what we were proposing, ready to have the discussions. And again, as you say, overwhelmingly, police officers are there to protect us. I think they see their role as guardians, not warriors. And we just have to hope for the best in that regard and invite them to the table so they can be part of the discussion. Some places it's different. Some places, some of the union officials have been very, shall we say, more protected than they need to be of bad conduct. But we have to make those distinctions.
Well, that was Nancy Pelosi, Speaker of the U.S. House, of course, of Representatives, speaking to our David Weston. Coming up, Nike steps up. The company has made Juneteenth, the day marking the end of slavery in the U.S., a paid day off for its employees. We'll look at the corporate responses to the protests. That's coming up shortly. This is Bloomberg. Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Danny Berger. Hi, Danny.
Hi, Francine. The global economy is recovering more slowly than expected and will bear lingering scars from the coronavirus pandemic. That's according to the International Monetary Fund. The IMF is set to release its latest growth projections on June 24th, and they're likely to be worse than the 3% contraction it predicted back in April. Houston may be approaching the precipice of disaster. That's according to a senior local official. The city is close to reimposing stay-at-home orders as the number of virus cases spreads. The warnings highlight the danger of a second wave of infections beyond the initial hotspots. The virus has so far killed more than 113,000 Americans. The UK is planning to introduce soft border checks with the EU. Deal or no deal? The measure is temporary and an effort to avoid hitting businesses already suffering due to the pandemic. The new policy comes as Britain and the EU step up the pace of trade negotiations. Prime Minister Boris Johnson is set to hold a call with Commission President Ursula von der Leyen on Monday. West Texas crude is heading for the first weekly loss since late April. That's on fears a second wave of virus infections in the U.S. could derail a fragile recovery. Swelling stockpiles are also raising concerns about excessive supply. Markets shrugged off a pledge by OPEC and its allies to extend output cuts. Global news 24 hours a day on air and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Danny Berger. This is Bloomberg. Francine.
Thank you so much, Danny. Now, Nike has told employees that June 19th will become a paid holiday. The date, also known as Juneteenth, marks the end of slavery in the U.S. The chief executive, John Donahoe, said employees had reported a disconnect between Nike's outward posture on race and their internal experiences at the company. Well, it's the latest move from corporations to speak out publicly about Black Lives Matter, a hashtag that grew into a movement. Now, it has become resurgent on the streets following deaths of African Americans at the hands of police. It all began in 2013. That's when a neighborhood watch volunteer in Florida shot and killed Trayvon Martin. Well, the shooter was acquitted. An activist in California wrote a Facebook post that ended with, quote, "Our lives matter. Our friend turned it into the hashtag Black Lives Matter." Well, the term took off the next year. Smartphone images of the deaths of Michael Brown and Eric Garner at the hands of police galvanized the movement. Protests in Ferguson and New York were followed by demonstrations in other cities. Black Lives Matter has no formal agenda. Protesters just want to reduce police brutality. Well, joining us now is our Quick Take reporter, Jennifer Sabajaya. Thank you, Jennifer, for joining us. I know you've done some great work on Quick Take, on actually what the movement is. What kind of corporate response to the protests and Black Lives Matter movement have we actually seen?
Yeah, Francine, I think companies are really starting to realize that consumers don't just want to hear from them, they also want to see them take action to support the movement and to support the Black community. So I spoke with one designer who started an initiative for big companies like Whole Foods and Target and Nordstrom to support Black-owned brands. It's called the 15% Pledge, and she's calling on brands to pledge 15% of their shelf space to Black-owned brands. And so the first brand that she partnered with was Sephora, of course owned by LVMH, but she's calling on other brands to step up to the plate. But it's not just in retail where we're seeing companies taking action. We're also seeing it with media companies like Netflix and HBO. Amazon is also taking their own separate action. And fitness companies like CrossFit. Earlier this week, the CEO resigned after a controversial tweet. And so companies are starting to get the hint that consumers want to see and hear from them in order to really believe that they are behind this movement and this moment.
Jennifer, how quickly can some of these changes actually take hold? How much time will we have to wait? For example, I'm looking at the screen, Sephora saying that they will give 15% of this shelf space to, business owners that were severely unrepresented. How long do we have to wait for that to actually happen?
Yeah, I mean, the designer that I spoke with told me that she's already having conversations with Sephora, regular conversations, and they're hoping in the next few weeks, and it's not just a one-time thing, and I think that's important to remember. They're hoping for it to be a long-standing relationship where they're holding the company accountable for what it is that they're doing, making sure internally they're looking at the vendors who they're working with and supporting the Black community. And so, she's really committed to holding this company accountable and seeing these changes implemented at Sephora, and also hopefully seeing other companies like Shopbop and Whole Foods and Target, as I mentioned before, do the same and, look internally and start to address some of the issues that they maybe have within their companies.
Jennifer, what about policing in America and calls to defund the police?
Yeah, I mean, defunding the police, this discussion is probably going to be something we're talking about well into November, the election. But, activists want to see some change happen on this front. They want to see money reallocated into the communities and taken away from the police department. We've seen some reform happen in the past few days. Cities like New York City, Minneapolis, and Houston banned chokeholds. In Louisville, they banned no-knock warrants, which of course was the tragic case that happened with Breonna Taylor there. And on the federal level, we're seeing both Republicans and Democrats put forward their own police reform bills. And we're going to hear this going into November. We're going to hear President Trump asked about it and former Vice President Biden. So it's something we're definitely going to have to watch over the next few months.
Yeah, we certainly will. Thank you so much, Jennifer, for joining us this morning. Jennifer Zabazarja there, our Quick Take reporter in New York. Now, make sure you also catch our Bloomberg Quick Take news special, what George Floyd's killing highlighted about protests, policing, and racism in America. And you can catch that on YouTube, Facebook, Instagram, or Twitter. Now, coming up, U.S. futures point to stock gains following the worst slump since March in yesterday's session. We'll discuss the sell-off and the outlook for equities next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg Business Flash. Here's Danny Berger. Hi, Danny.
Hi, Francine. Hertz is asking a judge to let it take advantage of a surge in its stock by selling up to $1 billion of new shares. Bankrupt companies are typically wiped out, but Hertz has seen a 2-week rally. Investors, especially retail ones, are bidding up bankrupt travel companies on optimism the economy and the market are poised for a rebound. A hearing is scheduled today to consider the idea. Zoom says China asked it to deactivate the accounts of pro-democracy Chinese activists based in the U.S. The company shut down meetings to commemorate the military crackdown in Tiananmen Square. But going forward, it says it won't allow requests from Beijing to impact anyone outside mainland China. The secretive big data firm Palantir Technologies plans to file to go public in the coming weeks. Bloomberg has learned the company could start trading as early as the fall. The last time private investors valued Palantir was in 2015 when they said it was worth $20 billion. And that's the Bloomberg Business Flash. Francine.
Thank you so much, Danny. Now let's get back to our top story. Stocks seeing their worst sell-off since March in yesterday's session, with almost $2 trillion erased from equities. Futures higher this morning. Joining us now is John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. John, thank you so much for joining us. When you look at what's priced in right now, is a second wave or a second lockdown priced in, or is it just concerns about what's going on around the world?
Yeah, I think, look, let's look at what happened. We'd had a tremendous run-up in equity markets. I don't think it's any great surprise that you see markets taking a pause. There's not really any one single catalyst. I think there's a few things that have come together here. I think first and foremost, there's been that question mark over whether we're getting evidence of a pickup in cases in some states in the US and what that might mean. But also remember, we had the Fed earlier this week. And while the Fed came in overwhelmingly dovish in many regards, I think that their outlook is reflecting an economy which is going to be in recession this year and only really beginning to come out when we see the year-on-year data through next year. And so what that suggests is that, you know, the outlook that the Fed are taking, although it's dovish, it's against a weak economic backdrop. I would argue here and now that what we're seeing is markets really just taking a bit of a pause after a very strong run. But technically within the markets, the level of participation, the degree to which investors had been still have a lot of cash on their balance sheets, etc., suggests to me that this is a pause rather than necessarily a full-on reversal of trend.
So what are you expecting markets? I know it's very difficult to actually see some of market movements. This is our question actually on our Markets Live blog. Is this a rout, a blip, or a sign of more to come? Are we going to see an extra correction, John?
Well, typically, I mean, a move of this magnitude in the S&P 500 is not that common. And typically what you see when you get a sharp move, rather as we're seeing in the futures this morning, is that they will point to something of a rebound thereafter. Now, over the short run, has the market hit a point where maybe it's, you know, needs a little bit more of a catalyst? That's certainly arguable. But in terms of the underlying fundamentals, let's look at the pros and the cons. On the pros column, what you have is massive financial stimulus, and the Fed added to that this week. There may be a bit of travel and arrive in what the Fed did here. We were waiting for them to deliver. They did deliver. They've left themselves some optionality as well over yield curve control or possible twist operations in the future. But let's be clear, rates are going to be at zero in the US for the next 3 years. And that means very, very supportive, accommodative financial conditions. High frequency data are bottoming and are picking up, and we'd expect that to continue over the near term. And then, of course, what we're seeing also is evidence from places like China, from Asia, that there is pent-up demand. And as the economies begin to unlock, what we will see is something of a pickup in terms of consumer behavior. On the negative column, of course, still concern over, you know, devastating unemployment levels, which will take some time to come down. And of course, that uncertainty over second wave of the virus. And I think the markets are calibrating for that here and now. But I would argue right now, coming up to earnings season, and let's not forget, we've got a ton of catalysts coming up in July. We would expect to see some evidence of companies beginning to look forward and perhaps something, you know, reflecting the bottoming in the higher frequency data, such as purchasing manager indices, etc.
But John, when you look at, so interest rates near zero for the next 3 years is what you're expecting in the U.S. Will they be able to stave off deflationary pressures?
Well, I think one thing that we've got to remember that is going to characterize this cycle compared with the last one. In the last cycle, we saw fiscal and monetary stimulus operating in opposing directions. And as a result, what you saw was something of a crimping of demand and, obviously austerity measures running through time. Governments are 180 degrees opposite to that this time around. There's been massive fiscal stimulus. In the fullness of time, that demand stimulus is likely to mean some level of rebasing of inflation. And, let's look at what the Fed came out with on Wednesday. 0.8 expected PCE, the CPE, consumer price expectations over the course of this year, but rising to 1.5 next year, 1.7 the year after. The Fed themselves expect that this combination of monetary and fiscal will see us through the disinflationary impact of the recession. But what that also tells us with rates at zero is that the real interest rate will be profoundly negative for some time to come. And I think that's something which markets will eventually have to reflect upon. So interest rates and inflation, I think, interest rates level, but inflation will gradually pick up as we emerge from this contraction phase.
So, John, where do you see the most value in the markets right now?
Well, I think one of the things that we have to recognize if we look at markets is that if we believe that we are seeing a rebasing and a rebound in terms of activity, notwithstanding the shocking data we saw for April for the UK GDP, remember markets price off the future. It's now June and we're looking forward to where PMIs take us, where retail sales take us, where earnings take us. And we would expect if we are going to be entering a recovery in the latter half of this year and into 2021, we would expect to see some of the more cyclical markets respond. Dollar has been weakening for most of the past few weeks. We saw a blip yesterday, of course, but we expect that trend to persist. That would favor places like emerging markets. Europe, of course, remember, what the ECB has done in the past few weeks, together with the Commission, is a significant step forward. This is probably the most comprehensive level of policy support we've seen going back to the financial crisis. And this is a significant underpinning, we would argue, for risk assets in Europe, which also have a cyclical tilt towards them. So those cyclical markets having the potential to play catch-up to core US equity markets, which continue to perform relatively well, notwithstanding yesterday's correction, we would argue is the place to begin to look as the economy starts to look forward and price off the next 6, 12, 18 months, which is a period when we expect to see the economy begin to recover.
John, thank you so much. John Bilton there from JP Morgan Asset Management. He stays with us. Now, coming up, significantly scarred, the IMF warns a global economy is recovering more slowly than expected as growth projections face fresh downgrades. We'll discuss that shortly. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the IMF says the global economy is recovering more slowly than expected from the coronavirus pandemic. Its chief economist, Geeta Gopinath, said that it will bear lingering scars from the experience.
Given the depth of this crisis, given the need for reallocation of labor across sectors, because some sectors like tourism, transportation are going to be hit in a big way, given this margin for bankruptcies and insolvency issues coming up, and prospects of changes in consumer behavior, one has to be quite concerned about the path of recovery, and many of these variables point to significant scarring effects.
Well, still with us, John Bilton from JP Morgan Asset Management. John, when you look at areas across the world, so it's the US, let's say Europe, some of the emerging economies, South America, Africa, and Asia, where do you see the most value?
Well, I think what we've got to look at is the early part of any recovery tends to lift every economy as it sort of washes through. We've got a natural cadence to this taking place. We were led by Asia, who were the first in and first out of the pandemic. Europe, of course, now putting in some fairly strong showing as we're seeing some good news emerge, and we'd expect that to continue to play through. The US, of course, I think the questions over the second wave, the questions over whether the US equity market can continue to be led by quality growth style companies, particularly technology, is always going to be there. But bear in mind, with the US as 50% of world market cap, it'd be unusual for the US not to at least offer some upside. But so where's the value here? Well, again, look, I think seeing where there are economies on a solid path to recovery and where we've seen new information in terms of policy support and where there's room to continue to do that, that's where I think value will come through. Let's be very clear. The nature of any contraction sets the path for what the subsequent recovery looks like. And the recovery over the next expansion phase, which may last several years, is going to be one where we have to absorb and think about fiscal partnership with monetary. The fact that Europe has begun to move in that direction with the Commission, with the ECB, I think suggests that what's been a very lengthy period of European underperformance may have scope to begin to reverse. Equally, as dollar weakens, as we come through into a recovery phase, emerging markets and cyclical economies tend to get something of a boost. So by and large, that's where we'd look. But don't forget the final adage. Don't fight the Fed. Always think about where we have central bank support. So there are elements of the credit market which are likely to be continued to be supported. And that thinking is going to help to build a balanced portfolio.
John, do you worry about, when some of this unwinding will happen, or is it such a long way off that actually we shouldn't even talk about it right now?
Well, I think it's something that we will have to think about as we characterize what the long term looks like. And of course, we do publish regularly, 10, 15-year numbers in our long-term capital market assumptions framework. And we have to think about what policymakers will be doing. We now know that the path of rates will be much flatter coming out of this recession than it might have been historically standard to expect. And that's something we've been told by the Fed. But we equally know that government spending, fiscal dollars, are going to be a much bigger part going forward. And I think the big question as we come out of this phase, and it's probably too early to say who the winners and losers might be, will be how those fiscal dollars and the fiscal euros and fiscal yen get put to work. Where they're invested into adding future economic gains, whether it be through technology, greening of the economy, etc., then potentially it can have a positive multiplier on the economy. And it's very important that we hold to account and look for where those fiscal dollars are well spent. Because if they're invested and dealt with appropriately, then the question over managing the debt load associated with them becomes less of a factor than if they are simply spent on propping up the economy in the short run. I'm relatively optimistic that we have that ability, and certainly seeing fiscal and monetary policy operating in tandem is one of the things which I think myself, as a relatively optimistic commentator here on markets, would point to as being something which will continue to help see risk assets perform over the intermediate term.
But John, is there a concern that in certain European countries, because the central banks, because the ECB is there actually and doing quite a lot, that some of the much needed structural reform won't come into play because the markets maybe aren't fulfilling their role of keeping, the countries in check?
Well, there's always moral hazard associated with any official intervention. And that's something that we learn. But at the same time, I think that we have checks and balances in place. And one of the things that the Commission and the European Union generally has done through time is look for how to impose and actually check up on those moral hazards. But let's actually look at history. Let's look at the facts. There were attempts at structural reforms in a number of countries. And we have seen some movement towards them, but there's a certain pace which is actually palatable for the population at large. And, there is limited appetite, I think, from a political standpoint for austerity, for, trimming back of budgets at a time when we've had an exogenous shock. This is not an economic issue in its heart. This is a public health issue. Governments rightly responded to it by looking at ways to support the economies more broadly. And I think that that's something that's widely recognized. So treating this with the same lens that we might treat an economically born crisis, I think would be wide of the mark. But it's very clear that as we go forward, as the ECB and the European Commission respond, effectively as first respondents to the economy, once we've gone past the triage stage, we will need to look at how do we manage that moral hazard. And I would feel relatively comfortable that the ECB and the Commission have those kind of tools in place.
John, thank you so much. John Bilton there, head of global multi-asset strategy at JP Morgan Asset Management. Now, we'll have plenty more on the markets. This is what I'm looking at across the board. European stocks actually pretty much flat. Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Seeing red, Wall Street has its worst day in months. The S&P plunges nearly 6%. Futures are higher this morning. Fears of a second wave. Houston weighs a new lockdown as the city says coronavirus cases are getting out of hand. Treasury Secretary Steve Mnuchin argues the U.S. cannot shut the economy again. And free fall, the UK economy shrinks a record 20% in April, rounding out a difficult week for the Prime Minister amid mounting criticism over his handling of COVID. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, I look at the markets, and actually a lot of the focus is definitely on the markets and what we saw in the last couple of days.
Oh, no question about that, Francine. I, go with Kit Jukes. I did the same thing Mr. Jukes did in his morning note. I did a Fibonacci analysis of what we saw yesterday. That's too much mathematics for Friday, but all you need to know is it was ugly, and we have a very nice bounce today. From the worst VIX of 42 yesterday afternoon, we've come in very nicely to a VIX of 36. So there's certainly a better tone to the market today.
It certainly is. Now let's get straight to the Bloomberg First One News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, there's never been a month as bad as April for the British economy. The UK says GDP fell more than 20% as the coronavirus lockdown took hold. On a 3-month basis, economic output shrank more than 10%. The contraction will prompt louder calls for the British government to ease restrictions on industries trying to survive. The IMF says the global economy is recovering more slowly than expected from the coronavirus, and the fund expects it will have lingering scars from the experience. The IMF will release economic growth projections June 24th. It expects them to be worse than the last forecasts that were delivered in April. The IMF says that in general, Asian economies are further along in the recovery path. President Trump is rejecting calls to overhaul law enforcement or cut police funding. He says a strong economy will be the fix for racial injustice. The president is working on an executive order that he says asks police to meet the most current standards for the use of force, but there are few details on what that program would look like. And North Korea accuses the U.S. of breaking promises it made at that historic summit 2 years ago. Kim Jong-un's regime says the Trump administration has turned dreams for peace into a dark nightmare. The U.S. and North Korea agreed to work towards denuclearization of the Korean peninsula. President Trump demanded that Kim give up nuclear weapons before the U.S. eases up on sanctions. Global news 24 hours a day on air and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. I'm really going to focus on the stock market here with a risk-on feel. Mark Cudmore to join in a moment. Edward Hyman will join us later. Ben Laidler will join us in a few hours. He reaffirms his bullishness this morning. SPX up 51 points. Dow futures up 525 points. The VIX in 4 big figures. What you need to know is how far we were extended. It's amazing, technically, the lack of damage because we were so far extended to the upside. I'd also note, Francine, gold quiescent near 1740 the ounce. Francine?
Tom, what I'm looking at is basically European stocks rising with U.S. futures. They're not rising by a huge amount, but still gaining some 1%. There was a sell-off that we talked about extensively. Basically, this was on concern of a second wave of infections, but also, the prospect of a protracted economic recovery. And I think markets are now trying to make sense of the two. Treasuries and the dollar actually slipping. And then I also wanted to look at VIX, 36.83. So something we need to watch out for. And then, Tom, we had that pretty bad figure out of the UK. The UK, actually, the economy retreating by 20% because of the lockdown. So I just wanted to see if there was any impact on a pound, and it's 126.36. Now let's get more on these markets with Mark Cudmore, Bloomberg MLive managing editor, who joins us from Singapore. Mark, what exactly is pricing is being priced in? What was the correction about? Was it a blip, or is it something more fundamental?
I think it depends, I guess, on your time span. I think it's a blip in terms of that we're probably not going right back to the lows, but it's a blip that's not over yet. And what I mean by that is that we had a few events that we were kind of really focused on this week. Obviously, the FOMC was the big one. And I think amazingly, the FOMC didn't disappoint, but didn't surprise positively. And I think it was going to be easier for them to disappoint, given that the whole rally has been driven by stimulus. Unfortunately, once FOMC was out of the way, that brought the attention very much back to the virus story, and that is looking increasingly negative. Now, something we've been highlighting is that infections globally picked up quite aggressively from mid-May, which would feed through to the fatality numbers picking up from June 10th was our predicted date. And in fact, it was actually from Monday 8th we started seeing the global fatality numbers pick up. Now we're going to get back into this idea of, is there potential for a U.S. state to kind of re-lock down again? I think we're definitely going to get into the idea that travel restrictions globally are going to come back down. And I think the problem in South Asia is perhaps going to take the limelight from LATAM. So I think what's happening at the moment is we're getting increased virus concerns, and I think we're going to price out some of the excess exuberance of recent weeks. But there's one really important overriding thing to remember here. U.S. stocks saw an incredible rally. U.S. stocks are immensely overvalued. But many other stock markets around the world are still massively discounted and offer an incredibly great value proposition for many investors, even at this level. So I think that whether you're bullish or bearish depends whether you're very U.S.-centric or whether you've got a global macro perspective.
If there is a second lockdown, where do you see it first, Mark? I know we're not health experts, but we look at the markets. But much more do market participants now need to become health experts?
I think that everyone's having to attempt to kind of have some grasp of roughly the trends that are there. I think, rather than being where does the lockdown come next, I think obviously it's which lockdowns really matter and what kind of form they'll take. The overriding bit is that part of the reason I don't think that equities will go back to the lows is that I think countries are becoming more comfortable with the idea of becoming a bit like a Sweden. And what I mean by that is that keeping the economy open to some extent while controlling the virus problem and feeling that they've got a better idea of testing, they've got a better idea of tracing it. So I don't think we're going to go back to a world of extreme lockdowns like we were in March, no matter how bad the virus is. I think there's just a different approach being taken now. And I think when you take that picture that we're going to do a little bit more muddle through in the economy, less focus on the extreme health measures, and you combine that with the massive amount of stimulus we've got from policymakers around the world, I think that's why equities won't go near their lows again. They still have more downside into next week as we trade this negative narrative, but ultimately this dip will be bought because there's just too much liquidity trying to chase that market. I think that dip will be definitely more painful than we've seen already so far, though.
It's fascinating, and folks, I really want to emphasize a number of bulls reaffirming their bullish outlook this morning. Mark, I know you're not in the business of buy, hold, sell, but I've got to ask you on a calendar basis in June, this is a gift to the institutional money that didn't buy this bull market. They get a second chance this morning. How dippy is the buy the dip crowd this morning? How urgent is it to get back on board if you missed the up before?
I think that's a great question. It's a key question. It's something we've been talking about since yesterday. Just jokingly, we said we'll probably get a move below the 3,000, a move below the 200-day moving average. You get the bears excited, and that's when the institutional investors will get excited. That dip below 3,000, then they'll buy. Now, we saw that in the short term, but I actually think we'll get a further dip. And I think what's happened is the dynamics is that the last week or so, from particularly after Friday's jobs number into the start of this week, was about the final capitulation of bears. It was like the forced buying of those who were short and just had to cover their positions because they're losing too much money. I think we've now finished the forced buying, and that's why we've been able to have this pullback. It's now about when are those people who are underinvested going to buy in. They keep on getting more cash. So I think that their dip level they're looking for is a lot lower, but it continues to climb all the time as they continue to accumulate more cash into their coffers.
Let me switch to Standard & Poor's 500, folks, at about 3,000, 3,100. Two standard deviations on trend is 2,800. And Mark, what you're suggesting is we can go down and test the bottom of that trading range in a healthy way, not in a panic way, correct?
I think that's 100% correct. I think that's the point, is that bulls don't actually mind a little bit of a pullback here. And again, I'd reiterate, that if we do see that pullback to 2,800, and I think that's very feasible, and I don't think it'll scare any of the bulls at all. Remember, there are many bulls that were happy to buy for about 8 days in a row in March below 2,400. So buying on a 2,700 handle is not necessarily going to be that scary for them, like the world is falling apart and everything is collapsing. So I don't think there'll be any panic at all. But I think what's more important is when we get back to that level, the real opportunities in the world will still be outside the U.S. The U.S. equity market won't be a bargain at that level. It just will no longer be so expensive.
Mark Cudmore, thank you so much for getting me started this morning after the market debacle yesterday. Mr. Cudmore, looking at the markets for Bloomberg from Singapore. We're going to do a lot more on the markets all the way through Bloomberg surveillance this morning. Again, Ed Hyman and Ben Laidler scheduled to be with us. We're thrilled by that. Coming up, Christian Keller of Barclays. Really, really important after those UK monthly GDP statistics. Christian Keller on a negative 20% GDP possible for Europe. Please stay with us. This is Bloomberg. Good morning.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, brace for impact. The UK economy shrank just over 20% in April under the virus lockdown. Now, the contraction wiped out almost 18 years of growth, returning the economy to the same size it was in 2002. Although a recovery is likely as businesses start to reopen, the figures also show the scale of the challenge facing policymakers. Well, joining us now is Christian Keller, Barclays head of economics research. Christian, first, it could be the UK, it could be applied to a number of countries, the US, but also European countries. What kind of recovery are we going to see? There's now a specter of a second lockdown, certainly a resurgence of infections. What does that do to economic forecasts?
Well, I think you said something that's at the beginning that's quite important. Would a second wave actually lead to a second set of lockdowns? Because, ultimately what really, brought activity down is the lockdown. And it is justified by possibly by a second wave. But I'm not sure whether, the reaction by governments to a second wave would be as it was to the first wave. Look, right now, if you think about, recent data actually made us relatively optimistic that we would have I don't want to use the word V because immediately people are going to jump, but we were thinking of a relatively swift recovery. Got some good data out of China. Europe is recovering. UK data today was poor, but that was expected. U.S. labor market data was better. So we did actually believe in a relatively swift recovery, call it a V in growth rates, not a V in terms of getting back to GDP levels soon where we were in 2019. Now, I do think that if we really have a second wave and we have to react to it in terms of shutting down activity again, that definitely would be then in question.
But Christian, when you look at economic forecasts, and we saw it from, in part the IMF and part the OECD, there's now two sets of forecasts. It's, one is what we're seeing now, and the second one, if there's a second lockdown. Is this because we're being overly cautious, or because the nature of the infection and the nature of COVID-19 makes it likely?
Well, we looked a lot at history, and you look at the back all the way to the Spanish flu. There often have been second waves. Again, it depends how governments would react. You have now a better preparedness also by the hospitals. So it's not clear to me that even if there was a second wave of infections, it would necessarily lead to the same stringent lockdown measures that we have seen in the past few months. But it's clear that institutions like the IMF, the OECD, they have to prepare and make two different forecasts where the scenario where you have another wave of lockdowns in a way is included. And obviously those scenarios look much worse than the baseline, which doesn't foresee such a second wave, or at least not a second wave of mandated economic activity.
Christian Keller, we're getting in monthly GDP data from the United Kingdom. We will get in quarterly data from other countries, including America. Are these grim statistics enough to shift the fiscal debate?
Well, to be frank, to a large extent, I think the fiscal debate has already shifted significantly. Being German myself and having seen what has been coming out of Germany, for example, in recent weeks, the kind of, you want to call it very Keynesian packages of, cutting VAT, of, providing more money to people who are likely to spend it. That is just one instance of a country that is, rather known for fiscal conservatism. If you think what has happened already in the UK and also in the US, there's a lot of fiscal largesse going on, a lot of spending, without necessarily thinking about the moral hazard implications, the long-term impacts. So I think the political debate around fiscal policy has already shifted significantly in the past few months.
Mm-hmm. Does disinflation and deflation follow these grim UK statistics? Can you bring it right over, whether V-shaped or not, to just a complete dampening of inflation?
Look, inflation is a number, is something a lot of people wonder about, because on growth, we're trying to get a hang of it. At least we know the mechanics. I think on inflation, the debate is what would happen, not in the next few months or quarters. I think that's quite clear. The demand impact is so large that it's really unlikely that you will see any surprises, suddenly inflation flaring back up. But it's a medium-term question for, 2-3 years from now, where we could see a situation whereby we have a lot of monetary stimulus in particular, a lot of fiscal stimulus also, possibly, if there's no second wave, a swift rebound. And in the background, we may have been something going on the supply side where, if we have some deglobalization, if we do what a lot of people believe, shift supply chains away maybe from the cheapest producers in China, etc., could we be in a situation where we create supply bottlenecks, or at least more expensive supply, and at the same time having really ramped up our demand, and then could finally get into a situation where we see proper inflation coming back up? I think that is an open question. For the short term, I think all the indications are that inflation will stay low. That's why I think central banks are so comfortable to tell us that they essentially do nothing until 2023.
Christian, when you look at economies or regional economies, across the world, where do you see the biggest concern? These were economies that first, some of the packages done by governments, but also some of the monetary policies have been different. For example, the US or Europe or the UK, but we were at different places in the economic cycle ahead of the lockdown.
Well, if I really take a very broad view, I would first have to say, I look at infection curves and the economic response. Some of the emerging markets are of a concern, excluding China. If I look at India, at Brazil, at some of the, these large economies where the virus is still increasing and, they don't have the room and the space for the kind of monetary and in particular fiscal policy response that we saw in advanced economies. So that's one concern. And, of course, also across a larger group of emerging markets, if we look at the debt dynamics and the lack of capital flows and what it would mean for sovereign defaults possibly going forward. If you bring it back now to closer to home, so to say here, if I look at Europe, I think we see the divergence clearly. I mentioned Germany earlier, a country that was able to muster a very robust response, and then we have countries in the periphery which apart from being hit very hard by the coronavirus, are now typically expecting the tourism season to bring them a lift to GDP, and that may not come. So, obviously we have the kind of the north-south divide, if you want to call it that way, of, countries
Right.
where Italy, Spain, I'm more concerned about. And I think this will require particular policy response by the EU, which we may be seeing through the recovery fund. Sorry, Tom.
Now, Christian Keller with us with Barclays, and we will continue. Lots to talk about here. Again, folks, if you're just joining us, just grim GDP numbers for 1 month in the United Kingdom. We're continuing to focus on the markets, and to do that, we need expert conversation. In our next hour, we're thrilled to bring you Edward Hyman of Evercore ISI. Please stay with us from London, from New York on this Friday. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg Business Flash. The biggest airlines in the UK are suing the British government. They're trying to overturn the new requirement that people arriving in Britain self-isolate for 2 weeks because of the coronavirus pandemic. British Airways, Ryanair and EasyJet say the quarantine will have a devastating effect on tourism and the wider economy. Hertz is asking a bankruptcy judge to let it take advantage of an odd rally in its stock. The car rental company wants to sell up to $1 billion of new shares. Stocks of bankrupt companies usually get wiped out, but shares of Hertz rallied nearly tenfold from May 26th to this past Monday. It's since fallen by more than half. Investors are betting that the travel industry is set to rebound. Zoom says China demanded it deactivate the accounts of pro-democracy Chinese activists based in the US. The company shut down video conferences to commemorate the Tiananmen Square protests, which Beijing called illegal. Zoom says from now on, it won't allow any requests from the Chinese government to impact anyone outside of mainland China. And that's the Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. This is what the markets are looking at. The markets definitely focused on the correction that we saw yesterday and deciding to focus on giving a little bit of a lift up to the market. So the focus is not only on a potential second lockdown because of rising infections, but what kind of recovery we'll see, Tom.
It will be interesting. We have a nice bounce this morning off of the carnage that we saw yesterday. We're giving you more perspective on this. Edward Hyman to join us here in a bit. Mohammed El Arian later this morning. Looking forward to that. Stay with us worldwide from London, from New York. This is Bloomberg.
Surprising. It's a surprise to me. It sounds like a horse riding, you know, and it's okay.
Excitement, a lot of excitement. Like the kids especially love the robots. It's a very new thing, I think, and it came at a right time, where social distancing is a safety measure right now, so they're robots, not people, you know, so it's like interacting with robots can help a lot at this time. I think it teaches people that technology can really have an impact on everyday life. So for example, these robots are in like a shopping center where I feel like everyone comes here, so it's incorporated into people's lifestyles and how it can make people's lives convenient and more productive, more effective.
Bloomberg surveillance. Good morning, everyone, from London, from New York. After the terrific market moves yesterday, really some careful study of them by all of global Wall Street. We've got some great conversations for you this morning. Just to give you one idea, Tom Purcelli at RBC Capital Markets really reaffirms his belief in some form of V-shaped recovery for the American economy. We wanted to take some time here outside of the market upset to talk about the great dialogue on deflation, disinflation, inflation, and the concept of reflation. We started that earlier this week with Olivier Blanchard, of course, of the Massachusetts Institute of Technology, and now at the Peterson Institute. And Professor Blanchard made very clear we need the courage to reflate. With us, Christian Keller of Barclays. Christian, within your study, is there an ability to reflate? Can economies, can politicians be successful at pulling us away from the abyss of deflation and disinflation?
Well, I would say, we call it the abyss of deflation. I think that already starts, right? We have situations, if you look at deflation a moment across history, where this deflation, may not always be as much of an abyss as you say. There have been relatively benign episodes where you have basically very low inflation, but you don't necessarily go into recessions or you have a depressed economy. Now, typically, if you're going from a crisis like Japan in the early 90s, and then as we do now, you plummet and then you go into a deflationary spiral where you depress investment, prices go down. I think this is the most dangerous part, not where you are long-term just having lower inflation rates. I would make that first point. Second, look, this is a process that has been going on for a long time. And you said, you had Blanchard, he probably talked about it. It's globalization. It has been a technology change, demographics. A lot of things played a role. Monetary policy as well that helped us to bring inflation down from high levels. From now on, look, in the immediate future, I think this is about reflating very clearly. And I think the policies that have been put in place were the right ones. I think it's correct not to be too afraid about fiscal loosening at the moment. We need to avoid deflation, which actually I believe we are successfully doing. Now, the question then about the longer term, I said it earlier, is about, how much are we potentially creating supply bottlenecks through rearranging our global economy structurally, global value chain, etc., that maybe then could create even more inflation, possibly more than we want to. But at the moment, I think it's about reflating. And I think actually we are relatively successful, at least avoiding deflation at the moment.
Yeah. Christian, what we heard from Chairman Powell, in a dot plot, folks, it's flat. For 2 years, it looks like a hockey stick. And then there's this hope and a prayer of inflation out there, quote, longer term, unquote. I mean, basically, the central bank of the world has given it up. They're at the zero bound forever. Is that right?
Look, I think they're at least telling us that they're out of office until 23, so to say. And I believe that, it's very similar with the ECB. If you look at the forecast, the ECB, in spite of having I think 3.5% of growth or so in 23, still have a inflation of just 1.3 or so. So I think both central banks, are telling us that they fear that the risks of not getting inflation back up are high. They see the high uncertainty. They know from the past crisis that all their models have not worked. They've been very poor in actually forecasting inflation. And so they're taking a cautionary approach. And the caution is to forecast that inflation is going to stay low and do everything to avoid that it will go lower and to do everything that it comes back up. I believe, these 3-year forecasts, uncertainty is really, really high around them. But they're giving us a message from the policy side that, they're going to continue to do everything to reflate by giving us forecasts that tell us there'll be no inflation in 2 years from now.
Christian, when you look at, all of what central banks have been doing, I mean, it's amazing to think that only, 5 months ago we said that they'd reached the limit of what they could do next. How impossible is it going to be to unwind all of this, extra stimulus that they've put out there?
First of all, I think you're very right. We thought, 2008-9 was bring us all the unorthodoxy that we could see. We now have learned that you could take it a step further by not only doing more QE, but also by blurring the lines between what is fiscal and what is monetary policy. I think this is what we are seeing. Central banks are more or less encouraging fiscal policy makers to spend and tell them, look, don't worry, we're going to load it on our balance sheet. That, of course, raises a question on how to unwind it. Now, in these baseline scenarios where you don't get inflation, you can keep interest rates low. And again, I'm sure Professor Blanchard talked about it. You can manage with much higher debt burdens. So the whole question about how quickly to unwind it doesn't pose itself with the same, with the same pressure than it did in the past. Because if you have low interest rates, you can suddenly deal not with 90, but maybe with 120% debt to GDP, depending on the country. So the big question really arises is, could there be a point where central banks actually are successful in reflating and then have to actually, respond to inflation while the debt burden is still very high? But I think everyone tells themselves right now, look, this is several years away, and my more imminent problem is actually to try to reflate, and therefore that question is in a way on the back burner, if you want. The more the inflation possibly comes back, the bigger the question then how to deal with a high debt.
Christian, we're also getting a viewer question. So if you are a viewer and you want to send questions in through the Bloomberg terminal, please do so by going on to TV Go. This person is writing in and says, why does Christian think we're all so obsessed with targeting inflation between 1% and 2%?
Why we are so obsessed about it? Okay, look, there's a lot of debate about how the 2% inflation target came about, and it was one that set in the early 90s, and then everyone in a way followed. I think there is a certain, central banks are following each other, and it has also to do with, differentials. You don't want too much inflation differential to another central bank if you're an advanced economy. But I think, look, the answer is clear. We do not want deflation, as Tom said earlier. And the closer you are to zero, the more likely you're, to slip into deflation. Now, given that you have a lower bound, that you cannot move interest rates into negative territory, of course, we've already broken that, but, no one believes that you can move very, very low into negative territory. You want to have a cushion. And therefore, you want to have positive inflation so that you don't get into a situation where, inflation is zero, you cannot move very into negative interest rates, and your ability to move the real interest rate lower is curtailed. This is why central banks have been so obsessed about, having an inflation that is above 2%. And now we have, of course, some people arguing again, Professor Blanchard was proposing this years ago, whether we should actually move to 4% to have a bigger cushion. I think that question is, it is not irrelevant now because we can make it there. But I do have some sympathy for people who believe that, maybe it is, whether we have 1.5 or 2, there is, of course, a question at some point, how much, financial risk I'm willing to take just to move that last 50 basis points or 100 basis points to reach 2 if I'm comfortably at 1.5. I think that is a debate that is worth having.
Christian, thank you so much. Christian Keller there, Barclays Head of Economics Research. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Tom, the city of Houston warns that the coronavirus has it on, quote, the precipice of a disaster. Officials are getting close to reimposing stay-at-home orders. Earlier this week, Texas recorded its highest one-day tally of new cases since the pandemic emerged. The state has been among those pushing hardest to ease lockdowns imposed during the first wave of the disease. The Republican Party is moving key parts of its August nominating convention to Jacksonville, Florida. The event has been scheduled for Charlotte, North Carolina, but the state's governor had refused a request by President Trump. The president warned the governor to lift all coronavirus social distancing measures, such as mandatory face masks. The UK plans to have a light-touch customs regime at its border with the European Union next year. That's Even if there's a no-deal Brexit, British authorities are trying to avoid adding burdens to businesses already struggling with the impact of the coronavirus. The new border policy emerged after the UK and the EU agreed to step up the pace of their trade talks. Global news, 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Greatly appreciated. Again, a wide series of guests coming up on the markets, the links to the economy. Dr. Alarian will join us. Ed Hyman will be with us in a bit. Later on, the Lieutenant Governor of New York, a touch of experience in managing this pandemic. Kathy Hochul will join us on our simulcast. This is Bloomberg.
I'm a big environmentalist. I believe strongly in taking care of our environment.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, fears are spreading about a second wave of coronavirus infections in the U.S. This comes as cases surge in Texas and California. Meanwhile, the UK economy contracted 20% under the lockdown in April. Well, joining us now is our Bloomberg Health editor. He is John Lauerman. John, what do we understand about how COVID-19 is actually working? What are the chances that we have a huge resurgence of infections, of people going to hospital, and therefore the increasing need of a second lockdown?
So what we're seeing so far, I think, in the U.S. is pockets of resurgence, not really a nationwide resurgence. Obviously, areas like New York, still the virus continues to contract. But these areas where you are seeing higher cases, I think what I've seen noted is Houston in particular, along with more hospitalizations in California and more cases in Arizona. And obviously what you're seeing there is that the virus is still out there. It continues to spread. It's a highly contagious virus. Nobody has immunity to it. So if you relax the measures that have contributed to the pandemic spreading not quite as quickly, when you start to relax those measures, it's going to start spreading again. And I think that's all we're seeing.
We should point out that John Lauerman, folks, we should point out, folks, that John Lauerman is most expert on this at Bloomberg. John, you know there's more beds in that 3-hospital district of Boston or the beds in New York City than all these other cities combined. Is the real impingement here for the experts that they will be short of hospital beds rapidly?
So that is the concern, Tom, in any place that that the virus is spreading. They have huge hospital resources in New York. Obviously, they have huge population as well. And of course, you know, the real area where we saw a problem in New York was in nursing homes, right? And so I'm wondering whether, you know, if there is a second wave, if these hospitals and nursing homes in particular, will have, you know, keep more people out, have more restrictions on traffic through those nursing homes. But if there is a second wave in any area, and these can be highly localized, obviously that's why Houston is talking about, you know, perhaps opening up their stadium again, because they can't send patients to other districts. Now, highly sick patients, people with a very contagious disease, into other areas to be treated. So if there is a second wave, even if it is localized to these particular areas, then it's a real concern for those cities and those areas.
John, how much do we know about how many people have had it? And if you have had it, even if you're not immune to it, is it likely that that it doesn't get worse the second time you've had it?
Yeah, that's a good question. So it looks as though people who have had it actually do get immunity. More and more research does seem to be confirming that people who have been exposed and who have actually had an infection are immune. We don't know for how long. We know that 2 million people roughly in the U.S. Have already been diagnosed with the disease. But what we don't know is how many people who haven't been diagnosed actually have the disease. There's data from other areas that's actually quite good. The U.S. is trying to get a handle on this now with broader testing, but still that's highly incomplete. So I don't think we have a really good understanding of how many people have had it and are immune.
Thank you so much, our John Lauerman there looking at COVID-19. Now, coming up in the next hour, Dr. Andrew Pekosh, Johns Hopkins University Bloomberg School of Public Health professor and virologist. That's at 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange rate.
China's slumping onshore bond market is great.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg Surveillance. Good morning, everyone. On a Friday from London in New York, we pick up the pieces off yesterday's market debacle. Ed Hyman will join us in the next hour. Mohammed El-Arian will join us later on this morning. A lot of other good conversation as well. Right now, and it's beneath the radar and beneath the equator, is the challenge of Brazil. Marcelo Cavallo is with us. Dr. Cavallo has been just absolutely outstanding over a distinguished career in studying the people of Brazil, the politics of Brazil, and how it simply links in to their very future. And right now, it is a future of crisis. Marcelo, thank you so much for joining us today. Dr. Cavallo, how fragile is the Bolsonaro government right now?
Listen, when I look at Brazil and I look at emerging markets for January, we have to be bearish on the economy, but we're quite positive on the emerging markets in terms of asset prices. Look at the impact of the crisis on emerging markets. Three key channels. It hurts the public health, it hurts the current account, it hurts capital flows. However, the global liquidity environment and the turn in the dollar, we think are very helpful for asset prices in general, emerging markets in Brazil in particular. Look at Brazil. The economy is in bad shape. It's a big recession this year, minus 7% we think. However, inflation is very, very low. We think 1.5%, well below the target of 4%. And that allows the central bank to keep rates, to cut rates dramatically and probably keep rates low for a long period of time. So this is a combination that helps the current account adjustment taking place. So there are many challenges, therefore, for Brazil. But we think the path going forward is one of gradual recovery, low inflation, rates low for longer, and appreciating currency after a lot of pressures earlier this year.
Can you extrapolate that enthusiasm over to a strong buy on all of struggling emerging markets?
Well, we do have a positive view on emerging markets, but key here is differentiation. I mean, I mentioned, for instance, the impact the global crisis has on the current account, on trade flows because of volumes coming down, because of prices coming down, because of the impact of tourism, for instance. But not all emerging markets are created equal. For instance, take oil prices. When they are down, it's bad news for the oil exporting countries, the GCC, Colombia, and so on. But it's great news for importing countries like India or Chile. Likewise for tourism. Tourism flows are collapsing globally everywhere. That's very bad news for Thailand, for Egypt, for Mexico. But it's actually good news for those countries that have more tourists abroad than coming into the country, like Brazil or Russia. So in general, we're constructive on emerging market asset prices, but differentiation is the name of the game. Being selective certainly pays off.
Marcelo, when you look at some of the emerging markets overall, what are the one or two countries that will be better off? We often talk about emerging markets, but as you're saying, each country is very different. Which is the one that will, get through the crisis, the COVID-19 crisis better, but also implement the right structural reforms?
Yeah, absolutely. This is the key question, because it's not just the short-term impact of the COVID crisis, but we have to look at the lasting implications for the global economy, for emerging markets. The long-term challenge is quite important too. Critically, I think, for emerging markets, long-term is the risk of deglobalization. I mean, say goodbye to globalization, say hello to fragmentation, and to figure out who does better within emerging markets, we have to look at three things. Look at the macro legacy, the starting points. Look at the global linkages between each economy and the global picture. Look at the institutional strength. So who wins? Well, if you look at countries like South Korea, for instance, they tick many boxes. The other end of the spectrum, if you look at Egypt or Argentina, they have a lot of things to do. If you have a less globalized world, the big closed economies like Russia and Brazil do well, but in the really long term, what really matters is institutions. And then if you look at countries with better institutions, you come up with names like Chile, for instance, that even though it's very small, very open, suffers in the near term, long term should be able to deliver faster growth given its institutional strength.
Dr. Cavallo, thank you so much. Greatly, greatly appreciated. Too short a visit. Marcelo Cavallo with us from BNP Paribas. We've got much more coming up, and yes, we're going to be very much focused on the equity markets and what we observed yesterday. Mohamed El-Arian will join us. Edward Hyman will join us. And we start strong in the next hour. David Pearl will join us. He is a really, really astute, I'm going to call it growth/value investor, and will give us investor perspective, not in the short term and not in the quick rebound, but really on what we're going to see here in the coming weeks and months. Again, if you're just joining us, futures rebound very, very nicely here. The VIX comes in from 42 to 36 as well. I'd also point out again, as Francine mentioned, GRIB, GDP news on a monthly basis out of the United Kingdom. That'll be one of our themes in the next hour as well. Please stay with us on this Friday from London. From New York, this is Bloomberg.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil, the Bloomberg Commodity Index.
This morning, Houston, we have a problem, in Phoenix too, and it is not funny. It's not the movies. Their pandemic, it is different than New York's pandemic, or really is it? They have relaxed social distancing. They are running low on hospital beds. Yesterday, well, the bid had a problem. There wasn't one. Stocks crater. We measure, well, the need to buy a rather large dip. David Pearl and Edward Hyman in this hour. And it will not be a convention. Rather, it will be, quote, to celebrate the renomination of the president, social distancing presumed to be allowed in Jacksonville. Please read the fine print on the back of the ticket. By attending this convention, you and any guests voluntarily assume all risks related to exposure to COVID-19, etc., etc. Good morning, everyone. Bloomberg surveillance from New York on a Friday, channeling Yul Brynner and Francine Lacroix in London as well. Francine, we can talk about the markets. We'll do a lot of that in this hour. But there was that statistic from the United Kingdom on a 30-day collapse in the service sector of the nation. A negative 20% statistic is stunning.
Yeah, it is stunning, and it also follows a 5.8% drop in March. What's also, very topical, Tom, is that sometime in July, we're expecting a lot of the furlough programs. This is the government programs to give money to people that have been still in their job, but actually spend aid may become real unemployment, so jobless people. And so we're trying to look at the dynamic for that. It's been a really tough week for Boris Johnson. He's come under extreme scrutiny and criticism because of how he handled the crisis in the first couple of weeks. Again, the UK actually was a little bit slow compared to others in entering the lockdown. And of course, we look at the Brexit talks. So a lot to do with the UK in the next hour.
And amazing, folks, to see the calls on Wall Street around this gloom. George Saravelis, I was shocked at how gloomy he was earlier in the week on the trajectory of pound sterling over the next 6 months to a year. So we're going to do a lot in the markets in this hour. Again, Ed Hyman will join us later, David Pearl here in moments. Right now, let's catch up on the news of the morning with our first word news in New York City. Here's Ritika Gupta.
Morning, Francine, Tom. There's never been a month as bad as April for the British economy. The UK says GDP fell more than 20% as the coronavirus lockdown took hold. On a 3-month basis, economic output shrank more than 10%. The contraction will prompt louder calls for the British government to ease restrictions on industries trying to survive. The IMF says the global economy is recovering more slowly than expected from the coronavirus, and the fund expects it will have lingering scars from the experience. The IMF will release economic growth projections June 24th. It expects them to be worse than the last forecasts that were delivered in April. The IMF says that in general, Asian economies are further along in the recovery path. President Trump is rejecting calls to overhaul law enforcement or cut police funding. He says a strong economy will be the fix for racial injustice. The president is working on an executive order that he says asks police to meet the most current standards for the use of force. But there are few details on what that program would look like. And North Korea accuses the U.S. of breaking promises it made at that historic summit 2 years ago. Kim Jong-un's regime says that the Trump administration has turned dreams for peace into a dark nightmare. The U.S. and North Korea agreed to work towards denuclearization of the Korean peninsula. President Trump demanded that Kim give up nuclear weapons before the U.S. eases up on sanctions. Global News 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Thanks so much, Ritika. On the data, let's just go to the equity market right now. Clear rebound off of what we saw yesterday, really closing ugly out of New York. Futures up 59, Dow futures just moments ago printing up 600, that's 2.4% on Dow futures. Nasdaq futures lag a little bit, up 1.8%, well under 10,000 on that Nasdaq statistic, 9,772. When have I quoted the index level on the Nasdaq? The VIX got out to a worse 42 in yesterday's carnage, and we're back nicely to a 36 level as well. Francine?
Tom, I'm looking at a very similar data check to yours. European stocks are actually advancing now. I want to show you the VIX. because we've seen a bit of movement on it, 36.23. I also want to show you pound because of what we saw in the economy, but in general, treasuries and the dollar slipping, Tom.
Very good. We begin our equity coverage in this hour with someone esteemed in the analysis of cash flow. What's so important here, folks, within the fundamental analysis, which many say is delinked from this market, there are revenue dynamics, and then down the income statement, I guess there are earnings dynamics, and somewhere in the middle of that is the soup called free cash flow. David Pearl is at Epic Investments and joins us right now. David, what do you do on a day like yesterday? Is it an opportunity even for a conservative long-term guy like you to quote-unquote buy the dip?
Actually, yes. We were buying a bank yesterday, so as an example. It is probably the most factor or thematic-driven market we've seen in 20 years, and this is looking at the analysis. It was down on factors. It's up on factors. The companies that led the market as it went down were the worst when it came back up since March 20th and vice versa. So, frankly, it's been very frustrating for stock pickers. Fundamentals really haven't come out. The FANG stocks have been huge winners over the last few years, but, you know, when you look at the 6 big stocks in FANG, 3 of them make a lot of money, and the other 3 vary from losing money to really making a small amount. And there's no differentiation generally. They are all going up or down on the same days.
Right.
So we're looking finally for some price discovery here.
Well, David, this is fascinating. And folks, I'm going to do a little math here, in that what we're looking for is the dynamics of relative revenue growth. And certainly those glory stocks have relative revenue growth. David, can you parse superior relative revenue growth from everything else, where everything is going to make 4% revenue growth, and maybe there's a group of stocks that will make 6 or 8% revenue growth?
So that's what's driven the market when rates go to zero with the Fed, and people have not differentiated between revenue growth being, as long as it's above average, they're willing to pay up. But again, as you started, we are free cash flow or profit investors, and only half of those stocks have superior profits. Facebook, Google, and Microsoft have S&P leading profit margins. They're incredibly high. When you think of search, it's probably the best business in the world. You know, Facebook basically just runs a website, so very high margins on advertising. You know, whereas Netflix loses cash, continues to lose cash, but investors are just looking out, let's say, 10 or 20 years, because interest rates are zero, and if they make $1 15 years from now, it's good enough for them. We don't feel that way, and only 3 of them are actually going to have earnings growth this year, 2020, the 3 I mentioned.
So, David, good morning from London. Where do you see the biggest value? What do you think will give you the returns you're seeking?
Well, it is going to be in the U.S. a return to normalcy. And, you know, obviously we have had the most volatile market, where we were in the best expansion since World War II up to mid-February. Then we had the fastest correction in history, and since March 20th, we've had almost one of the fastest recoveries in the market. But what it's pointing to is we are all, I think consensus is we are going to return to some normal. It's not going to be where we were before COVID. So whether it's 50%, 75%, that is the debate. And then which industries are going to lead us out? I think it's pretty clear aerospace is going to be the laggard. But if you had a 5-year horizon, are we going to fly planes again? Yes. So depending on your time horizon, I think restaurants are something that have been recovering very, very quickly. People want to go out and spend money, and they're already open in many, many states, and they will be returning to closer to 100%. If they don't get there, it'll be 75% of normal. So economically sensitive stocks are the ones with the biggest upside. Financials are the cheapest. The one thing about financials is you have to watch credit quality. The rates are interesting, but these bigger companies, the bigger banks, make money on the loans and the spreads over LIBOR. It's short rates that matter, actually, and they have a spread. It's really credit quality. If they get paid back, they're going to make a lot of money. They're about to have stress tests at the end of this month, which will probably allow them to return all their capital. In other words, do stock buybacks like they were doing before COVID. If so, they could have near double-digit returns, even if earnings and revenues are only low single digits, but they'll have an almost double-digit return of capital shareholders. Then you look at industrials and particularly consumer discretionary as very interesting things. For instance, Dollar Tree is a company that will benefit today because it's where people go when they first get back to work. It's cheaper than Walmart, but it has a long trajectory because they took over Family Dollar, which will be basically the Walmart of small towns throughout America. So it's really the only place you could go to get a lot of groceries and basic goods if you're in a rural area. So there's a really long trajectory for a company from a bottom-up stock-picking perspective that fits with this economic outlook.
David, what do you think is priced in terms of the possibility of a second wave of infection and a lockdown? Are there pockets of the market that are already pricing this in?
That has been the important question during the entire rally, is whether the market is discounting the full recovery and being over-optimistic or not. I would point out, when you look at the data here, testing is up something like 30 to 40% in all of these states, Texas, Florida, New York. But so when testing is up, cases are going to be up. We already knew that. The statistic you don't need the test for are mortality. That has not changed drastically. So my point would be, what we're seeing is more people have the virus because we're testing more people. It scares us for sure. But when you look at the mortality rate, it has not moved very much, which says that we're treating it pretty well. People are social distancing. It turns out the virus was very widespread in the first place. So while we watch it, I wouldn't get panicked about it. It is natural for the market to have a pullback after such a strong rally. And let's face it, value only has outperformed a couple times in more than 10 years. The last time value had a strong outperformance was the dot-com bubble in 2000. So, there really is, from a stock-picking point of view, interesting value stocks as long as they are, in fact, creating cash flow for shareholders.
I want to come back and talk about that, the idea of momentum versus small cap and what we're seeing, the lure, if you will, of international investment as well. David Pearl with us with Epic Investments. We're going to continue this discussion this morning. Ed Hyman with us, Mohammed Al-Arian joining as well later. Please stay with us from London. And from New York, this is Bloomberg. Bloomberg surveillance. Good morning, everyone, from New York, from London, of course, picking up the pieces off truly an equity markdown. As I mentioned earlier, folks, they did a lot of fancy technical work on the Bloomberg, and it is amazing how far we were extended on some of these indices, and even the crater that we had yesterday only got us back to certain levels, whether you look at the technicals or even some of the fundamental ratios as well. We continue with David Pearl of Epic Investments. David, one of the charts trotted out every day is momentum stocks versus everything else. Have you ever seen anything like this where it's just a momentum market?
No, this has been one of the most extreme circumstances, and the volatility has been amazing. For the market to have 25% moves every couple months, let's say, is unprecedented. Sadly, it is very hard as a stock picker when these factors overwhelm. And to go with momentum, it has been growth over value, large over small. So those three factor issues have been very dominant, although they flip-flop every few days or a couple of weeks. And it's overwhelmed differentiation between good and bad companies. Now, the way to combat this, frankly, is to be a long-term investor. The question is how many of us can hold out. But, our average holding period is 3 years. So in other words, if you're a good company, a good business, very profitable, you generate cash, you do the right thing to grow it or to pay people back with dividends and share buybacks, over a period of 3 years, somebody will figure it out. It may not even be the market. It could be another company buying your company. It could be private equity taking you private. It'll be a non-market participant. But over a long period of time, fundamentals get recognized. In the short term, and this has been the wildest short term I can remember, it's been all about these factors.
David, when do markets start really worrying about the unwinding of all this extra stimulus from central banks?
Well, this is the question, and if you ask the people who talk about gold every day, the question is how much longer we can do this without having, some issue with inflation, with lack of confidence in the Treasury and the Fed. So for the time being, though, I don't think that's going to be an issue. The market really likes the Fed to be very, very dovish. But, skeptics in the long term go, we are creating huge, huge problems. But again, we have to get out of this. We need the lockdowns to end. It's just going to take a while. There's no question we're not going back to pre-COVID economy anytime soon. But let's put it in perspective. The second half of this year is going to look very strong compared to the first half. Next year, the year-over-year comparisons are unbelievably easy. So if you're looking at buying equities, they look attractive because of the relative increase in fundamentals year over year and relative to fixed income with rates at zero.
This has been a good briefing. David Pearl, thank you so much.
I'd like to buy the
investments.
You're welcome.
Greatly. We're going to have to leave it there, David, with a delay. I'm sorry. Thank you so much, David Pearl of Epic Investments. Again, Ed Hyman to join us in moments. Mohammed Al-Arian later today. Tonight, Lawrence Summers, the former Secretary of Treasury, will be with David Weston on Wall Street Week. Stay with us. This is Bloomberg.
livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix and Tom Keene. Lots coming up. Ed Hyman with us in a bit here as well. Right now, we digress to Washington staggering into a weekend. With us, Jack Fitzpatrick, who has been noting the response on Capitol Hill. Jack, what happens to Lafayette Park this weekend, and what is the symbolism as Washington tries to get back to some sense of summer normal?
Well, here we've been waiting for them to see when they're going to take the fencing down from Lafayette Park. I'm not sure if that's what you're getting at, but I mean, really, the whole central part of D.C. has looked a bit like a military zone while they're working on Capitol Hill on some legislation on policing. The fencing has still been up around the White House, and we've seen military vehicles around the central area of D.C. So as far as getting back to normal, we've still got a little bit of a ways to go.
Jack, a lot of the focus was, again, on that photo opportunity of the president in front of the church next to the White House. We heard yesterday from someone who said he shouldn't have been there.
Yes, clearly that was sort of a major flashpoint in this controversy, the march across to the church across from the White House, where you had a military official yesterday apologizing, saying he should not have been there. That will clearly, that's one more sign of how rough this has been for the president. I mean, you've seen his polling take a hit during his response to this. He has not exactly entirely tried to address it in a different way. He talked about race a little bit in Dallas yesterday, although he's kind of tried to shift it to an economic discussion. Really, I think you could sum this up by saying there seems to be a long way to go for the president to find some sort of cohesive message on the protests, how to respond to them, and why he's if he's got any kind of plan to actually address them aside from his law and order approach that he's emphasized so far.
Well, it'll be interesting to see, and of course, all that serve the nation, looking through the Pentagon to General Miley to see what his future is today as chairman of the Joint Chiefs of Staff. Jack Fitzpatrick, thank you so much for that briefing this morning. We must get back to the markets. It's no question it's a lift up today. VIX 42 to 36. The Dow futures up 600 big points. I'm not going to say all clear, but decidedly I can state it is a rebound off of yesterday's most difficult markets. Edward Hyman with us, and then Mohammed El-Arian later this morning. This is Bloomberg.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg First Word News. The city of Houston warns that the coronavirus has it on, quote, the precipice of a disaster. Officials are getting close to reimposing stay-at-home orders. Earlier this week, Texas recorded its highest one-day tally of new cases since the pandemic emerged. The state has been amongst those pushing hardest to ease lockdowns imposed. This is Bloomberg's. The state has been amongst those pushing hardest to ease lockdowns imposed during the first wave of the disease. The Republican Party is moving key parts of its August nominating convention to Jacksonville, Florida. The event had been scheduled for Charlotte, North Carolina, but the state's governor had refused a request by President Trump. The president wanted the governor to lift all coronavirus social distancing measures, such as mandatory face masks. European leaders want to avoid getting boxed in by President Trump over China. The president hosts the Group of Seven summit this year, and he's entitled to invite whoever he wants. He's been musing about inviting the leaders of Russia, India, and Australia, but not China. European diplomats say that's a clear sign the summit could be turned into part of the president's anti-China campaign, and they don't want to play along. The UK plans to have a light-touch customs regime at its border with the European Union next year. That's even if there's a no-deal Brexit. British authorities are trying to avoid adding burdens to businesses already struggling with the impact of the coronavirus. The new border policy emerged after the UK and the EU agreed to step up the pace of their trade talks. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thank you so much. Greatly appreciated. Francine Lacroix in London. I'm Tom Keene in New York. The hallmark of Bloomberg Surveillance is to bring you world experts on what we do, which is economics, finance, investment, and yes, a large smattering of international relations as well. One who has set the foundation for this for many decades is Edward Hyman of ISI, and of course Evercore ISI now. I read his research at CJ Lawrence just a few years ago. We still read his research today. We're thrilled that Ed Hyman could join us today. Ed, I want you to link the market gyrations and the original monetary policy that we face today to your wonderful acute reading of the American economy. Can Jerome Powell lead this economy to a recovery in 2021?
So at the moment, that's what's happening. The other force there, which is connected, is reopening. And reopening is happening everywhere, from London, Paris, to Jamaica, everywhere. And that's giving the economy a lift. But there's still so many risks out there. The one that was highlighted yesterday was the chance of a second wave. You also have a chance the economy stalls. You have the election coming up. But in any event, the Fed and other central banks and other policymakers on the fiscal side are being very aggressive in stimulating the economy. And as far as I'm concerned, it's beginning to work. So we have 20% growth forecast in the second half of this year.
Within your Ed Hyman market economics, there is always a wonderful acuity of data. It can be trucks on the highway or railroads or some arcane measurement of the service sector economy. Give us one glimmer of hope you see in that minutia.
The first one I would go to, because of what you said, is this Apple Mobility Index, which is a new statistic that we didn't have before. But Apple gives you a reading daily of people looking for trip maps, and that is going up about a point a day. The second one are our company surveys, where restaurants have shown improvement for 9 weeks. Truckers have picked up some, but our surveys in general are now on track to be up for 9 weeks. That's 2. And then thirdly, you have unemployment claims, which were almost 7 million just about 10 weeks ago, and yesterday they were 1.5 million. So those are 3 things that have come down or have improved a lot. And then, of course, you had the blockbuster employment report for May with a 4 million increase. And we think there'll be another increase of 1 million in June.
Ed Hyman, good morning from London. Are we creating quality jobs in the U.S.?
It's too early to tell. I'm sure that the jobs now, creating jobs, we've just done it for maybe 5 or 6 weeks if we've done it. But it's really people coming back, as you might imagine, looking at the world in London or in New York or in Toronto, Paris. So I think initially the jobs are more at the entry level or low part of the economy. Say restaurants opening up, you hire people back, they order food, that starts up. They have to have trucks to deliver the food. They have to have truck drivers. But the figures have shown that the jobs are really at the low side. But at this point, I think you're not really creating jobs. You're just getting people back into work. And it's going to be a long time before we really start to have new jobs above what we had at the prior peak.
Ed, what are the chances of a second lockdown, and what would that where would that leave the economy?
I think that would be very bad. And I think, first off, just to have a second lockdown, you have to have a pretty big wave. And my bet, but I can't be, this is obviously very uncertain, my bet is that we've learned quite a bit in the first epoch of this about distancing, about segmenting, older people versus younger people. And so we're definitely seeing a second wave, but it hasn't been big enough to, I think, at this point, cause a lockdown, a new lockdown. And so I don't see that, but that sends the S&P down almost 200 points yesterday. So it's a good question.
Ed Hyman, I've got here on my fancy iPhone the HP 12C calculator, which you know too well. I went back, Ed Hyman, and I looked at the Dow at 1,000 in 1972, and you put your shingle out at C.J. Lawrence. I want you to talk to the gloom and doom crowd out there. I want you to talk to the bears who feel it's over. Up we go through this tribulation and that tribulation. Why are you optimistic on American equities?
That's a deep question, Tom. Before this virus, as you and I talked about, and I would travel around the U.S., cities I went to, and I counted up 94, were doing really well. Boston, for example, was booming, and then Nashville was booming. And I got up to 94 cities like that. So I had the feeling at that point, before the virus hit, that the U.S. economy was doing the best I had ever seen it. And the sectors that were driving it were things like higher education, technology, new sectors in the economy, healthcare was a major sector, and oddly enough, entertainment, which is new compared to 1972, has become a major sector. So I think the economy, the world economy and the U.S. economy could do okay when we get past this. And I think there's a pretty good chance that by the time we get past the election, we might have a better sense of the future again. I think the odds are over 50% that we get a vaccine, and I think that's essential to getting past the situation we're in now, to the point where you and I and your listeners can feel comfortable with flying or going to a movie, going to a baseball game. But in order to do that, you're probably going to have some sort of vaccine. And I think the odds are over 50% that by early next year, we have a vaccine that is pretty effective. And then after that, you'll also have the election behind us, one way or the other. And so we can either have a new administration or look forward to Trump's last 4 years. And then the economy in 2021 could be a barn burner if we get a vaccine and you have all the stimulus that we're putting in the economy now, both monetary, which
right.
you mentioned, but also we're doing a huge amount of fiscal.
Ed, where do you see, if there's a U.S.-China trade war, a second one, which could be more aggressive than the first one, what does that do to the economy? I've moved on. I was very positive on China maybe 10 years ago, 15 years ago, maintained that. I'm involved with a number of institutions in China, so I know it pretty well. But at this point, I assume that we're in some sort of Cold War. I thought we would move together, and now it appears that we'll be moving forward, hopefully both countries, but moving on separate paths. And so that, which I thought was going to be very synergistic for the world economy, is less so at this point. And I assume that it's going to remain a sort of Cold War type of back and forth trade issues, political issues. So it's not. I don't put that in terms of Tom's questions, Francine. I don't put that as one of the. I thought it was going to be a bright spot. Now it's more of a dark spot.
Right. Ed Hyman, thank you so much. With Evercore ISI this morning, we'll drive forward this conversation through the morning. Again, Dr. El-Erian scheduled to be with us, and Ben Laidler scheduled to be with us. He has been bullish and reaffirms that in a research note overnight. Coming up, an update on the pandemic, the success of New York State. From Buffalo, the Lieutenant Governor, Kathy Hochul. Stay with us. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. The biggest airlines in the UK are suing the British government. They're trying to overturn the new requirement that people arriving in Britain self-isolate for 2 weeks because of the coronavirus pandemic. British Airways, Ryanair and EasyJet say the quarantine will have a devastating effect on tourism and the wider economy. Hertz is asking a bankruptcy judge to let it take advantage of an odd rally in its stock. The car rental company wants to sell up to $1 billion of new shares. Stocks of bankrupt companies usually get wiped out, but shares of Hertz just rallied nearly tenfold from May 26th to this past Monday. It's since fallen by more than half. Investors are betting that the travel industry is set to rebound. Zoom says China demanded it deactivate the accounts of pro-democracy Chinese activists based in the US. The company shut down video conferences to commemorate the Tiananmen Square protests, which Beijing called illegal. Zoom says from now on, it won't allow any requests from the Chinese government to impact anyone outside of mainland China. And that's the Bloomberg Business Flash. Tom, Francine.
Ritika, thank you so much. So lesser enthusiasm there was an hour ago, but nevertheless a bounce. S&P futures up 51 points. Dow futures were up over 600 points. They're now up 500 points. I'm going to round that up to 2% and be optimistic. The Nasdaq 100 futures, they trail a little bit here, but nevertheless, a nice rebound off of the carnage that we saw yesterday. The VIX was a 36 handle, now 37 handle. Everything else to me, Francine, pretty quiet. What do you see, Francine?
Yeah, so as you're mentioning, U.S. futures, Tom, actually rebounding. European stocks are doing the same. They're gaining some 1%. Again, this is after that pretty dramatic sell-off that we saw. I think markets are still trying to figure out the second wave of coronavirus infections, but also a slower than expected economic recovery. The focus also is on pound. You can see pound 126.12. We talked about it today. I mean, it's pretty incredible, Tom, to see the UK economy plunging by a record 20% under this virus lockdown. Coming up next, we talk about COVID-19 with Dr. Andrew Pekosh, Johns Hopkins University Bloomberg School of Public Health professor and virologist. This is Bloomberg.
is actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Andrew Pekosh. He's virologist and Johns Hopkins University, a Bloomberg School of Public Health professor. Professor Pekosh, thank you for joining us. If you look at COVID cases, but also the number of hospitalizations in the U.S., it's very different state by state. Why is it so?
Yeah, so this is a reflection of the epidemic and how it varies based on the geographic region within the United States that you're in. And it also is now being affected by the different states and their rollout of pulling back on public health interventions. So you're seeing that combination of how many cases were going on within a state and how those public health interventions are being loosened that are leading to these different numbers of cases.
Houston is weighing a new lockdown. What have we learned? If you look at all the data from all the various states, what is the right way of doing an opening of an economy or easing of the lockdown, and what is the dangerous way of doing it?
Well, I think the most critical thing when loosening these public health interventions is to make sure that testing and contact tracing capabilities are at a very high level. Because you don't just want to release the public health interventions, you also want to have in place ways to identify and track the cases that are going to occur. But if you have the capability to do the testing and the tracing, you can identify those cases, quarantine the individuals that are ill as well as their contacts, and then keep the number of cases low. My worry is that in some of these states that have eased their public health interventions, those testing and contact tracing capabilities are not at the right level to be able to now keep the cases at a low level.
Andrew, do we have an idea, if you're going to make an informed decision on how to ease a lockdown, you need data. Do we have an idea about how many people or what percentage of the population in each state has actually had COVID-19?
So some of those tests are certainly coming up. What's really important is to know that your testing capability is relatively high and that your testing positive numbers are at a relatively low level, meaning around 5% or so. If you have reached those capabilities, then there's a realistic chance of your state being able to respond with the testing and tracing capabilities to limit the spread of the virus. So if you ease those public health interventions when there's still a large numbers of cases around, the rebound in terms of numbers of cases is going to be really fast. So you want to get the cases down low and then have the capability to keep them low through the testing and contact tracing.
What can you tell us about the capacity for hospital beds in intensive care units? You know, are we reaching the limits in certain states, or actually is there room to kind of test this gradual lockdown?
Yeah, and that's one of the most important questions that has to be followed on a state-by-state and perhaps even a city-by-city basis. The real worry is that you exceed capacity to deal with the severely ill, and that's based on hospitalizations as well as intensive care unit bed capacities. We're seeing those levels rise in a number of states. Other states, and I'll call out the state I'm in now, Maryland, hasn't seen those surges as they've tried to relieve the public health interventions. So again, it really comes down to each state really assessing the number of cases and their ability to follow those cases and making informed decisions based on that, whether they can, that drives the rate in which they pull back their public health interventions.
Andrew, what was the approach in the U.S., or how was it different to Europe and Southeast Asia?
Well, I think in other parts of the country, in Southeast Asia, for instance, you saw a much more intense, rapid movement into testing and contact tracing at the early stages of the pandemic. What you're seeing in Europe, their method of control was once the virus got there, they really got their testing up to speed, put in public health interventions, lowered those cases to a significantly low level, and then were able to open up the economy when their cases got very, very low. In many parts of the U.S., our case numbers really didn't get that low before we started to roll back our public health interventions. It doesn't make it impossible to control the case numbers, but it makes it incredibly difficult because you need much, much more resources to do the testing and contact tracing. I know it sounds like a broken record, but it really comes down to testing and contact tracing as a means of controlling the bounce backs that we're seeing in these states as public health interventions roll back.
Thank you so much, Andrew Pekosh there at Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. Also tune in every day for our exclusive conversations with Johns Hopkins experts for an inside look at battling COVID-19. A lot of the other focus, of course, which is linked to what we are seeing in the public health emergency, is what the markets are looking at. So U.S. futures are bouncing back. European stocks are also bouncing back. There has been a dramatic sell-off, which was brought on by concerns over a second wave of coronavirus infections, but also a slower than expected economic recovery. I'm looking at treasuries. They're down, dollar falling, and then the pound actually advancing even after we saw that data showing that the UK economy shrank a record 20.4% in April. We'll have plenty more on the markets throughout the day. Coming up, join Tom Keene, Jonathan Farrow, and Lisa Abramovitz for more Bloomberg Surveillance. That's simulcast on Bloomberg Radio and Bloomberg TV from 7 a.m. in New York to 12 p.m. That's 12 p.m. in London. That's just a couple of minutes from now. This is Bloomberg.
When they check into a hotel, they say, hey, I probably need to wear a mask. There's so many people. And so we should have that available, like a toothpaste and toothbrush.
Front door of the hotel, the availability of hand sanitizer and disinfecting wipes. Again, we know that they're walking into an environment that we've cared for them in, but given them the ability to kind of be involved in that, to kind of build their level of confidence.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Markets trying to test the Fed to see how accommodative will they be, or are they okay with rates being higher?
There is no free lunch. Somebody will have to pay.
The way markets are looking at dividends and returns and earnings has been a little bit over the top.
If you look at what the pandemic has done, it has exacerbated every division we had.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures positive. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro together with Lisa Abramowitz. Tom Keene, allow me to reintroduce to you a little bit of two-way risk that makes a comeback to this market in a big way in the last couple of days.
Amazing to see it. And what's really amazing, John, is how far ahead this market was. The technical deterioration yesterday was remarkably tame. First thing I did was look at the Bloomberg terminal, John, and to see a bounce off selected Fibonacci's fine, some of the technical work. But what has stunned me this morning is the reaffirmation of the bulls in some form of V-shaped recovery and enthusiasm for stocks. Tom Purcelli, RBC optimistic. Ben Laidler joining us later. Ben Laidler optimistic.
S&P 500 futures looking optimistic this morning, Tom, up by 1.9%. I think we've got to work out, ponder what the big driver of markets is and will be. Over the last few weeks, we've pondered that question, Tom. Will it be the sequential month-on-month, week-on-week improvement we've witnessed, or will it be the limits of the recovery? We've been trading on the former, and I think what we got in the last 24 hours was a gut-punch reminder not to forget about the latter, and it was the latter that I think made a comeback into the psyche of this market just in the last 24 hours, Tom, in a more pronounced way.
No question about that. And the pandemic update, if you will, and the new geographies of concern is important. Ed Hyman just joining us, John, and he was adamant that a vaccine is critical into next year. But Ed Hyman was hugely enthusiastic on the American financial experiment.
The data has been getting better on the economic side. On the pandemic side, there's some real disparity beneath the headline number in the United States of America at a state and city and county level in places like Texas. Lisa, we talked about the data yesterday on the economic side. We wanted to see if the economic data validated the optimism that the payrolls report last Friday inspired. And yesterday morning, we answered that emphatically, I think, with a no. We still don't know. The path, the trajectory of the recovery is still pretty unclear at this point.
Yeah, it was disappointing how little of a decline that we saw in the continuing claims of people who were jobless. Interesting to me, just the big takeaway from some of the volatility is that the fundamentals are going to matter even as the Fed pulls out all the stops to try to dampen volatility. When we talk about economic data, today at 10 a.m. we're going to get a read on consumer sentiment, which people are looking at as an important piece of the equation. University of Michigan Consumer Sentiment Survey comes out then. To 1 p.m. also Eastern time for other things I'm looking at is the oil front, the Baker Hughes U.S. rig count. Remember, this had tumbled earlier in the year. Question of whether some of those rigs came back online as prices increased, a big question there. And then later today, and this, John, I think is really important, Joe Biden, the Democratic presidential candidate, is attending a virtual town hall on public health and economic crises. We are in an election season. We seem to forget that, but especially heading into September and October and November, this is going to become an increasing risk for the market as well, John.
I don't think we can forget that. Thank you for that, Lisa. Tom, we need to talk about it. The President of the United States, where he does poll well still, not just with his own party, but on the economy. And you can see the trajectory of travel here going into November. Who is best placed to secure the economic recovery? And the former Vice President, Joe Biden, has got some work to do there to convince people he's the man.
Well, not only the speculation over who vice presidential candidates will be, frankly, for both parties, but also, John, just the idea of how you report the statistics. The United Kingdom today, John, albeit a monthly statistic of a negative 20% GDP, President Trump has to get those grim statistics out of the way. I believe it's on July 30th. We'll see the second quarter of the United States. Then he's got to get the third quarter out of the way, and then maybe he'll see a trend that will advantage him.
The IMF talking about the scarring, Tom, the permanent scars from this crisis, whether it be in the labour market or in bankruptcies. We'll catch up with Mohammed Al-Arian a little bit later on that very topic. I want to begin the programme with equity futures up 57, positive 1.9% on the S&P 500, with the CIO of Skybridge, Troy Gajewski, joining us right now. Troy, fantastic to catch up with you, sir. Let's just start with a simple one. What was behind the massive move lower in the last couple of days?
Look, obviously, from our perspective, it's mainly technically driven in that you think of where equities bottomed out at and how fast and explosive they've rebounded. They clearly got overextended. And a lot of that has to do, of course, with the Fed's easy money policy, which is increased money supply by levels that no one could have dreamed of even mid-March to late March. And so you started to get a euphoric rally, and then the data coming in started to look a little bit weaker, started to see profit taking. And that, again, led to a much higher downside vol than we've witnessed really since March. That being said, when you think of what equity investors are doing now, they're looking ahead to 2021 and even into 2022 and saying, hey, given how low treasury yields are, given how much money supply has increased, given the fact that the constituency of equity markets is really not very reflective of the real economy, even in the best of times, and particularly now, we're willing to pay a much higher multiple because we don't see interest rates going up anytime soon, and we think we're going to have very accommodative balance sheet policies for an extended period of time. So we've never thought we'd retest the lows, and we certainly don't think this mini pullback gets materially worse. We could see it down 10 to 15 at some point, but it does look like we have positive price action already today.
Right. Troy, where's the agony right now for hedge funds? And what I'm really, really interested in is the idea of the interest rate parity game, the playing of the bond market, long and short, if you will. Is that a minefield out there awaiting hedge fund returns?
Yeah, so if you're focused on that space, I mean, that's either for fixed income ARM managers or for macro managers that are doing more relative value trading. And so if you think of the path here, the big driver of returns for most macro managers in February, March was the collapse in interest rates in advance of easier Fed policy. Some also monetized some of the sell-off, but have not done a great job capturing the rebound, which is typically the case. And that's really all you can ask from a macro fund is protect you on the way down. Don't assume they're going to also capture the reflation trade. But what we're in now is a range where, 10 years is going to be 50 to 100 basis points, arguably as far as I can see. And we sincerely doubt the Fed's going negative anytime soon. So trading fixed income was a great profit center for certain hedge funds in February and March. We just don't see it as a great profit center going forward because you're going to have a constrained range-bound market.
So, Troy, let's talk about the best profit centers going forward, given the fact that a lot of people have seen the Fed as propping up asset prices, perhaps to what fundamentals would justify. And yet we do see that occasionally fundamentals matter, like yesterday. What is underpriced right now in the market, given Fed stimulus and given the fact that fundamentals cannot be completely discounted?
Oh, yeah, sure. So from our perspective, if you look at where the most damage has been done, it's been in a large part of our portfolio of structured credit, particularly RMBS, consumer ABS, CLOs, and CMBS. And when you look at those markets as a whole, what you're seeing is much better fundamentals than we even dreamed of, 6 weeks ago in terms of the residential housing market. Most managers are pricing in 20-25% unemployment, 15% plus or minus 5 forbearance requests, 2 to 5% ultimate foreclosures, which was incredibly higher than what one would have expected in February, obviously before COVID hit. And so what we've seen from the data is forbearance requests apparently have flatlined around 7 to 8%. And again, maybe they go higher, but it doesn't look like they're going up to 15% anytime soon. And obviously the labor market's at least stabilized at much better levels than people thought, again, 6 weeks ago. And spreads are still exceptionally wide. So we think whether it's legacy RMBS, or even some of the new issue markets that got disproportionately punished. There's good opportunities there. Also, even in agency CMBS, the agency CMBS space is primarily or exclusively multifamily. And as you're probably aware, given the transfer payments that the government's done, which showed up big time in the recent personal income and outlays report, where you had a 90% increase in transfer payments, and which offset the 7% drop in wages and salaries, which in turn led to a 33% rise in savings, you've seen rents decline barely at all, which has been shockingly positive. And that doesn't mean when the stimulus runs out, we won't see those rent payments start to fall short of where they were in February. But the fundamentals so far have been much better than people feared. And you're looking in some cases at low teens, mid-teens yields for Freddie or Freddie B pieces in particular. So we see that as a great opportunity. And then, of course, when you come over to distressed corporate credit, the easy money has been made in performing credit so far because spreads have gapped in so much due to Fed policy intervention primarily. But if you look at forward default rates projected by the major rating agencies and most managers in that space, you're looking at somewhere between $300 and $500 billion of defaults. Now, we're not arguing that managers are going to put up the same returns they did in 2009 necessarily, but it should be a very rich opportunity set for the next several years as this cascade of agencies runs through markets.
Troy, will you do me a favor? Next time there's some easy money to make, will you come on this program and let us know ahead of time so I can make some of that easy money as well? I love it when people come on this program and say the easy money's been made. Troy, great to catch up with you. There has been nothing easy about the last several months. Troy Gayeski there of Skybridge on this market. Tom, this is the story, isn't it? On the reopening, on the economy, we have seen upside surprises in the economic data. The concern in the last couple of days is whether we got too excited by a payrolls report, one, and two, whether the latest data on the pandemic, I want to be clear here, away from the headline number at a country level in the United States and focusing on the disparity beneath in states like Texas, whether that starts to shape people's appetite to put more capital to work in a more riskier parts of this market exposed to the cyclical economy.
There's no question you see it within the pandemic. I mean, the details, I thought Vox did a wonderful treatment state by state of the details. They led with Arizona, but had Florida and Texas in there and Oregon as well. So yes, John, I do think it's the pandemic, but what I was stunned this morning to look at the charts, John, of the technical quality of this pullback because we were so far extended into Thursday.
We'll talk about the technicals and the volatility up next on this program. We'll do that with Dean Kernert of Macro Risk Advisors. In this market right now, a lift to close out a trading week. Equity futures up 60 points, positive 2%. From New York this morning, good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. There's never been a month as bad as April for the British economy. The UK says GDP fell more than 20% as the coronavirus lockdown took hold. On a 3-month basis, economic output shrank more than 10%. The contraction will prompt louder calls for the British government to ease restrictions on industries trying to survive. The IMF says the global economy is recovering more slowly than expected from the coronavirus, and the fund expects it will have lingering scars from the experience. The IMF will release economic growth projections on June 24th. It expects them to be worse than the last forecasts that were delivered in April. The IMF says that, in general, Asian economies are further along in that recovery path. President Trump is rejecting calls to overhaul law enforcement or cut police funding. He says a strong economy will be the fix for racial injustice. The president is working on an executive order that he says asks police to meet the most current standards for the use of force. But there are few details on what that program would look like. North Korea accuses the U.S. of breaking promises it made at that historic summit 2 years ago. Kim Jong-un's regime says the Trump administration has turned dreams for peace into a dark nightmare. The U.S. and North Korea agreed to work towards denuclearization of the Korean peninsula. President Trump demanded that Kim give up nuclear weapons before the U.S. eases up on sanctions. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
That we're seeing ebbs and flows shouldn't come as a surprise. We know that markets, with all of the passive investing, have gotten more prone to trending, trending, correcting. That's more of the dynamics we see these days. So I don't think it's that surprising that we're taking a step back, and I wouldn't necessarily think that this is a sign of panic either.
Macro Policy Perspectives founder and president from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. We're live on Bloomberg TV and on Bloomberg Radio, getting you in shape for the trading day. Your morning this morning shaping up as follows. Equity futures positive, up 60 on the S&P 500. We advanced by around about 2% on the benchmark. Yesterday, nowhere to hide. Staples and utilities, even those sectors on the S&P were down around about 4%. In the bond market, big bid through the week on 10-year treasuries, down almost 20 basis points from last Friday. This Friday morning, we come up by around about 4 basis points to 0.7, call it 0.71%. And in foreign exchange, to round things out for you, yesterday was all about the haven currencies, the risk aversion bleeding through this market. Today, the Aussie back on top, Tom. I think that's a reflection of that improving risk appetite, a snapback this Friday morning.
Again, John, I was really thunderstruck by the reaffirmation of optimism off of the carnage yesterday by the bulls. Many of them just didn't blink an eye over that huge move. As you said, John, there was no place to hide yesterday. Some of Wall Street hides in the Greek letters. We hide in the derivative dynamics. An expert at that is Dean Kernett at Macro Risk Advisors. I'll be direct. I don't understand half of his research note. He does extremely sophisticated analysis of the interior dynamics of the market, and he joins us right now. Dean, you were the first name we mentioned yesterday. Basically, it was get Dean Kernett. What did you observe in the interior dynamics yesterday?
Yeah, thanks, Tom. A tremendous move, obviously, in the S&P 500. So we were running at about a 25 implied volatility. So that's about a 1.5% move a day. That's high in, of course, historical context. We moved 6%. So that's a 4 standard deviation move. Our little normal distribution table is going to tell us that's supposed to happen once every 63 years. So first, we know, of course, markets aren't normally distributed. The tails are fat and they're active. But the biggest, I think, conclusion from yesterday is just below the surface of the market. As has been discussed widely, the factor rotation is violent. So I keep track of a market neutral index for momentum stocks. And again, I underscore market neutral. And it has had 7 straight days of 4.5% moves or more. And that's 100 vol for a market neutral index. It's just it's staggering. So again,
we've had mega cap stocks moving like penny stocks, Dean. It's been absolutely remarkable. And I think what we're looking for are signs that maybe the coast is clear. And I know that's the $1 trillion question. It always is. But as you look at the VIX curve right now, what signal do you take away from that at the moment?
Yeah, so I think what the VIX is telling us is that the market was really unprepared for this. So anytime the market moves down like it did, the VIX is obviously going to fly higher. It outperformed the move lower in the S&P by quite a bit. So the move higher in vol is telling us the degree to which people were caught off sides. And I think that can be confirmed by looking at open interest in VIX options had gotten very quiet. So the ownership of, let's say, things like upside calls to protect portfolios was quite low coming into this.
Dean, taking a step back, after 2010, a lot of people were saying that the Fed stimulus and involvement in markets had dampened volatility dramatically. And we saw a real flat market, a real calm market. I'm wondering if there is a larger takeaway from yesterday, that the Fed is throwing the kitchen sink at the market in order to improve and smooth out market functioning, and you still see these whipsaw technical reactions that indicate some sort of liquidity issues or high degrees of leverage getting unwound. Is there some larger takeaway about the Fed reaching its limit in terms of being able to dampen volatility?
I think it's exactly right. There, at every turn when we have these significant risk-offs, 1998, 2008, 2020, at every turn, the degree to which the policy response is larger and more overwhelming and wades further into private markets, it just is telling us that the financial system is something it's unwieldy. I think that old adage, "Don't fight the Fed," is, of course, focused on asset prices, the stock market, but I think in terms of buying volatility, buying insurance, whenever you're doing so, you are fighting the Fed. And so we have to respect the significance of this move yesterday. It's violent. It tells us something. But at the end of the day, a stable VIX or a lower VIX is part of the Fed's playbook. It can't sit by idly and allow the VIX get back up into the 50s, allow high yield spreads to spiral higher. It'll sit for a little bit, but at some point, you're going to have the Fed come back in the name of market functioning. And so, again, when you buy insurance, you've got to keep that in mind, the policy response.
Dean, one final question, and I'm just going to be as direct as I can, and you can go nuanced as you like. The game is momentum. Do you buy the shift from momentum to value, momentum to small cap, momentum to international, or do you stay momentum?
I stay with momentum. I think that the real economy is what is ultimately going to drive that relationship. And of course, we've seen that shift back into small caps and value. It came undone violently. So much of it's just a function of the success to which the economy reopens. I'm skeptical on that. Again, you're fighting the Fed. You're fighting the policy response from the government. They are going to feel invested in keeping income earners with income if they don't have jobs. But the degree to which these weaker companies with weaker balance sheets are going to be able to thrive, I think, is very much an open question, just given how challenging the reopening of the economy is going to be.
Dean Kernett and Macro Risk Advisors. Dean, always fantastic to catch up with you, sir. My best to you and the whole of the team. Tom Keene, a balanced view there from Dean. And I think, as we've said repeatedly on this program, on the way down and through the rally, it is a moment for humility. The lack of conviction and visibility that we have over the next several months is just quite something.
It is. It's absolutely remarkable. And again, to go back to the research overnight, and I'm sure Dr. Larian will touch on this, people have a construct, John. They have a belief set that they work with. And what's interesting is not that it's being tested, but everybody's belief set is being tested on a weekly basis. Can they reaffirm their belief in whatever that belief is?
We'll catch up with Mohammed Al-Erin in around about 35 minutes on this program, live on Bloomberg TV and on Bloomberg Radio. Coming up next on the show, we'll be catching up with Jeremy Stein, Harvard professor of economics. We'll do that next with equity futures positive 55 points on the S&P 500. Up nicely to close out a choppy week. We are up by 1.8%. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. We're live on Bloomberg TV and Bloomberg Radio. This is Bloomberg Surveillance.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with Lisa Abramowitz. 2 hours away from the opening bell, this is Bloomberg Surveillance. With equity futures up 57 on the S&P 500, we are positive around about 1.9%. Coming into Friday at the close on the session down about 6%. On the week, the S&P 500 down around about 6% as well. Outside of that, in foreign exchange, the dollar marginally weaker on the week too, heading for a fourth straight week of losses. The Aussie on top today, that cyclical proxy for the global economy, the Aussie dollar doing better than good in today's session, positive 0.6%. And outside of that, in the bond market, last week off the back of that payrolls report, it was about higher yields and steeper curves. This week, slam the brakes on, hit reverse. It's been about lower Treasury yields, down almost 20 basis points on a 10-year maturity. In today's session, we creep just a little bit higher, Tom, up 4 basis points to 0.71%. But certainly, yields coming back down through the week has been the theme.
And I think, John, for next week, that's an even larger theme to see not only what the obvious yields do out the belly of the curve and further, but I'm really interested to see two-year dynamics as well. There's a huge presumption they stay right where they are, and I'm not sure. Evan Rabari at Citigroup with a piercing note this morning talking about, folks, what's called a bear steepener, which is where you would have yields coming up, but the 2 years still staying quite subdued. Now is a real treat, and this is without question the must-listen interview for Global Wall Street. How good of an interview is this? Mohamed El-Arian will take notes. That's because he knows Jeremy Stein owns the high ground of our theoretical finance, the underpinning of what we do. He's a former Fed governor, also a member of Princeton Gymnastics. Just a few years ago, he runs the herd of cats at Harvard, known as the Harvard Department of Economics. Professor, thrilled to have you with us. I want to talk about the foundations of Markowitz, of William Sharp, of Jack Traynor from a million years ago. Does any of that stuff work at the zero bound?
Well, some of it works, but I think one issue with the zero bound is if you're a stock market investor, there's not a lot of other attractive stuff out there, and you may want to diversify, but your general risk appetite is pretty high, and I think we're seeing some of that in markets now.
I look at the zero bound, and of course, what we do at Bloomberg Surveillance is talk macroeconomics and monetary theory. I want you to take the zero bound over to the capital asset pricing model, the fundamental theorems that everybody on Wall Street uses. How does that geometry work if there isn't a real yield, if there isn't a virtual nominal yield, and even negative rates in Europe? How does the geometry work?
I'm not sure about the geometry, but, I sit on the board of the Harvard Endowment, and one of the things that you see endowments generally, a whole class of other investors, when rates are zero and they have targets for returns, they end up pushing pretty hard into riskier assets. And I think that more than anything is the sort of mechanism that's at play these days.
Professor, one concept that people have discussed, not just through this pandemic, but over the last several years, is the so-called reversal rate, when rates go beyond a certain level and become counterproductive. Professor, what are your thoughts on that concept?
It's an interesting idea, and the basic idea is that when rates are very low, it damages the profitability of the banking sector, makes it harder for banks to lend. It's an interesting idea. I would say an idea that I'm more focused on now that's related is, another thing that can make it hard for the banks to lend is when their capital position is badly impaired. And in that vein, while I think the Fed has done basically an admirable job, and I really want to applaud the Fed and Chair Powell, I think they've, on a number of dimensions, have really risen to the moment. One concern I have is that they've been more passive with respect to the banking system than you would ideally like. A number of other countries have gotten their banks to stop paying dividends, to conserve capital. The bigger thing that I worry about for the banking system now is not the reversal interest rate, but as we saw last time around the global financial crisis, they take a big enough hit to their capital, they're going to be very impaired in their ability to lend at any interest rate. And I think
Professor, pretty much every CEO that would come on a program like this would probably tell us that their capital position is strong and they can afford their capital return programs. They've suspended their buybacks and they can meet their dividends. What is it about the big banks on Wall Street that you think maybe some people are missing?
Well, I think it's good to remember the lessons from last time around. So if you think about the financial crisis last time, the banks paid, I would say, something like over $100 billion in share repurchases and dividends between mid-2007 and Lehman. Didn't really raise a lot of capital, didn't really get to raising equity capital until after the stress test period. So things deteriorate, and they deteriorate not necessarily immediately all at once. I think here the market is trying to tell us something, as it did last time around. Bank stocks probably down. Bank stock index, I'm going to say, is down about 35%, relative to an S&P that's down only a handful of percent year to date. Last time around, the market was pretty good at being forward-looking. Those banks whose stocks declined the most were the ones that had the biggest loan losses. So I think, this is a very big economic shock. It's a very big economic shock. The conventional measures of capitalization that banks look at are accounting-based. They tend to be backward-looking. If you look at more forward-looking indicators, I think there's reason. And I wouldn't even say it's the baseline expectation, but is there a tail whereby you should be seriously concerned? I think the answer is probably yes.
Wait, just to be really clear here, Professor, are you saying that the risk of a banking failure is greater than the Federal Reserve is acknowledging right now?
Okay, I wouldn't use the word failure. I think the banks are well enough capitalized that that's not something even in a sort of tail scenario. But, well before failure, if they lose 300, 400, 500 basis points of capital, that seriously impairs their ability to lend. And so back to this sort of concept of the reversal interest rate, again, the bigger constraint on their lending will be a shock. Again, it can be a moderate and not catastrophic shock to their capital. But if you're thinking about, what will help the recovery in the next year, having a strongly capitalized banking sector, I think, will be, one of the more important elements.
Professor Stein, we're talking about some of the consequences of the Fed's policies. And you have the potential oversight of banks on one hand, and on the other hand, you have a question of capital efficiency. And I know you've done a lot of work on this. A lot of people saying it doesn't make sense for Hertz to be bankrupt, for people to be buying its shares, and now to be potentially raising additional money and selling more shares. It just seems like the market is getting less efficient as rates go down and people look at the Fed as a perpetual backstop. What is the consequence of the lack of efficiency that a lot of people are talking about in markets?
Well, I think, Mark, there's an old saying that markets are, I think this goes to Paul Samuelson, that markets are macro inefficient, but micro efficient. And I think you see some of that now. I would not want to try to even begin to explain the overall level of the market. But again, if you look at individual companies, there's some logic there. As I said, in the banking sector being one example, I think the relative performance of bank stocks tells you something. I think even within bank stocks, we're seeing those that are most consumer exposed being hit the hardest. And I think there's some, so I'm not sure I buy the idea that all the sort of micro efficiency has been taken out of the market.
Jeremy Stein, I want to go against your expertise in finance right now as a representative of Harvard economics and all of that heritage. Of course, we speak to Ken Rogoff and to Benjamin Friedman and back through Marty Feldstein. You lost a giant here in this tragic summer and Alberto Alessina. How will you replace the unreplaceable of Alberto Alessina? How do you replace that beautiful holistics of political economics that Professor Alessina did?
Wow. Okay. I was not expecting that question. That's a very moving question. You know, it's just a heartbreaking loss for our department. And as you say, Tom, it's going to be hard to very, very hard, impossible to replace him in terms of what he brought as a researcher. I mean, this was a guy who was doing really Nobel caliber work, founded the modern field of political economy in many ways. But, you know, I sat in the office basically next to him for 20 years. So when you raise the question, I'm sort of not quite thinking of that. I'm just thinking of one of the warmest, kindest, most generous colleagues I've had. And, you know, in talking to others in our department, when they think of, you know, what we've lost and how we'll miss him, it's the personal that sort of everybody seems to speak to.
Jeremy Stein, thank you so much for joining Bloomberg Surveillance today. He is at Harvard University. John, I look at the markets and I just think it's thrilling that we take that time to look at the underlying theories. I have Markowitz's original book on my desk back at 731 Lexington. It's foundational mathematics that Professor Stein represents. And that's what Ed Hyman, that's what Mohamed El-Erian, that's what many others read and think. And that's the foundational thinking, John, of what they do every day.
You know, Tom, I once had lunch with a former Fed official, and we talked about your interviewing style and how you cite economists and their work and the pages and the chapters. And the former Fed official, of course, a Fed official I won't name, turned around to me and said, you know what's really interesting? As random as it sounds, it does sound like he's actually read the books. So, Tom, I just wanted to throw that out there just in case some people think that maybe you haven't read the books. Equity futures this morning up 51 points on the S&P 500. We're up by 1.7%. We advance, we snap back. It has been really, really volatile over the last couple of days. But as Tom said this morning, really the bulls undeterred by the price action of yesterday and just pick up where they left off this morning. We advance in the bond market. Treasury yields, they advance too, though they are down hard on the week, up 4 basis points on a session to 0.71%. And in foreign exchange, just a weaker dollar story emerging over the last month or so. It continues this morning with the euro up by 0.1% and the pound stronger by a couple of 0.1% as well. Later on this program, we'll be catching up with Mohamed El-Erian in a conversation you don't want to miss. And next, we'll catch up with New York's Lieutenant Governor on reopening the economy in New York City. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. This is Bloomberg Surveillance, live on Bloomberg TV and Bloomberg Radio.
With the First Word News, I'm Ritika Gupta. The city of Houston warns that the coronavirus has, unquote, the precipice of a disaster. Officials are getting close to reimposing stay-at-home orders. Earlier this week, Texas recorded its highest one-day tally of new cases since the pandemic emerged. The state has been amongst those pushing hardest to ease lockdowns imposed during the first wave of the disease. The Republican Party is moving key parts of its August nominating convention to Jacksonville, Florida. The event had been scheduled for Charlotte, North Carolina, but the state's governor had refused a request by President Trump. The president wanted the governor to lift all coronavirus social distancing measures, such as mandatory face masks. European leaders want to avoid getting boxed in by President Trump over China. The president hosts the Group of Seven summit this year, and he's entitled to invite whoever he wants. He's been musing about inviting the leaders of Russia, India, and Australia, but not China. European diplomats say that's a clear sign the summit could be turned into part of the president's anti-China campaign, and they don't want to play along. And the UK plans to have a light-touch customs regime at its border with the European Union next year. That's even if there's a no-deal Brexit. British authorities are trying to avoid adding burdens to businesses already struggling with the impact of the coronavirus. The new border policy emerged after the UK and the EU agreed to step up the pace of their trade talks. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I want the reopening to be successful. I want the economy to be resilient, but I'm growing increasingly concerned that we may be approaching the precipice of a disaster.
Harris County Judge Hidalgo, the highest ranking county executive down in Texas in that region. Tom Keene, a controversial statement and unclear whether they have the legal authority to reimpose lockdown, stay-at-home orders in Houston. And I think that's going to be an interesting conversation through the weekend into next week.
Right. I think it's so important, folks, to understand that within the Bloomberg surveillance world of London, with the mayor and with the prime minister, or in the world of New York and even New Jersey with the lieutenant governor and the governor, it's nothing like the tensions that you see across the Sun Belt of America, where there's massive tensions between some of these city authorities and the more statewide executive offices. John, it's incalculable, the gap there in Arizona, in New Mexico, in Texas as well.
Yeah, the tension between the local officials and the governor, Governor Abbott down in Texas, which we'll be discussing in just a moment. From New York this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Lisa Bramberts, we're live on Bloomberg TV and on Bloomberg Radio. Just to whip through the price action for you as we get you set up for the trading day this Friday morning. Equities do snap back. They advance on the S&P 500, up by 51 points. We're up by 1.7%, just fading from session highs, but still nicely firm this morning. In the bond market, Treasuries lower, yields higher, the curve steeper, your 10-year maturity up by 3, call it 4 basis points. We'll round this one up, Tom, to 0.71%. And in foreign exchange, just a little bit of dollar weakness making a comeback in G10.
For Lisa, John, and I, folks, there have been benchmarks through this pandemic, and one of them has been good, informed, and intelligent conversations with the lieutenant governor of the Empire State. Kathy Hochul joins us again for an update, a briefing. Kathy, let me give you the safe general question first. How is the reopening of the state from Buffalo to New York and out to the Hamptons? How's it going?
Thank you for having me on the show again. It is going phenomenally well. And I say that not just from my position as Lieutenant Governor, but as someone who literally as recently as yesterday walked the streets. I was in Niagara Falls. I was in Lockport. The day before I was in Rochester. And there is such an excitement about reopening and an energy on the streets that I am actually shocked to see, because I thought people would be more sort of depressed and in a dark place after what they've had to endure. And the truth is, this just demonstrates the resiliency of New Yorkers. So the reopening is going well. We've not had complaints. As we reopen, though, we are very closely monitoring our health outcomes and the rate of transmission and our hospitalizations. And if you look at the charts every single day, as I do and the governor does, you'll see an incredible downward trajectory, unlike what we're seeing elsewhere in this country. So the opening is going well. We're in phase 1 in New York City. Most of upstate is now, as of today, just today, is now in phase 3, which is restaurants and more personal services. So people are feeling a sense of normalcy, except they know that it only continues if we keep social distancing and wearing the mask. And all the business owners have been really great about complying.
Lieutenant Governor, perhaps they're in a dark place and they're turning to retail therapy to soothe some of those feelings. I am curious about threading this needle of encouraging people to go back out there and embrace the economy while also practicing social distancing and some of these other measures. How much are you trying to encourage people to come back, and how much are you able to deploy tracers, trackers, to really make sure that people are not super spreaders at this point? We don't see a big resurgence of the virus.
You have hit on exactly the answer to the problem that I'm not seeing going on in the other states that opened even before New York did. And some people criticize us for taking too slow of an approach. Well, we were not going to send a message that any part of the state could open until we listened to not just national experts, but global healthcare experts who've enlisted from London to assist us in analyzing the data to make sure we don't cross that line between risk and reward. We've always wanted to make sure that we are doing this in a smart way. But the answer is testing, and there is no state in the nation that tests more people than we do here in the state of New York, over 50,000, sometimes 65,000 a day. And what happens after the testing is that information goes directly to our contact tracers, an army of individuals, and we thank former Mayor Bloomberg for his assistance with the state of New York, working with our Governor Andrew Cuomo to bring in the resources to allow us to have individuals trained, have them in every corner of the state, even the most rural areas. And I oversee the reopening even in Western New York, the second largest city of Buffalo. But we have incredibly rural areas, small towns, and we have contact tracers ready to jump if anyone tests positive, even in the furthest corner of states down in Allegheny County, Chautauqua County, up in Plattsburgh. So that is what other states should be doing, and that is how we can get control over this virus. And what's frustrating to us in New York is we figured this out. We have led the nation in terms of how we've managed this pandemic. No one has done a better job than Governor Cuomo. And if the other states simply followed our lead, they'd be in a far better place today, because we're going to continue reopening in a smart way based on healthcare data, but we're going to do it.
You mentioned former Mayor Mike Bloomberg, of course, the parent company, Bloomberg LP. He was the founder, majority owner, still is, of course, of Bloomberg LP, the parent company of Bloomberg News. Lieutenant Governor, just to continue the conversation, there is clearly some tension down in Texas. I've spoken to the administration, and they've suggested to me that the bar is higher for another lockdown. Quite clearly, you've suggested that to us as well in the last several weeks too. I'm just wondering if you can establish some guardrails for us, the kind of data that you would need to see to reconsider locking things down again.
Well, we've said we don't expect to go there. And again, this is why we did it right in the state of New York. And I can't emphasize that enough, that there was another alternative, which was to listen to the many voices who were saying, you know, we're short on revenues. Our counties can't function. You know, the state of New York is in dire straits in terms of the loss of revenue coming in during this 3.5-month period. But we are never going to sacrifice people's lives and public health. And so what people have to look at, when you can go right to forward.ny.gov, you can literally pull up regional dashboards to see the metrics that we're examining. And the one that's most important now is the rate of transmission and how we can determine what the testing rates are showing. And if you look at a place like Western New York, a few weeks ago, it was 9% of people were testing positive. That number is now 0.8%. That's extraordinary. And you look at New York City, where we had 25% testing positive not long ago, and the numbers are down to 1%, 2%, 3% higher in certain neighborhoods that we're putting a laser focus on. Communities of color have been harder hit, and that's why we have even more testing and contact tracers deployed there. But it's not that hard. We followed what the Centers for Disease Control had recommended early on in terms of the phasing. I mean, these guidelines have been out there, but very few states were enlightened enough to actually follow them. And so we're feeling not overconfident, but a sense of confidence that this is the right path to be on, and we're going to continue here. And if we see a change in the numbers that are alarming, and that's what all of our regional control rooms do, we're watching every corner of the state, then we'll talk about whether or not we enter the next phase. But thus far, we've not had any holdups. The numbers keep going down.
New York's Lieutenant Governor on some better news. Kathy, hopefully we can catch up with you soon on some more better news here in New York. From New York City this morning, good morning to you all. Up next, Mohammed Al-Arian on this equity market, on this global economy, next on Bloomberg Surveillance.
New York City is set to reopen this week, but many big retailers may choose to sit it out. Governor Andrew Cuomo says stores can start offering curbside pickup after being closed for months. Big retailers like Coach and Gap have already rolled out that service in other parts of the U.S., but they said they're still evaluating what they'll do in New York City. New York City is the epicenter of the coronavirus outbreak in the U.S., and in recent days, demonstrators have taken to city streets to protest police killings of African American men and women. Some store locations have been damaged, and other companies have responded by boarding up their storefronts. For mom and pop shops, opening up is the only way that they'll stay alive. They don't have the luxury of turning to other markets in the U.S. for sales. So, many are looking at the only available option they have, curbside pickup. Curbside pickup has its challenges too. Shoppers are entering the store, so the chances of an impulse buy may be lower. Plus, it's not clear if city dwellers will adopt it as quickly as someone in the suburbs who has access to a car and parking lots. In the country with the most retail selling space, reopening in America's biggest city is crucial to survival. But in the age of the coronavirus, civil unrest, and economic uncertainty, considerations need to be made for what shoppers want from their store experience.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The market's trying to test the Fed to see how accommodative will they be, or are they okay with rates being higher?
There is no free lunch. Somebody will have to pay.
The way markets are looking at dividends and returns and earnings has been a little bit over the top.
If you look at what the pandemic has done, it has exacerbated every division we had.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We are thrilled you're with us after the market turmoil of yesterday. Good conversation forward to set up your Friday, and certainly with futures doing better than the carnage of yesterday. A good feeling here. Mohammed El-Arian will join us here in moments. And John, with that, to get to Dr. El-Arian as soon as we can, certainly a nice rebound. John, what did you see in the literature overnight about a bull or a bear market reversal?
Well, I think we've got to work out, Tom, what the big driver of this market is. And as I mentioned in the last hour, the big driver over the last several weeks has just been the sequential month-on-month, week-on-week improvement we've seen. The latter issue is the one I think we should focus a little bit more on in the weeks to come, though. The limits of normalization, the limits of the recovery. And I think the pandemic data at a state level in several states in America this week were a stark reminder of why that is an important thing to keep in mind in this market.
Lisa Abramowitz, the bond market yesterday I found fascinating, particularly the separation of IG investment grade from real tangible carnage and high yield. What signals did you see there?
Well, first of all, you had oil prices tumbling the most since April, right? So that was a main driver of some of the distress that we saw in the high yield space. But all through the market, you saw this real grab for cash, a sort of return to what we saw in March. You saw the dollar surge. You saw gold decline, which I thought was fascinating. This whole idea, people looking for cash in order to offset risk positions, which raises a question again, Tom. My big question, what does this say about the Fed's ability to dampen volatility going forward? Yes, this is just one day, and yet they have thrown the kitchen sink at this market, and you are still seeing some of these, I don't know, squeezes that we saw back in March.
Yeah. Interesting dynamics, and of course, all of us folks overwhelmed by so many cross currents, so many events, including, as Jonathan mentioned there, the pandemic, the new news, the new iterative news, if you will, of this terrible virus. He has been hugely visible, persistently prolific, but Mohamed El-Erian always writing smartly about economics, finance, and investment from his core foundation of game theory. We're thrilled that Dr. El-Erian could join us this morning. Of course, writing too often for Bloomberg Opinion, he will take up a modest position at Cambridge University in the autumn months. Mohamed, wonderful to have you with us. Everybody out there right now has to make a T decision of do they want to play in the markets, or in fear, do they want to remove themselves from the markets? How do you approach that T decision?
Good morning, Tom, and good morning for having me. Look, it fundamentally comes down to how you feel about the disconnect between finance and the economy. If you believe, like I do, that ultimately fundamentals will assert themselves, then you are more cautious about this market, and you're worried not just about the level of the market, but you're starting to get worried also about relative pricing. If, however, you believe that technicals, call them FOMO, the fear of missing out, call them TINA, there is no alternative, and if you believe that central banks will continue to protect every asset, then you can participate in this market on the long side, regardless of fundamentals. So it really comes down to how wedded are you that fundamentals matter.
So, Mohamed, let's talk about the fundamentals. You and I have discussed this now for several weeks. What matters? The initial improvement, sequentially, month on month, week on week, or the overall limits of the recovery, the limits of normalization? There's just a real push and pull there. One of those things will be a dominant driver for quite a while. Which one is it?
So it's now both because of the level of the marketplace. So in the beginning, it was about the sequential improvement. And markets got reinforcement of sequentially improving situation on health and therefore on the economy. And markets got carried away. So now the implicit valuation is that not only will the journey be a pleasant one, but you're also certain about the destination. And what we've been getting over the last couple of days are legitimate questions, both about the journey and the destination. What we haven't been getting is any question mark about central bank support that is consistent and strong, nor really about market fundamentals, market technicals. You see it again today. The buy the dip mentality, the conditioning to buy the dip is very deeply embedded in this market.
Scarring, Mohamed. Scarring is something I want to talk about with you. The IMF mentioned that in the last 24 hours. The permanent job losses, the bankruptcies, the sectors that just won't come back 100%. I've got a headline crossing a Bloomberg terminal right now that American Airlines sees second quarter revenue decline of about 90%, capacity down 75% in the second quarter. Have you got your hands around the amount of scarring that we will have coming out of the other side of this pandemic?
Yes, more on the supply side than on the demand side. So on the supply side, we're going to see hits to both productivity on the capital side and on the labor side. We are going to see a process of deglobalization that is driven by households, governments, and the corporate sector. And the result of that, absent, and I want to stress, there's nothing predestined, depends on policies, but absent policies to improve productivity will be lower productivity and lower growth. And that's what you hear from the IMF, you heard it from the OECD, you heard it from the World Bank. What's more uncertain is the demand side, John. We don't know what's going to happen to people's marginal propensity to consume. How willing will people be to spend money how willing will people be to continue behavior that the U.S. consumer has been so good at, which is drive the economy? Will we come out with a more frugal society or not? That's still a question mark.
Mohammed, I want to talk about this decline in productivity and growth that you're talking about, paired with the question marks around demand and deglobalization, which a lot of people think will actually be inflationary, because if you bring supply chains home, you won't necessarily capture the efficiencies of cost that some of the globalization did. I'm wondering, does this feel like a stagflationary environment? Is that what you're portraying here?
Well, you do have two inflationary pressures. One is simply the rewiring of supply chains and the inefficiencies that come with that. And the other one is we are seeing, Lisa, significant increase in industrial concentration. The big firms are getting bigger, and we're losing the mid-size and the small firm. However, to translate that into a stagflationary projection, to say inflation will result, means that you have a view on demand. And as I said earlier, the demand side is really uncertain right now.
Mohammed, you are going to go to Cambridge, and the legacy there of all this mathematics and foundational theory is Frank Ramsey, who we lost at a shockingly young age, distant ago. Right now, our foundations are being shaken to the ground. We've got a pandemic. We've got the shocks of this economy and really original economics and monetary theory. Do you understand the foundations right now that we're standing on, or is the mathematics broken?
Look, we're dealing with unusual uncertainty, to use Ben Bernanke's term, or radical uncertainty, to use Marvin King. So the structure of the economy is in play. And as you know, when the structure of the economy is in play, you've got to bring in many elements of economics, of behavioral finance, of game theory to try to understand what's going on. I keep on stressing to people, the most important thing right now is not what you think, but how you think. It is this ability to bring in a multidisciplinary approach to try and figure out what are the key questions and what you should be monitoring. And talking about monitoring, look, Tom, even the data that you and I look at these days is completely different from 4 months ago. We didn't look at mobility data. We didn't look at restaurant booking data. But that's what we're looking at right now to try and understand what's going on. So I think it's a different challenge. What is exciting for economists is they have the tools, but they have to make sure that they adapt accordingly.
So, Mohammed, let's just finish there. The data point that you are laser focused on at the moment, the high frequency data maybe, what is it?
So I look, like everybody else, at the high frequency data. So I look at mobility data, certainly at health data. I look at infections. I look at hospitalization. I look at how is the individual household interacting with the economy. Travel data. I mean, we're just trying to get a notion of three things, John. One is, what is the health situation? Two is, are households engaging? And three is, are companies engaging? Remember, it's these three things. It's not just health, because there are people who are risk-loving, there are people who are risk-averse, who react differently to health indicators. So we've got to keep all three under close monitoring, and they'll give you some feel for how we are going through this journey. It is going to be a check mark. It's not going to be a sharp V, and it's going to be one subject to a lot of volatility.
Mohammed, always great to catch up with you. 5:10 on the West Coast. Can you apologize to the family on our behalf if we've woken them up with this interview? Mohammed Al-Arian of Bloomberg Opinion on this market, this global economy with equity futures just off the highs, Tom. Still positive, 45 points, up 1.5%. But I think a reminder over the last week after that blowout payrolls report this time last week, there was always that risk of extrapolating out that improvement too far too quickly. And I think the data this week supports that risk. We've got to be very careful about doing that in the weeks to come. We're going to have some really choppy data, some bumpy figures one way and the other.
There's no question about it. I mean, the data comes in. I loved what Dr. Al-Arian said there about the need to be multidisciplinary. I just can't say enough, John. Of course, I'm talking my own book here, but I really, really believe mentally the way to survive through this is to have an exceptionally holistic reach over all these different themes that we talk about. The avenue of a specialist right now is really difficult.
I can only imagine how great the inflows were into the Tom Keene Triple Leverage Cash Fund in yesterday's session, Tom. I'm sure you were overwhelmed with money pouring in from New York City this morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. This is Bloomberg Surveillance, and we're live on Bloomberg TV and Bloomberg Radio.
With the First Word News, I'm Rishika Gupta. There's never been a month as bad as April for the British economy. The UK says GDP fell more than 20% as the coronavirus lockdown took hold. On a 3-month basis, economic output shrank more than 10%. The contraction will prompt louder calls for the British government to ease restrictions on industries trying to survive. The IMF says the global economy is recovering more slowly than expected from the coronavirus, and the fund expects it will have lingering scars from that experience. The IMF will release economic growth projections June 24th. It expects them to be worse than the last forecasts that were delivered in April. The IMF says that in general, Asian economies are further along the recovery path. President Trump is rejecting calls to overhaul law enforcement or cut police funding. He says a strong economy will be the fix for racial injustice. The president is working on an executive order that he says asks police to meet the most current standards for the use of force, but there are few details on what that program would look like. And Zoom says China demanded it deactivate the accounts of pro-democracy Chinese activists based in the US. The company shut down video conferences to commemorate the Tiananmen Square protests. Zoom says from now on it won't allow any requests from the Chinese government to impact anyone outside of mainland China. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
You think of where equities bottomed out at and how fast and explosive they've rebounded. They clearly got overextended. And a lot of that has to do, of course, with the Fed's easy money policy, which is increased money supply by levels that no one could have dreamed of.
Troy Gayeski of Skybridge Capital, the co-CIO, joining this program in the last hour from New York City this morning. Good morning to you all. This is Bloomberg Surveillance, live on Bloomberg TV and on Bloomberg Radio. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz, 1 hour and 12 minutes away from the opening bell in New York. We advance on the S&P 500, though we do start to fade going into the cash open. We were positive by around about 2.1, 2.2% at the highs. We're now up by 1.4% and up by around about 42 points. Just a little fade of session highs in the last hour or so. In the bond market, Treasury still softer, lower, yields higher by just 3 basis points now to 0.7%. And in foreign exchange, the story as follows. The outperformance, talked about this through the morning, really. The Aussie on top, the Aussie positive by several tenths of 1%. Tom Keene, risk appetite improving from yesterday, though I should stress, as the session grows older, we do give just a little bit of that up, just a little bit in the last hour or so.
I agree. In the last hour and a half, it's given up a little bit. But, John, I would really emphasize, first thing I did this morning, folks, on the Bloomberg terminal, as I went and looked at standard deviation studies of the market move, and we forget how far we came, how quickly, and the damage done yesterday wasn't nearly as bad as I thought I would see on the Bloomberg screen. John Ferro knows that, say, Steve Major at HSBC has not only got the low-yield call right once, or twice or 3 times, but has really been extraordinary about just nailing the longer-term bond call. Somewhat equivalent in the equity markets is Benjamin Laidler of Tower Hudson. He was brilliant in December of 2018, I believe it was, and he has been shockingly on in the last number of weeks. I read his morning note, and he re-emphasizes optimism after what we saw yesterday. We're thrilled he could find time to be with us this morning. Ben Laidler, what is the nuance now in a long-term equity long call? What is the distinction right now that keeps you enthusiastic?
So this rally that we've had so far has all been about sort of valuations expanding, and I think now we're rotating and we're looking at earnings that need to come through to validate the move that we've had, which, as you say, 44% in 10 weeks is shocking, and valuations, which, you know, I don't think they're maybe as high as people think, but optically we do have a 12-month forward PE of north of 20 times, which is it's obviously a pretty big number. But I think what we're maybe missing here is that earnings are troughing. Markets historically run 3 to 4 months ahead of earnings. So I think, you know, we're sort of on track there. And I think the key is this sort of incremental momentum data of restrictions loosening, activity picking up, and you know, let's keep a vaccine development at the back of our minds here. But from now, it's the earnings. If markets are going to move higher, it needs to be on the earnings. We've had the multiple re-rating. You know, we're pretty comfortable that that's going to come through, but that's what we're focused on.
Well, Ben, let's focus on that with you then. Let's build on that just a little bit. As you point out, it is perfectly natural going in and coming out of a recession to see the multiple expand and extend in the way we've seen over the last month or so. We need to see, as you've pointed out, earnings revision develop positively, so we look at a more robust PE, something that people wouldn't describe as extended or overvalued. Where do you expect to see that improvement? Where are you comfortable on a day like today to say, you know what, I expect earnings revisions to improve in sector X, Y, and Z?
So 2 things. One, this is an incredibly bifurcated market, right? I mean, half your S&P 500 has had its earnings cut by 5% or less. And these are the quality growth names, which I still like, tech, healthcare. You know, we've talked before, I think they're going to come out of this crisis a lot stronger than they went in. They have no debt. They have very high ROEs. They can do very well in a sort of lower for longer growth and rates world. And the other half of the index earnings are down, you know, more than 40%, right? So it's incredibly bifurcated. And it's that 40%, it's that 50% of the index with those slashed earnings, which are super sensitive to this sort of triple momentum that I think we have here, again, of loosening restrictions, reactivating activity off a very low base, And again, the sort of holy grail, if you like, of one of these clinical trials or one of these vaccines coming through. So we're running a balanced portfolio. We do like these sort of quality growth names, but we're also being, selectively picking up these sort of deeply depressed sort of cyclicals. So real estate, small cap, some consumer durables. I mean, I think, you've got to pick your way carefully there. As you said in the previous segment, some of these segments, may not be coming back. But I think a lot of them are, and a lot of the earnings are very depressed, and you're going to see a big upgrade cycle.
Ben, how do you strip out the noise from the fundamentals at a time when you have Robinhood traders that people are blaming for the likes of Hertz shares surging 900% and then falling, or JCPenney or Chesapeake, bankrupt companies, seeing their shares rise? How much noise is this?
Yeah, I do think that is noise because, one of the less fundamental supports of this rally is just how cautious people are. Now, there are different ways of measuring that, but, the VIX just went up 50% yesterday. You've had 1 week of equity inflows in the last 6. You have an extra $1 trillion went into money market funds over the last 3 months. There's enough signs out there that this is not a super bullish market or a super bullish investor backdrop. I think that, there is a support there. And we've talked before about, fear of missing out and everything else. So I think that's a component. But again, let's not lose sight of the fundamentals here. Earnings are, at least for 50% of the index, are incredibly depressed and are beginning to move back here. Earnings for the other 50%, I think, are almost bulletproof. And valuations, I actually don't think they're as expensive as people think. I mean, PE is the outlier. Everything else, I think, looks a lot more reasonable.
Ben Laidler of Tower Hudson Research. Ben, fantastic to catch up with you. That's the constructive outlook. We're in a market, 2 views. That is the positive, more optimistic outlook for this equity market. Equity futures this morning up 49 points on the S&P 500. Lisa, you mentioned Hertz. Can you imagine a company going through bankruptcy, looking to raise $1 billion in a share sale? That is how peculiar things are at the moment, and that is not just something we're talking about hypothetically. That is something that we might actually experience.
This is one of the best stories of the week of 2020, frankly. It highlights 2020. They're basically saying, look, people are willing to buy our shares, so why not raise some money from the equity markets, because that's a lot cheaper and better financing than a debtor's in possession loan. This is unprecedented, John, as far as I can tell. A lot of people were looking for any historical reference for this. We can't find it.
I'd be very worried, Tom, about the people funding that particular share sale. I don't want to offer a personal view on this, but let's just talk away from a single name. I don't know if you want to be sitting at the bottom of the capital structure in a company that's about to be going through bankruptcy proceedings.
I am not informed. I am pleased to say that, but I will say, John, I agree with you. All my radar is up. No other way to put it.
From New York City this morning, good morning to you all. Up 51 points on the S&P 500. We advanced 1.7%. From New York City this morning, good morning to you all. The opening bell 1 hour away. A more constructive outlook on this market. In the bond market, we've had a steeper curve over the last several weeks. Flatter, lower yields through this week so far. Up next on the program, we will get the view from Matt Hornbach of Morgan Stanley on this bond market and why this curve might start shifting higher, steeper once again. That conversation is coming up next from New York this morning. This is Bloomberg Surveillance.
surprising. It surprised to me. It sounds like a horse riding, you know, and it's okay.
Excitement, a lot of excitement. Like the kids especially love the robots. It's a very new thing, I think, and it came at a right time where social distancing is a safety measure right now. So they're robots, not people, you know, so it's like interacting with robots can help a lot at this time. I think it teaches people that technology can really have an impact on everyday life. So for example, these robots are in like a shopping center where I feel like everyone comes here. So it's incorporated into people's lifestyles and how it can make people's lives convenient and more productive, more effective.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and Bloomberg Radio. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz, getting you prepared for the market open 1 hour away from the opening bell in New York City. Equity futures snap back, up 49 points on the S&P 500, positive 1.64%. That's the story in equities. No place to hide in this equity market yesterday. Every single sector down and down hard, including the more defensive sectors, which were still down about 4% on a session. Outside of equities, in foreign exchange, risk appetite improves as well. The Aussie, the Canadian dollar on top. The commodity currencies doing okay as risk appetite improves. And in the bond market, story of the week, really, going against the grain of the last several weeks. Today, 10-year Treasury yields are higher. The curve is steeper. But on the week, Tom, it has been really interesting to see the 10-year yield come down by about 18 basis points and the curve flatten, 2s to 10s by a similar amount because the 2s are just totally anchored right now on what the Fed is doing, which is nothing for the next several years. It is all about where the 10s go, which will drive the direction, the trajectory of this yield curve.
And the phrase you use, folks, is you put a foot on the 2-year yield and the other stuff gyrates around. It will be a very interesting June and July for fixed income. All sorts of themes buffeting. Matthew Hornbach joins us right now from Morgan Stanley on fixed income. Matt, I love the idea of your heritage of working off the yen desk for Morgan Stanley in Tokyo. So it's a bond prism that you bring that's decidedly international. All my radar is on the 2-year yield because it is assumed it will stay pegged. Will it?
Tom, well, thanks for having me on. I think for now, yeah, the answer is yes. It's going to remain pegged. Chairman Powell made it quite clear in his commentary earlier this week that the Fed had no intention of raising rates for the foreseeable future, and it's quite a long future ahead of us. I think the Fed is going to keep rates on hold at least for the next couple of years, and so that would align very nicely with the low level and low volatility that we're seeing in the 2-year yield today.
So, Matt, what we've got to discuss then, debate, is what happens down the longer end of the curve. And one of two things can happen. Either the longer end of the curve sells off, or it gets really firm and yields come lower again. HSBC think the weight of the Fed sits at the front end and just travels through the belly of the curve and out. Other people will say that risk appetite will improve, yields will go higher off the back of increased Treasury supply. Which one is it for Morgan Stanley? How are you thinking about those two opposing forces?
Yeah, John, well, for us, it's neither really. I think the oncoming supply that everybody is well aware of is not really going to have a dramatic impact on the level of yields. I think to the extent that we get some surprises in Treasury issuance down the road, whereby perhaps the Treasury issues more in the back end of the curve than people are expecting, that could weigh on prices of long maturity bonds. So you could have a bit of a steepening in the yield curve on the back of surprises in where the Treasury issues. But in terms of the total size of issuance, I think that's well understood and is not going to have an impact on yields. To me, what the most important thing is going forward is how data perform relative to people's rather somber expectations for data. Our perspective, or coming out of our economics group, Chetnaya, our global economist, believes that we are going to have better data than most people are expecting. And I think if that's what ends up happening, you are going to see upward pressure on yields in the back end of the curve. You will see break-even inflation rates expand alongside that upside surprise in economic data. And we will have a steeper curve at the end of the year. But we need to get better data, and that is going to be the real focal point for us.
Matt, let's sit on this for a second. This is really important, the idea that 10-year, 30-year Treasury yields could rise significantly or materially from here on better data, because right now what we're pricing in is something pretty bleak. How high could those yields go before we start talking about yield curve control and the Fed needing to monetize more of the debt in order to keep borrowing costs low for the United States?
Yeah, so I think you'd have to see the 10-year yield north of 1% for it to start showing up on the Fed's radar. Having said that, it's not clear to me that you're going to get the 5-year sector of the curve or the 3-year sector of the curve participating dramatically in that type of a sell-off. I think you'd get a pretty decent bear steepening in the 5s, 10s, or 3s, 10s yield curve. If we do get that type of a rise in rates. So it's not clear to me that the Fed is going to have to go down the road of yield curve caps. In fact, I think that they would rather avoid it, given the risks that come along with yield curve caps and the fact that they can achieve a similar outcome as capping yields by just putting in place some very clear forward guidance. I think that is ultimately what they end up going with. And avoiding the whole issue of yield curve caps, which are unnecessary in my view.
So, Matt, let's talk a little bit more about Morgan Stanley's view, which has been pretty constructive and, frankly, has been right for a lot of the year, to be very fair. I'm wondering if you look at credit, and corporate credit in particular, at a time when leverage ratios are picking up and the fundamental backdrop for them is looking worse on a balance sheet level. Are you still seeing opportunities lower down the risk spectrum right now, given the valuations we have priced in?
Lisa, we've had an up in quality stance to our credit allocation for some time, and it's obviously served our clients well. I think going forward, the issue that we're wrestling with is to what extent are markets going to lead the economy out of recession? And what we've seen certainly in the equity space is that's happened, right? We've had a dramatic outperformance of equities, save for, of course, the past couple of days. But that has led economic data surprises for a couple of months now. I think the other thing you need to remember is that all forms of government, the central banks around the world, governing bodies around the world, are making it their mission to add stimulus where and when it is needed. And they've done it at an unprecedented pace and size. And that is worth something in a fiat currency system, which is the one in which we're operating. We're no longer in a gold-backed currency system. You need to think about how central banks and central governments actually impact liquidity and asset prices. And they are inflating them And that is part of what is influencing markets today.
Then how do you, Matt Hornbach, and Mike Wilson manage the inflated asset balloon on its way to a bubble? How do you manage that for institutional and retail money?
Well, Tom, the first thing we tell people is that this is not a bubble. I mean, I suppose a bubble is in the eye of the beholder, but people have been calling the government bond market a bubble for the 20 years that I've been at Morgan Stanley.
Yes, true.
And it clearly is not a bubble. This is how the system works. And so it's not, we start by telling investors it's not a bubble. We also tell investors that there are limited opportunities to harvest risk premiums given this approach from central banks and governments around the world. We saw ample risk premium in March, and our chief U.S. equity strategist, Mike Wilson, recommended that people take advantage and harvest that risk premium. And as we've seen so far, that was the right advice.
Matt, we won't debate whether this is a bubble, but I'm sure we can all agree that this is a highly distorted market across several assets. When you introduce a price-insensitive buyer into any asset class, that would distort the market. When you introduce a price-insensitive buyer with the scale that the Federal Reserve is doing across a range of asset classes now that goes beyond just sovereigns and into credit, and when you see the same thing happening in Europe, in European markets, you see the same thing happening in Japan, we can all sit here, can't we, Matt? We can agree. We're all friends. We can all say this is a highly distorted market. There is nothing normal about this. The only thing we can say is normal, I guess, is that we've experienced it now for a long, long time.
That's right, John. And look, the globe is dealing with a wide variety of issues, and these issues are important to every person on the planet. We're all striving for a better life together. And I think what we've seen in terms of the demographic trends is that they have not necessarily been helpful for generating organic economic growth. And in that environment, we need our elected officials to support that type of growth. And that's what they are doing. And so we just have to sit back and recognize what's going on. And I think for investors, right, we need to deal with the game that we are playing, not the game that we want to be playing or that we think we should be playing. We have to deal with the game that we are actually playing. And that is our approach, is to figure out the rules of the game, play by those rules, give investors the best advice we can. And that's our main goal at Morgan Stanley Research.
Matt Hornbach of Morgan Stanley. Matt, always appreciate your honesty, your transparency. Fantastic to catch up with you, as always. The President of the United States, always difficult to interpret these things, Tom. This is not a presidential tweet. It is a presidential retweet, and the content of that tweet calls for Microsoft to be banned from federal contracts. Now, we saw some controversy with Amazon and a contract with the Pentagon in the last couple of years as well. And now the president retweeting a tweet which is talking about Microsoft being banned from federal contracts. Now, as I say, there's a clear nuance here. It's not a presidential tweet, Tom. It is a retweet. That is the world we live in right now, trying to just comb through the nuances of presidential statements.
It is certainly a fact, John. The retweets are much harder to interpret than maybe the stuff that we believe is actually written. I would suggest in Washington, the land of Kevin Cirilli right now, what they're really looking for are tweets from the president on the chairman of the Joint Chiefs of Staff. That's maybe widely anticipated on this Friday.
What do they say, Tom? Not all retweets are endorsements necessarily. So I think maybe someone might have to ask the administration about whether that is an endorsement of that particular stance or not. Anyway, here we are, 21 minutes, in fact, 1 hour away from the opening bell. Call it 45, 50 minutes away from the opening bell. I'll get my clock right. We advanced by 61 points. We advanced on the S&P 500 by around about 2 percentage points. Risk appetite improving this Friday morning after a really choppy session yesterday. Much more still to come as we count you down to the opening bell from New York City this morning. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The city of Houston warns that the coronavirus has it on, quote, the precipice of a disaster. Officials are getting close to reimposing stay-at-home orders. Earlier this week, Texas recorded its highest one-day tally of new cases Since the pandemic emerged, the state has been amongst those pushing hardest to ease lockdowns imposed during the first wave of the disease. The Republican Party is moving key parts of its August nominating convention to Jacksonville, Florida. The event has been scheduled for Charlotte, North Carolina, but the state's governor had refused a request by President Trump. The president wanted the governor to lift all coronavirus social distancing measures, such as mandatory face masks. European leaders want to avoid getting boxed in by President Trump over China. The president hosts the Group of Seven summit this year, and he's entitled to invite whoever he wants. He's been musing about inviting the leaders of Russia, India, and Australia, but not China. European diplomats say that's a clear sign the summit could be turned into part of the president's anti-China campaign, and they don't want to play along. And oil is headed for its first weekly loss since late April. There are fears that a second wave of infections in the U.S. could derail the fragile recovery. The market appears to be discounting a pledge by the OPEC Plus coalition to extend record output cuts. Oil fell more than 8% yesterday. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange. China's slumping onshore bond market is great.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
of us as investors would have expected a second wave, but would have expected it maybe in the fall. This second wave starting, especially here in the US, so early on in the summer is a bit counterintuitive and really a sign that reopening is a very delicate situation.
Alessio De Longis of Invesco weighing in on the increase of infections we're seeing in several states across the United States of America. From New York City this morning, good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. We're live on Bloomberg TV and on Bloomberg Radio. With equity futures elevated going into the opening bell, Tom Keene in the next hour will be catching up with Bob Michael of JP Morgan on this global market. And on the bond market, we'll talk to Kathy Jones of Charles Schwab. Those interviews coming up very shortly on Bloomberg, Tom.
Yeah, it'll be important to drive that conversation forward, not only to the opening folks, but really, how do we close the weekend? Everybody has to settle up for the weekend. It'll be interesting to see, particularly what Mr. Michael sees there as well. What we thought we'd do now, after a real wonderful cross-section of conversations today, Jeremy Stein of Harvard on the complexity of finance as well, Dr. Al-Arian, Ed Hyman, and others, is not take a lighter approach, but look at the agony in New York City of a collapsed restaurant and entertainment business. Andrew Ridgey has been doing this for years with New York hospitality. He is not so much a promoter of the industry as the go-to guy in the 5 boroughs to keep the spirit alive, and he's been doing that for many years. Andrew Ridgey joins us this morning. Andrew, I know you're going to tell me it's bad, it's grim. Let me take an optimistic tack. How quickly can the restaurants recover and open again?
Well, thanks for having me on. You know, that's a tough question. We are looking at all the health metrics. If everything continues to go in the positive direction, which it is, fortunately, in New York City, June 22nd in New York City, we could potentially open for outdoor dining. And then 2 weeks after that, we could potentially open for indoor dining. But this is going to be at reduced occupancy. We don't know what consumer purchasing behavior is going to look like. We have, 1 million people out of work. And when are 70 million tourists who love to come and eat and drink in our restaurants going to come back? So, even when we start reopening in the coming month or so, it's not going to be business as usual.
Andrew, a lot of restaurants have come out and said that they cannot operate with the requirements at hand, given the fact that they just can't turn a profit or even break even. What proportion of restaurants do you expect to be online in the next month, 2 months, given this profitability challenge?
Well, there's more than 25,000 eating and drinking establishments throughout the 5 boroughs in New York City. It's really tough to say what percentage is going to open. Some have stayed open, offering takeout and delivery. Once we're able to open outdoors, which we're hoping will be soon, under a new plan to open up our streets and sidewalks to really reimagine public space to hopefully get some of that lost occupancy indoors, generating sales outdoors. But it's going to be a long time. And as you said, these restaurants are really devastated, and they don't know, once they are permitted to reopen, how long they're going to be able to sustain themselves. Because even pre-pandemic, at 100% occupancy, it was incredibly difficult to, really survive and thrive as a restaurateur.
Andrew, one reason why it's so great to have your perspective is you do speak to so many people in the hospitality industry in New York City. I'm just wondering about the ongoing pain from a lack of tourism and kind of the drag there. What kind of insolvencies, inabilities to continue do you see going forward? How long will it take before the city gets back up to speed with respect to the hospitality industry?
It's going to be a long road to recovery. Depending on where you're located, it's going to depend on how reliant you are on tourism. So if you're in Midtown by Times Square or some other areas, and frankly, over the past couple of years, 10 years even, we've seen so much kind of food tourism where people are traveling through the 5 boroughs to different neighborhoods to go check out really local, authentic, and international cuisine that we have right here in the city. So without those 70 million tourists coming back, and without Broadway reopening, and all of these other hotels, et cetera, it's going to be incredibly tough, and it's going to be a long road.
Yeah, but Andrew, I want to go granular here. And we say good morning to everybody in the greater New York City area listening to us. We can go to the bake shop, the Sugar Bun Bake Shop out in Queens, and talk about people from the seat of their pants who built a bakery and moved it forward. I mean, that's what restaurants have to do each and every day. How does the guy struggling now, going out of business, what do? Do they reform like the Sugar Bun Bake Shop and move it forward? How do you redo it after being crushed like this?
Yeah, Sugar Bun Bake Shop. Listen, my family, going back to my great-grandparents, had bakeries and cafes in Brooklyn, Queens, and then Sugar Bun. You know, it is an incredibly resilient industry. People that go into this industry,
yes.
I mean, they are tough, and they are going to do everything they possibly can do. The challenge here is this is an unprecedented situation where government is telling us we need to shut down by mandate. And when we are permitted to reopen, it's going to be under reduced occupancy. So it's unlike anything we've seen before. That's why we need federal, state, and city support to sustain us until we can get back to some sense of normal operation. But people are looking at delivery. How can we do off-site catering? Are there other types of T-shirts and hats and selling gift cards that we can engage in these types of business practices to find new streams of revenue? But at the end of the day, we are about hospitality and serving people. So even if you find these additional revenue streams, they're not going to offset the loss of your in-house dining.
Absolutely. You got to get back to the in-house dining. Andrew Ridgie, thank you so much. New York Hospitality. And folks, this is an incredibly visceral conversation for Lisa and I. Just because you're living it on every street in these 5 boroughs, where just the complete total collapse of restaurants. Lisa, I'm seeing fits and starts. Boy, is it clumsy.
Well, it's difficult not to crack given the fact that we're not getting tourists and it's unclear how much confidence people have to go out and spend. I will say this, Tom, I found this article really interesting about California car dealerships. And they're actually seeing a resurgence in foot traffic and people actually going to the dealerships when a lot of people thought all of the activity would go online. People still want to physically go somewhere and shop. Physically go somewhere and eat, physically go somewhere and work. And as much as people have suggested that perhaps that's going away, the evidence so far initially is that that's not quite the case, Tom.
No, the timeline will be interesting to see. And as Mr. Ridgie mentioned there, getting back into the restaurants maybe will be the most challenging thing. We are challenged by markets yesterday and they recover this morning. The VIX out to a 42 is back to 37.43, and that's in 3 big figures. Futures up 57, Dow futures up 545. They were up over 600 points earlier, and as John Farrow's mentioned through the morning, the bond market has been mixed to say the least. Right now, there's a nice risk-on feel with a 10-year and a 30-year yield higher as well. This will be must-listen for Global Wall Street, must-listen for American Wall Street. That is Betsy Gracek of Morgan Stanley, the future of the too big to fail banks. Please stay with us. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg Commodity Indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. With equity futures nicely positive, we begin with the big issue. From an uncomfortable calm to uneasy exuberance, the confidence, the optimism of the last week colliding with a new wall of worry.
Markets really just taking a bit of a pause after a very strong run.
We think the markets are a little bit divorced from the fundamental economy.
There's a few things that have come together here.
There's a very high level of uncertainty, especially as we reopen the economy.
There may well be a second wave of infection.
The probability of a second wave in the United States is rising.
I'm not sure whether the reaction by governments to a second wave would be as it was to the first wave.
There's the trade environment, which, as you say, remains very tricky.
Volatility over the next many months.
The volatility is likely to increase.
We're looking for the recovery on the demand side.
People are not spending because they don't feel confident about going out and resuming normal activity.
We're underwriting things, depending on the industry, at sort of 4, 5, even 6-year recovery trends.
Reintroducing some two-way risk to this market, down hard in yesterday's session and snapping back hard through this Friday morning. Let's get to the market desk and catch up with Kaylee Lyons for more. Good morning to you, Kaylee.
Good morning, John. Well, it has been a wild week, to say the least. When I came into the office on Monday morning, there was no real reason to believe that that furious, nearly 50% rally off the lows in March was set to end. But that one update was followed by 3 consecutive down days. Of course, yesterday being the worst day for the 3 major averages since March 16th before we hit the bottom. A storm of a cautious Fed, a potential virus resurgence, and really incredibly lofty valuations slamming the brakes on momentum, at least for a moment. And only momentarily, John, because today, of course, we are rebounding. Not enough to recover from yesterday's losses. Futures are up about 58 points on the S&P 500 E-minis right now. Of course, John, 2 points I would make here are, one, that there was a time not too long ago that decades of declines of 5+% on equity benchmarks did not feel that abnormal. We saw them often during the March sell-off. And the second and perhaps more poignant point is that after each of those plunges, we did rally the next day. None of those subsequent gains were enough to recover the losses of the previous day. However, we'll have to see what plays out in today's session. If for whatever reason this early rebound we're seeing this morning is not sustained, if we roll over into the weekend, could send a grim signal about risk sentiment. And finally, John, to widen the lens and mention that this wasn't just a dramatic week for U.S. equities. The stock 600 over in Europe looks set to end the week about 5% lower. And the action in the bond market also pretty incredible. Just last week, it looked like the U.S. 10-year Treasury yield was on the cusp of hitting 1% once again. But we're now down 20 basis points over just the past 5 sessions, now yielding just 70 basis points. And finally, of course, a lot of that was about the economic outlook, concerns about growth that rolled into the commodity complex as well. You have WTI crude down nearly 8% on the week at this point, John.
Kelly Lyons, thank you. What a reversal through this week. A little bit of a reality check. The equity market retracing some of yesterday's move, up by 2% on S&P 500 futures. Speaking of reality checks, here's Bob Michael of JP Morgan, who wrote the following. The road to recovery will be long and challenging. Inflation will remain low and unemployment will be unacceptably high. This is an unfolding reality that policymakers, public and private, must accept and begin to deal with. Bob Michael of JP Morgan Asset Management joins us now on the phone. Bob, always fantastic to catch up with you, sir. So let's explore. You said something that drew a lot of controversy in the last few weeks. It was a comment with me maybe a month ago when you said it could take 10 years to get back to normal. Why do you think it could take that long, Bob?
Good morning, John. Well, because when we look at the magnitude of damage that's been done, when you look at where unemployment had gotten to close to 20%, and we'll see a low in GDP, maybe down 30 to 40% this quarter, even with all the policy response, it will take a while to get back to the long-term growth potential of the U.S. economy. And I've always said, if you annualize quarterly GDP, it will look like a V. The great financial crisis looked like a V-shaped recovery. That's the wrong way to look at it. Getting back to the long-term potential and filling the output gap is the right way. That will give you a roadmap to how long the Fed will be on hold and how long it will take to get back to full employment.
Wrong way, right way. What do you think is going to be the dominant driver of markets? Because over the last several weeks, up until the last couple of days, Bob, it has been about that sequential week-on-week, month-on-month improvement. What do you think the dominant driver of markets will be?
I think without question, it's the overwhelming policy response. And we totaled up the aggregate amount of policy response globally. It's over $17 trillion. And only $6.2 trillion of that is quantitative ease. Now, not all of that has been deployed yet. And I'm pretty sure in Tom's dusty stack of books, there's a Samuelson in there which says, don't fight the Fed. You certainly don't want to fight all the policymakers in aggregate.
I have no doubt that that book exists on the Tom Keene bookshelf, Bob Michael. I'll ask him a little bit later. Let's talk about things then. You think that rates will stay low way beyond where that dot plot is at the Federal Reserve, far out beyond 2022. What are you pricing off here, Bob? A low Fed funds rate through the rest of this decade?
Well, so much of it will be dependent on what further policy responses look like. And for us, the starting point is the financial crisis, and the Fed kept rates near zero for 7 years. I think they learned something from that. I think they learned they don't need to go that long, that probably they could have began the normalization process a bit earlier. So maybe the next 5 to 10 years, but it is so dependent on the policy response. All we know is we don't want to fight that for the next few years.
What does not fighting it mean? What does that mean for your capital allocation decisions?
Well, it means that we talked originally about co-investing with the central banks. I think we're in the phase now where you start handing off some of those assets to the central banks to warehouse. So government bonds, maybe some agency mortgages, maybe some bits of investment grade credit. And then you start rolling up your sleeves and start trying to find things that maybe have been left behind, maybe have some story behind them. And there's a lot of places in securitized credit. It's uncertain how households will be able to deal with their debt burden, especially if some of these fiscal programs run out. And then in emerging market debt, there's a lot there that's been left out on both the external, local, and FX sides of the equation.
So, Bob, to be clear here, you think it could take 10 years to recover, but because of the policy effort, you're willing to take more risk, even in the face of the increased infections that we see across several states in America right now. Now, I'm not one to extrapolate things out too far. Let's hope they can be addressed. But certainly there's some risk out there at the moment, Bob. You think it just all comes down to policy, Fed policy specifically?
Well, let's not forget the high yield market put in its bottom in December 2008. Default rates didn't peak until the fourth quarter of 2009. The equity market put in its bottom in March 2009. Unemployment didn't peak at 10% until October 2009. So the markets are fantastic discounting mechanisms. And what we're seeing is that the policymakers are locked arm in arm on this. So if there is anything that will cause uncertainty, and believe me, there will be things that come down the road, we do believe you're going to see further policy response by both central banks and politicians on the fiscal side.
Bob, before we let you go, I want to talk about what you have on the other side of the barbell, so to speak, what the haven asset of choice would be right now, where you expect to get that risk mitigation characteristics from. Is it still treasuries, or is it somewhere else for you, Bob?
I want a little bit more yield than treasuries. So it's investment grade credit. I don't think European or American businesses will be allowed to fail wholesale here. It's not their fault. When I also listened to the Fed, and I was also impressed by the technical knockout that Michael McKee registered on the Fed chair, I think the Fed needs to shift the narrative. They've done everything they can to get us through this crisis. They shouldn't be on the hook for rising asset prices. What they need to do is shift the narrative to public and private policymakers and say, we've created a backdrop for a long-term recovery. What are you doing with that? Are you going to buy back shares and raise dividends, or are you going to invest in CapEx? If you're a municipality, will you invest in infrastructure? So I'm confident that there is investment coming, and I want to be part of that.
Bob Michael, you honestly think there could be a policy handoff from the Federal Reserve?
I don't know. We're seeing it in Europe, right? Christine Lagarde is being very clever at saying we need help on the fiscal side. We saw some early comments from Powell a couple days ago where he hinted that there needs to be more fiscal stimulus. Certainly Secretary Mnuchin said the same thing. We'll see if there is, but I think that's where the narrative needs to shift during this crisis.
Bob Michael of JP Morgan Asset Management. Bob, always great to catch up with you, sir. My best to you and yours. Thank you very much. And a hat tip, a nod to Michael McKee's TKO in that news conference in the last couple of days over at the Federal Reserve. In this market right now, we advanced by 2% on the S&P 500, up nicely by 60 points on the S&P after an ugly day in yesterday's session. Much more still to come from Kathy Jones of Charles Schwab as we count you down to the opening bell in New York City this morning. It's a beautiful one. Good morning to you all. This is Bloomberg.
you think of where equities bottomed out at and how fast and explosive they've rebounded. They clearly got overextended. And a lot of that has to do, of course, with the Fed's easy money policy. You started to get a euphoric rally, and then the data coming in started to look a little bit weaker, started to see profit taking, and that again led to a much higher downside vol than we've witnessed really since March. We certainly don't think this mini pullback gets materially worse.
Troy Gajewski of Skybridge Capital, the co-CIO, weighing in on the sell-off of the last 24 hours. It has been so difficult to understand the trajectory of the recovery in the U.S. economy. We had a massive blowout upside payroll surprise last week, Friday. That, I think, inspired a lot of optimism about this economy, but the subsequent data just hasn't validated any of that. You expect to see that. It's going to be lumpy. It's going to be choppy in either direction coming out of this. And I think we need to check in with our expert boxer himself, our TKO, Michael McKee, from a couple of days ago in that news conference. Mike, we'll leave that one behind. Let's get forward and look ahead. The data we've had from the U.S. economy in the last week or so, how are you processing things at the moment, Mike?
It's really hard to process, John, because this is an unprecedented situation, to use a phrase that nobody has used recently. The models just don't work, is the problem. Ordinarily in a recession, you have causes that economists can identify, inventory buildups, or maybe the Fed tightens too much, and you can plug those in and try to figure out when they will be corrected and when things will get better. But we shut down the whole U.S. economy at once, and restarting it is something we've never done. So it's really hard to figure out how fast we're going to get better and how much better we will get. It's forced people out of the monthly indicators. Bob Michael was talking about looking at the output gap, but looking at where we are in GDP is going to take quite some time, because those are delayed numbers anyway, quarterly numbers, and we're not going to be sure how accurate they are. You look at what happened with unemployment in the numbers last week. But there are some high-frequency indicators people are looking at, and some of them are good. More people are driving and flying, a few. More restaurant seating, particularly in the cities that have opened up. Not a lot, but a little bit. And then you look at the hiring numbers from last Friday. You look at jobless claims. They're still high, but coming down. And that's the good news. But then there's negatives out there as well. Natural gas demand up. But why is that? It's higher than it ordinarily should be at this time of year, because more people are air conditioning their homes instead of all going to the office. Consumer spending has been down. You look at the Johnson Red Book numbers. Consumer sentiment depressed. That's a tease ahead to the Michigan numbers, which are out at 10 today. The real question is, for consumers, when do they feel safe about going out? So the COVID data might be what we really want to look at. And then once you go back to work, how much work is there to be done? You look at the ISM indicators that were just out, both for services and manufacturing, and you can see new orders way down. So you come back, is there any business to do? That's going to be the real question, and that's why it's so hard to figure out what's going on. We just came out with, Bloomberg Economics did the latest survey of economists for what's going to happen in the economy, the June survey, and you look at the GDP forecasts for the fourth quarter when we're supposed to be growing. And you can see the white line, 7.6% approximately is where the consensus median is, but the green is the high forecast, 70%. The red is the low forecast, negative 2.6%. That's such an enormous range. There's no way to know what people think GDP is actually going to be in the fourth quarter. So how do you get to that output gap prescription that Bob was talking about?
Really, really difficult stuff. Michael McKee, our economics editor, live right here on Bloomberg TV, with equity markets coming back a bit, up 65 on the S&P 500. Here's another take. It comes from Kathy Jones of Charles Schwab. The Fed is far from their goals. The focus is really going to be on, are we doing enough? The door is open. If we get disappointing economic news or get something that is particularly negative, like no more fiscal policy help. Kathy Jones of Charles Schwab joins us now. Kathy, we haven't mentioned that yet this morning, though I think it's pretty clear to everyone there is a little bit of fiscal policy fatigue down in Washington, D.C. We might have to wait until late August to find out what the next moves are. Are you focused on that?
Hi, John. Yeah, we are focused on it because we do think, particularly for state and local governments, it's going to be important to get some more fiscal aid out into the economy. And particularly now that we're seeing this rebound in cases of COVID-19, there may be more resources needed at the state and local level, and there may be a lot of need for an extension of some of the unemployment supplemental funds. So we are keeping a close eye on it.
And Kathy, how are those thoughts shaping your capital allocation decisions going into the back end of the summer?
So our view on the market is that, as everyone agrees, the Fed's on hold for the foreseeable future. We think at least 2 years. And that 10-year yields on the Treasury market are probably going to vary between about 50 and 100 basis points. So we're not going to see probably that kind of volatility, but what we are watching more closely in terms of allocation is how much should we have in the riskier sectors of the market. If we have a steady recovery or a stronger recovery than anticipated, then the risk assets will continue to do well, like high yield and the lower tranches of investment grade. But we're not convinced that's going to happen. And where they're priced now, we're concerned that the market is priced in a really positive bounce back in economic growth that may not materialize.
This is the problem, Kathy, and it's something I think we've all been following at the moment. Should we be following exclusively the rate-on-rate positive change that we've experienced over the last several weeks and months off the bottom, or should we be thinking more and more about the limits of the recovery as we go deeper into this reopening process? You can have a company that is getting back towards normal quickly, but tops out at 80–90% of capacity. How do you balance those two things when you put money to work at the moment, Kathy? The improvement that you see off the bottom against the limits of the recovery we might see as well.
So where you make the most money is early on when the market's discounting all the terrible news. So when, say, for instance, high-yield spreads blew out to 1,000 over, 1,100 over, and snapped back by a couple hundred basis points, that's where you get the biggest capital gain and the biggest gain in those sorts of sectors. When you start to get yield spreads back to close to normal or long-term averages, then you have to really start being selective about what you're buying, whether it's investment grade or high yield or anything else. Now is when you have to be a lot more cautious and do some of that hard work where you're doing the analysis to see who's going to make it, who isn't going to make it, and how well, as you say, they're going to come back. And that's where we're getting cautious. So we are back to the story of moving up in credit quality. For a time, as the market was selling off, it seemed like, okay, everything was going to rally because the Fed was behind you. Now we have to be more cautious. Yeah, the Fed's behind you, but they're not going to rescue everybody. Not everybody's going to make it. So you have to be a lot more careful. And we continue to like to move up in credit quality from these levels.
And Kathy, I'd like to wrap up by talking about where in the capital structure you like to sit at the moment. I'm not going to name names, but there is, of course, a car rental company going through bankruptcy that is looking to raise some equity. There are some people willing to go and sit in the bottom of the capital structure, take on that exposure for a company going through bankruptcy proceedings. Can you walk me through, without naming any names, where you want to sit in the capital structure of any given company right now and why?
Well, I'd like to be higher than in the equity tranche of a bankrupt company. Let me put it that way. And I've been doing this almost as long as Tom Keene. So back when I went to school, you paid attention to recovery rates and things like that. So what we're concerned about is recovery rates in this cycle are going to be, we think, much lower than they were in the past because the lending terms were very easy. And that means that when a company gets into trouble, the lenders and the equity holders get the least, if anything, back. So this, to a large extent, informs our desire to be in the investment-grade tranches of the market, and even within that, not too heavily concentrated in, say, BBB. And if we're in the high-yield market, we'd like to stay as close to the upper end of that market as we can and look at some of the fallen angels and other names that may get some support.
Kathy, don't age yourself. Tom Keene was around when the Federal Reserve was established a long, long time ago, and I know you're much younger than that. Kathy Jones of Charles Schwab on This Market. I hope Tom's not listening. Around about 8 minutes away from the opening bell in New York City with equity futures elevated, snapping back after the heavy losses in yesterday's session. Later in the program, we'll catch up with Jonathan Golub at Credit Suisse. Up next, some of the calls from the analyst community on Wall Street. Right here on Bloomberg TV. 5 minutes away from the opening bell in New York. Session highs on the S&P 500 up 73 points. We advanced by 2.4% following yesterday's ugly losses. That's the price action. Here are the morning calls. First up, Credit Suisse upgrading Southwest Airlines to an outperform with a $45 price target. The analyst signing a best-in-class balance sheet and expecting a near-term recovery in leisure travel demand. Your second call from Goldman upgrading General Motors to a buyer $36 price target. An analyst saying GM is well positioned to take advantage of recovering auto markets in both the US and China. And your third and final call, BMO Capital downgrading Caterpillar to market perform with a $130 price target. The analyst expecting a near-term recovery to be challenging due to budgetary constraints and stretched government finances. Next up on this show, Jonathan Golub of Credit Suisse. After an equity market that sold off and sold off hard, there was nowhere to hide in yesterday's session. Your equity market this morning positive. This is Bloomberg.
When they check into a hotel, they say, hey, I probably need to wear a mask. There's so many people. And so we should have that available, like a toothpaste and toothbrush.
When they walk in the front door of the hotel, the availability of hand sanitizer and disinfecting wipes. Again, we know that they're walking into an environment that we've cared for them in, but giving them the ability to kind of be involved in that, to kind of build their level of confidence.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Taking a bite out of yesterday's losses. Session highs going into the cash open this Friday morning. Good morning to you all. Up 69 points on the S&P 500. We advanced 2.3%. Risk appetite improving, sending the yield curve steeper. Treasury yields higher. Your 10-year yield up 3 basis points to 0.7%. And in foreign exchange, the commodity currencies, the growth proxies, the Aussie dollar advancing, reflecting that improving risk appetite relative to a brutal session yesterday. From New York City, then, let's get to the opening bell. Let's get to the market desk and get you some price action. Here is Abigail Dillittle.
John, well, what a wild week it's starting out to be, or it's turning out to be, I should say, after 3 down days, with yesterday a big crescendo to that selling. Today we have 2 notable leaders and 2 notable laggards. Starting out with those leaders, American Airlines, this is really pretty incredible, up 17%. They did provide a somewhat positive mid-quarter update, but the bigger point might be up 17% or 16% today, down 16% yesterday, net still down on the week. So a big piece of this volatility in some of those cyclical stocks that we're seeing this week. Adobe up 5.2%. The software company put up another big quarter. Reoccurring revenues of $9.2 billion, almost $9.2 billion, better than estimated. It looks like folks are really using Photoshop and other productivity tools of theirs from home. To the downside, actually, PVH Corp has just flipped higher. It had been lower in the pre-market, now up about 3.4%. They put up a terrible quarter. They own clothing brands such as Calvin Klein and Tommy Hilfiger. CL King said it's tougher than expected. Investors seem to be looking past that right now, and the fact that they put up a loss of about $3 per share, almost double the estimate. Perhaps some folks are thinking that their reopening plans could be a positive. Lots of volatility there. And then finally, Lululemon down 2.2% at this point. If the loss holds on the day, John, this would be the third straight quarter of a post-earnings drop after mainly rising after earnings for the last 10 quarters. That's what you could call the beginning of a trend shift. Online sales rose, but the rest of their business really very, very tough. They withdrew guidance, as so many companies have done, and are saying that the recovery will be very gradual, realistic, but investors not liking it today and this morning, John.
Abigail, thank you. 2 minutes into this session, equities advanced 2.5% on the S&P 500, on the Nasdaq up by 2.44%. Yesterday's session, nowhere to hide. Every single industry group, every single sector in deep negative territory. This morning, the session's young, granted, but a real snapback, and it's broad-based too. Every single sector in positive territory this Friday morning. Rotation on, rotation off. Katie Lyons, we've been talking about it for weeks now. We've seen so many head fakes over the last several months. What are you seeing?
Yeah, well, John, of course, that value rotation we all were so excited about did a total 180 yesterday. Today, we seem to be doing a total 180 back. I guess that makes it a full 360-degree spin. But it's not just when it comes to the cyclical defensive names of the market, but also when we look at small versus large caps, because small caps, domestically focused, have really been seen as kind of a proxy for the recovery story. And they had been outperforming on economic optimism as they are more economically sensitive. Yesterday, however, the Russell 2000 dropping 7.6%, a much larger decline than we saw in the large cap indices. This morning, though, it is small caps that are rebounding back the hardest. It's up about 3.6% after the opening bell. And of course, we also have to pay attention to that value growth narrative, John. For a brief moment in time, it looked like value maybe was staging a comeback, then it was maybe ending, thanks in part, of course, to retail investors bidding up some of the most beaten down names of this equity market. That outperformance had faded rather quickly. Now, value and growth are roughly on par over the past month. And I want to focus on one value sector in particular, John, and that is the financials, the second worst performing of the major industry groups in the S&P 500 this year. And after staging a comeback last week, a quick reversal this week. The sector as of the close yesterday was the biggest laggard in the S&P 500 over the previous 5 days, down about 8.6%. And when we look at the KBW Bank Index in particular, its performance relative to that of the S&P 500 is still hovering around record lows. But I have to note here, John, that banks are fully participating in this morning's rebound. In fact, really leading early on. Wells Fargo, JP Morgan, Bank of America, Citigroup, all up 3% or more. Of course, it doesn't hurt that yields are rising as a risk-on tone really is taking hold. But of course, John, the jury is still out whether this value resurgence is actually sustainable, John.
Kelly Lyons from the market desk. Kaylee, thank you very much. Let's turn now to Jonathan Golub at Credit Suisse, the chief equity strategist. Jonathan, always great to get your thoughts. Earning trends, you say, favor large over small, growth over value. Are you pushing back where the consensus is starting to build, John?
Well, I think, John, this is really an issue of time frame. The growth is going to win if the underlying environment is weaker, and value is going to win if the reopening looks successful. So what you had yesterday, among other things, was a tick up, and I think a really small tick up in concerns that people might be getting sick from coronavirus again now that we're opening up, and therefore that might ultimately hinder the process, and that beats up on value. But I honestly think that the likelihood of having a broad-based national shutdown again, when you look at data, it seems extremely small. And so I think that yesterday, while the market was due for a pullback, I think that the tone of it was probably too harsh.
Well, it's not just the data, it's the appetite for another lockdown. There just doesn't seem to be one at the state level in Texas at the moment. If you listen to Governor Abbott, there doesn't seem to be one at the federal level. If you listen to the administration, Larry Kudlow himself has told me the bar for that is incredibly high. So, John, I just wonder, if those data points, if they deteriorate further on the pandemic side, how would you process that yourself as a market participant?
Yeah, first of all, I think that we're misreading it, and let me give an analogy. Even on a day that the market is up big, you still have individual securities that are down. What we are not seeing is a spike on a national level in the number of people getting sick, so what you're seeing is within the market, while the overall level is coming down, and the real successes are in the hotspots that have been so beaten up, places like the New York metro area and Illinois and some of the other big cities that depend on public transport, they're getting much better because we're taking it seriously. The areas that are ticking up are areas that had very, very little in terms of caseloads, and they're picking up from those low bases, but in aggregate, they're not really a big national problem. So I think that we're almost cherry picking, looking for those. We're always going to have individual hotspots. And the other thing which I think is being missed here is that I don't think that we're going to have a vaccine for longer than people think. We're not going to have one as quickly as some are saying, perhaps the end of the third quarter. However, doctors are really learning how to treat patients when they come in with COVID-19, and the number of deaths that are occurring when people are getting sick are down very meaningfully. And while everyone is focused on a pickup in the number of people who are getting COVID-19, the number of people dying from it are not going up.
It's hard to turn to markets when we have these kind of conversations, isn't it, John? It feels really crude just to turn from these kind of data points towards what it means for markets. What do the conversations with you and clients feel like right now when you discuss these topics?
Well, first of all, I think that this is front and center, but this growth value discussion is a really big deal. The one other part of this, and I think this is really the way this is going to play out, is that, yes, I believe the openings are going to move forward, and I don't believe we're going to see lockdowns in a major way. However, the question is, will we get back to 100% of a functioning economy if it's hard for people to commute into New York City, if the number of people willing to get on an airplane is lower, if we have 20 million unemployed Americans, that some of them are going to get their jobs back quickly, but some of them are going to take a longer period. It took 4 years to get everyone reemployed after the financial crisis, and there's a lot more people, so it's going to probably take longer. So I think the right word is that the economy is going to be impaired in terms of its trajectory, but that the reopening will be successful. And I know that seems like they're at odds with each other. The bounce off the bottom is going to be brilliant because you're comparing it to everyone staying at home. The problem is once we get that bounce, a couple of months from now, we're going to start realizing that restaurants aren't open 100%, that we're not moving about the way we used to, and we're going to have a cap on the level of success. And I think that ultimately that favors growth, and that's going to limit some market upside.
I hear you, John, and I think a lot of people agree with you. In the short term, it's about sequential improvement. In the long term, it's the limits of the recovery. And if your time horizon is long, then it's the secular growth stories that you want to be sticking with. John, great to catch up with you. Really appreciate your thoughts, and I hope you're all doing well at home. Jonathan Golub there at Credit Suisse on this equity market. Let's get you more on the price action, shall we, as we recover with every single sector in positive territory. I want to cross back over to the market desk and catch up with Abigail Doolittle. Hey, Abby.
Hi there, John. Well, stocks are certainly sharply higher today, but of course, in this big volatile week on the week right now, the S&P 500 down almost 4%, headed to its worst week perhaps since the end of March. So today it's really a snapback rally. Let's take a look at some of the big winners. They were yesterday's big losers. Take a look at Bank of America, up about 4% today, but after 3 down days, down about 17%. That after a 42% up rally, that rotation into cyclicals, but now into question whether or not that will continue. Spirit Airlines, same story, but a bigger deal, up 257% from the May low, then down 40%, today up 16%. Really big extreme volatility. Norwegian Cruise cruise lines had been down 11% yesterday. One of those cruise and hotel indexes, Dine Brands, lost 31% in 3 days. They own Applebee's, among other companies. You can see that is now up about 10% today. Pete Dioteris, our market producer, who I know you also appreciate very much, John, he put it well, where saying that these markets, not for the faint of heart. And that's certainly true with the volatility that we're seeing today. Volatility breeds volatility, probably more to come.
I love Pete. Love Pete. Very experienced man in this markets too. Abigail, fantastic work. Thank you. 10 minutes, 11 minutes into the session. Equities advanced 2.8%. The first up day in 4, still down on the week. We were down coming into Friday, off by about 6%, now down by about 3.5%. Up next on this program, a man who has got it right almost at every single turn in the last couple of months. It's Peter Cheer of Academy Securities. Been looking forward to this conversation and happy to say he comes up next. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
"13 minutes into the session in the equity market, we advanced 2.8% on the S&P 500, taking a chunk out of the weekly loss on the S&P. We advanced by 2.85% on the Nasdaq as well, with every single sector positive on the benchmarks in the United States. A real lift and a massive rally off the March low in this equity market that caught so many people by surprise, including many legendary investors, including Paul Tudor-Jones.
If there was a franchise for humble pie, oh my Lord, there'd be a mile long to own that, because we've all had huge gulps of it, me included.
Paul Tudor-Jones there on the queue for humble pie. I think a lot of people have had those gulps. You've been right or wrong at some point quite a few times in the last 3 months, that's for sure. And it will feel that way, I imagine, for the next several weeks as well. Katie Lyons, it's been really difficult to read this market. The institutional investors, for many of them who sat this rally out, it has been a huge pain trade to see this equity market rip higher off that March low.
Yeah, you're absolutely right, John, and I think that wins for best soundbite of the week. There has definitely been a lot of humble pie consumption in recent weeks. I'm going to quote our producer, Pete, for the second time this morning. He said, anyone who doesn't think it's hard to make money in this market on a daily basis has never done it. This market has been incredibly hard to time, John. When you look at the returns for retail investors' favorite stocks relative to that of hedge funds' VIP picks, that's the white and blue lines here on this chart, both have outperformed the benchmark S&P 500 in yellow, at least on a short-term basis. But it looks like retailer investors were the ones who actually timed this the best, seeing the best gain of around 53% since the March low. And we've had plenty of conversations this week, John, about how it was retail bidding up the beaten down, even bankrupt names in this equity market that was driving a lot of those gains. And it was the very same names that positioning data shows us hedge fund exposure was sitting near multi-year lows. Instead, they were sticking to the stay-at-home trades like tech and healthcare. The result is smart money looking like it was just a bit too cautious here. But we also have to consider that there are macro factors involved here, John, like the abundance of liquidity coming from the Federal Reserve, the Fed totally opening up the floodgates with its unprecedented asset purchases, bulking up its balance sheet. Plus, you had fiscal stimulus coming online as well. Institutional investors may be underestimating the fervorish optimism that would inspire. To get a better read on that optimism, John, our very own Gina Martin Adams of Bloomberg Intelligence would point you to the SIBO equity put-call ratio. It measures the relationship between bearish and bullish options. On Monday, that hit the lowest in 9 years, since all the way back in 2011, really underscores the bullish sentiment that was underpinning this rally. And what's noteworthy, too, on bullishness, John, if you look at the latest AAII survey data that was released just yesterday, gives us a read on bullishness for retail investors. It showed virtually no change after a 5-week rise. I'll leave that up to Peter Cheer to answer whether those unsophisticated investors are sending us the right signal yet again, John.
Kelly Lyons, thank you. We'll turn to Peter Cheer now, a man who's got it right so many times over the last several months. In the middle of February, he came out with a series of bearish reports just a week, 2 weeks before we topped out on the S&P 500. Then in the middle of March, after a big drawdown, about a week or so before the bottom, he said the worst was behind us and he turned bullish. Then in early June, June 4th, shifted from bullish to neutral. Then after we got a big payrolls report shortly after, Peter Cheer turned bearish. I'm happy to say the man who's got it right so many times after so many turns over the last couple of months joins us now from Academy Securities. Peter, walk me through the following. What you've been focused on, your signpost through the downturn, through the rally that you've used just as a gauge for where things are heading.
You know, I think I've tried to do a couple things. One is really focus on positioning and sentiment and really betting against that to a large degree. Also really trying to look through the data. What is the data and what is DC going to do next? And we've spent a lot of time on the Fed. I don't think we spent enough time on exactly what DC did for us back in March and what I think they might not do for us in the coming weeks, which is why I'm so bearish right now.
So let's talk about that, Peter. Why you were initially bullish and why that has turned to a bearish stance in just the last week or so.
So I was really looking for DC not only to have effectively a CARES Act 2, but really to start pushing economic growth. So whether it was infrastructure spending or rebuilding of our manufacturing base. And I'm very worried right now that three things are going on. The economy is doing a little bit better and the stock market's doing much better, so that takes some pressure off of DC to act. We're getting closer to the election, which may cause them not to act. And now clearly we have to deal with racial inequality, and that's a really important issue that DC needs to focus on. But it, again, will probably slow down what they're able to do for the pandemic, which should be our priority right now, is getting through this next couple months. And if DC doesn't deliver, I think stocks are going to have a lot of difficulty sustaining their momentum.
So, Peter, turning points are really important. Upside surprises, downside surprises, equally as important. This is known. Policy fatigue is known. You and I are having this conversation right now. Nobody's surprised by it. Everyone knows there's real fiscal policy fatigue down in DC. What is it about that fatigue that you think is going to materialize into something that slaps everyone around the head and makes them realize this is really important?
Maybe a little bit of price action. I think you're going to start seeing more COVID headlines. You know, I think Nashville's now talking about maybe slowing down the reopening. Houston's talking about slowing down the reopening. So if you get a little bit of caution on that, that's going to really create the need for DC. And as that comes, people are going to realize, hey, this isn't happening as quickly. We also really haven't talked at all about how we're going to pay for any of this. I think that starts becoming an agenda item as we move into later June. And again, that's going to scare market participants, I believe.
So let's talk about where's vulnerable in this market. Crowded positions. You talked about looking at positioning and looking at sentiment. And arguably, where we are crowded right now is still in the safe parts of this market, the so-called safe follow the Fed strategies in IG, in places like that. That's where sentiment is really quite crowded and positioning is too, isn't it, Peter?
Yeah, so I think that's going to be something different. When we looked at this market coming down in March, you wanted to be in tech because they were the big winners from work from home. you wanted to play some of these rotations out of tech and into other assets. Right now, I think you want to be careful on the big winners, and that includes investment grade as well as, say, Nasdaq or QQQ and the ETFs, because I think that is where there's a much more long positioning, and that is where you're going to see the unwind. So I think you're going to see continued underperformance from those sectors in the next week or two.
So, Peter, in a series of days, weeks, whatever it could be, when risk aversion strikes in a more pronounced way, and I'm not sure if yesterday was a good example of that, you expect to see the pain in the so-called safer parts of the market?
Yes, and so I think it's going to be the safer parts of the credit market. So investment grade will actually probably underperform, which will surprise many, and it's just a function of that's where so many people are hiding their long expressions in the credit markets. And again, I think the same thing really happens in the Nasdaq, where so many people are hiding, and you've got phenomenal companies, but they're also very expensive valuations.
Peter, fantastic to get your thoughts. Constructive and optimistic when so many people weren't. And as the tide starts to turn, you're pushing back a little bit. I look forward to keeping this as a regular conversation in the weeks to come on this market. As we pick up once again in this market, the S&P 500 up by 2.5%. Want to get you the sector price action, peel this one back a little bit, get back to the market desk. Here is Abigail Doolittle.
John, not surprisingly, with that solid gain for the S&P 500 and the other majors, there is a risk-on tone sector-wise. Let's go into the Bloomberg terminal and use the IMAP function, and I'll show you what I'm talking about. First of all green on the screen. All 11 sectors for the S&P 500 are higher, 10 of them up by more than 1%. And it seems as though the cyclicals are more in favor today. Energy, materials, industrials, financials, all up by 3% or more. But right behind the financials, John, which are certainly getting a boost from yields rising as bonds fall off on the day. Tech also up about 3%. Healthcare not so far behind. So the stay-at-home stocks are doing almost as well as some of those cyclicals. So a bit of an even draw on the day between those sectors and that rotation we've seen more recently. On the week, though, decisively in the other direction. First of all 11 sectors are down on the week, John. And the best sectors underperforming, or outperforming, I should say, even though there's a decline, tech and consumer discretionary. So right there, that stay-at-home, big tech and big internet outperforming on that stay-at-home component. On bottom, as you can see, energy and the financials really taking a hit, both down at about 10%. So it's going to be very interesting to see what is ahead sector-wise. Markets and price will tell us whether or not folks really believe that there is some sort of true recovery for the economy ahead.
Abigail, thank you. A little bit of a recovery in this market relative to the pain yesterday for the equity market bulls. We advanced by 2.5% on the S&P 500, on the Nasdaq up by 2.65 percentage points. Next up on this program, we'll run you through the day ahead into the weekend and out to next week in our trading diary. From New York City, this is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Advancing on the S&P 500 by 2.33%. We recover just a little bit, still down on the week by about 3.8% on the benchmark. That's the price action. Here's your trading diary. What to be watching through to next week. On Monday, we get retail sales out of China and Fed speak from Presidents Robert Kaplan and Mary Daly. On Tuesday, we get a BOJ rate decision, U.S. retail sales, and Fed Chair Jay Powell beginning his 2 days of testimony on Capitol Hill. Facing the Senate Banking Committee on Tuesday, the House on Wednesday. A Bank of England rate decision, another round of jobless data. Jobless claims in the United States is coming Thursday. Finally, on Friday, President Donald Trump holding a live campaign rally, plus Jay Powell and Loretta Mester taking part in a webinar on the workforce. From New York City, that's your week ahead. After a very, very volatile trading week, as always, reach out to me on Twitter if you need me at FeroTV. Be well, stay strong, and be kind to each other too. From New York City, this was the countdown to the open. This is Bloomberg TV.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food, they're able to buy things, they're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of in life happens. You know, I'm here by my side. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue, and it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname
Pocahontas.
Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for Mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, US Navy, and other branches of the US government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats could face real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
When people think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for
Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
And from that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was
one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
The U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world, yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. he applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us, say, 24 people went for the job. 23 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统基础，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma's an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission.
And several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Value-Ag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
"... 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.
There's an inherent attraction to light and being human. And I think on a very deep psychological level, light is this way in which we experience the energy surrounding us in a very personal manner. My name is Matt Dilling. I'm the founder of Light Bright Neon Studio, and we manufacture, produce, and restore neon works of art and design. origins of the creative content of a lot of the work at Lightbright comes from a variety of sources. Sometimes people come with a napkin sketch, some people come with an Adobe Illustrator file, and we have a whole design team who then we kind of work together to help create layouts of what it might look like. Scale it up and create a paper template using a pen plotter. And that paper template actually becomes our guide for what we're going to bend the neon to. We take from the office into the glass shop. We pick out the right size tubing with the right color for the right size project. From there, we heat up the glass tubing. The torches heat the glass well in excess of 1,000 degrees in order for it to get into its molten state. We heat up and bend the glass tubing to match the template. One of our chandeliers has over 100 different bends in it. So each one of those bends has to be marked for a heated up bend. We also have to allow the glass to cool between the bends so that the next area can be worked on and heated up in its own unique fashion. It turns into spaghetti, and then we have to make sure that that spaghetti lines back up and cools to the template. We use a blow hose to connect our mouth to the tube, create a volume that's closed, and we can control the pressure in there with our mouth. There's just a variety of challenges that come up inherently in working with glass. Glass can crack due to stress, and sometimes you'll just have a batch that all it wants to do when it gets near a torch is crack. After we've bent various components, we have to go in using the crossfire or the hand torch and actually weld all of those pieces together. The last step on that is then to weld on electrodes onto either end. Each one of those steps is very, very specific. I draw inspiration from so many different experiences. It's hard to come up with one thing that's particular, but one of the ways that I really am able to connect with the creative is to float. Floating is a similar experience to meditation, to psychedelics. Going into a blackened room and laying out in a body of water and salt that's heated to your body temperature, and it allows for all sort of external stimulation to fall away. And your internal world really begins to bubble up and manifest. You really get to experience a different relationship to your mind. I think I work with neon because I can't not work with it. It's so challenging and so rewarding. And those things are so intertwined that there's no way of separating it out. I've learned so much and continue to learn so much by working with it. I find so much inspiration in working with it, and I just continue to experience new and different things through the medium. It's that close to me at this point. Once the neon tube is completed, we have to hook it up to our manifold for bombarding. The manifold is opened, a vacuum is drawn. We check the tube for leaks with our Tesla coil. We close the tube back off, and we heat it up using a very large and powerful transformer. As the tube is heated up, it releases anything that's not inert inside the tube, and we evacuate that out. We introduce the gas into it, and we seal the tube off, sealing into that tube whatever gas we introduced into it. I think my favorite part of making a neon light is when I see it lit up for the first time. Different gases, when electrified, emit different wavelengths of light. Neon gas is this very bright orange, fiery red color. Argon gas creates a very intense blue, but that light output that is produced can then be expressed in a different wavelength by coating the inside of the tubes with a phosphor coating that takes that one wavelength of light and emits a different wavelength. We bring it over to the aging table where we hook it up to an age-in transformer and allow it to settle, age the gas in that we've introduced to it. There's always a stray particle of something left inside the tube. But that time that the oxide coating can act to scrub whatever is left inside the tube while things are getting settled into place. Once the tubes are aged in, we move on to our process of assembling two halves of the fixture together in a jig, gluing up the center of the fixture to its spindle. Once the adhesive dried, we would connect the wires from the fixture together into a transformer, and we turn on power and it lights up. Part of what we love about what we do here is that we try and put out into the world the kind of things that we'd like to see. I still am surprised when it lights up. I'm still excited when I get to see it illuminated. There's an ineffable quality to it. To me, it is this insight into the inner workings of the universe. It literally is. It's a way of looking at what is surrounding us in the cosmos in a new light.
It's a bit like an addiction. You've got to make something, you have to do something. It's borderline obsession. And every bike we build is my favourite bike at the time, and as soon as it's done, I want to build another one. Sven cycles is something I've been thinking about ever since I started cycling in my late teens. We want bikes that ultimately you'll really enjoy riding. There's never a bike that's the same. There's always a slight change. And as we build them individually as well, they have the marks of a bike that's built by hand. Most people I know cycle have an idea of their dream bicycle. And it may be an evolving idea you've had in your head. And we've worked with a lot of people that have come to us with sketches and scrapbooks. It's really, really nice to build something that's just one-off and unique. I think a lot of people see a bicycle as two wheels and a frame in the middle. There are a lot of subtle changes and nuances in design which can change the riding characteristics quite dramatically. I'm a really big fan of modernist architecture, and the simplicity of a modernist building is really hard to achieve. And with some of our bikes, they may look very simple, but I think people should not underestimate the time and effort that goes into designing a product. Tubing is key to a bike's feel and ride. Reynolds tubing has been in my life ever since I can remember. Growing up, I could never afford a frame manufactured with their tubing. We can now put a badge on our bike saying manufactured at Reynolds, which is a sort of thing as a kid I just wouldn't have believed was going to happen. Every part of the bike has a specific tube. It's not universal. The first thing we do is get the tubes out, check they're correct, check the wall thicknesses, sand the edges, make sure it's all really clean, because if it's not clean, the tubes won't join together correctly. We build in steel because I still believe it's one of the best materials to use. It's been used in bikes since the late 1800s, and they're still using it now for a very good reason. It's the flexibility that we can replace the tube, repaint the bike, and you wouldn't know it's damaged. I just like working with it. It's very sculptural. This isn't sort of aerospace precision engineering. It's a steel rule and a marker. So when we're cutting the tubes, it's within a mil or two. But what we're trying to do is take the best from bicycle building in the past and add a little bit of modern flair to it. There's various techniques for building bicycles. We do a thing called fillet brazing, where you connect a pipe together. We use a bronze rod and a flame. We heat the tubes up to the same temperature and we fill the joint with bronze. And it gives a very, very sort of fluid, lovely, sort of quite sculptural feel. You've got to practice. You've got to be able to judge material temperatures. You've got to just look at it and you just get a feel for it. It's a stage where your tubes start to look a bit like a bicycle. My father's a jeweller. He'd make sort of very pretty things, which are lovely, but for me, they don't really have any function. What I love about bicycles, you can start on a Monday with a box of tubes, you can be riding it by the weekend, and it can last you for the rest of your life. Outside of the frame and forks, the other most important part is the wheels and tyres. When you build the wheels, you have to lace them, so there's little holes going all the way around the rim. You poke the spoke through. We do build all our wheels by hand here because a machine can't get 30 years worth of wheel building experience. Colour is very, very personal. With any of our bikes, you can have them painted whatever colour you want. We've matched one to a teapot, so we can get that scanned and we can match that or someone's favourite item of clothing. I like to let the bike sit for 4 or 5 days minimum, just so the paint can have time to cure a little bit, and then we assemble it. We get out all the new components, and it's a case of putting them together. Some bikes you can assemble in 3 hours, some will take 3 days. And we've built bikes that cost in the £10,000 plus mark. Some people, they're saving up and this is their bike and they're going to own it for the rest of their lives. So we just want to make sure they get the right thing. I think the bike for me was the first time I had some freedom. So as soon as I had one, I was off. A lot of people still get that thrill as when they were a kid blasting down a hill, wind going through their hair. It's fun. Everyone has their favourite jacket or something that just makes them feel good. If you've got a bike that fits well, you actually feel part of it. Building bicycles as a creative outlet is fantastic. It's not something you do because you're going to get a big paycheck at the end of the day. You do it something you have a passion for it.
If you ever saw a wooden surfboard, it was probably hanging in somebody's house or underneath the deck. But kind of in the last 10 or 15 years, wood has made a big comeback. They surf wonderfully. It's beautiful and it feels great to be on one of them. I always had a love for wood and kind of passionate about things that went in the water. I've kind of been around wooden boats most of my life. There's just so much character. The way they're built, the stories that come with them, a lot of that has translated over to why we build surfboards the way we do. When we first started thinking about building surfboards, wood was the natural material we chose. They have a very high strength to weight ratio. Wooden surfboards have the longest history of use in the surf world than any other material. People have been surfing wooden surfboards since kind of the first documented history of people riding waves. The board starts in CAD, where we take a 3D model, break down the shape, and kind of create frames and templates and all the inner parts of the board that we get cut on a CNC machine. We take those frames and we just pop them out, assemble the frame into kind of a skeleton. We go out to our lumber shed, pick a bunch of cedar, and bring them into our mill shop, put glue along the edges, clamp it all together into a panel. Everything's book matched, you have symmetry in the colors and texture of the wood. Cut your outline. take our assembled frame, gently put it down right on top of the plank. Once that foundation is started, you're basically building up the three-dimensional shape, the outside part of the board, using lots of strips that kind of interlock and fit together. Every piece of wood is going to be different, and it's all going to react differently. There are frustrations with it, but I think that's one of the things that keeps it challenging. You learn to read the kind of what the grain lines are doing and what the color of the wood is telling you. Once those rails are cleaned up, we put our top planks on. It's a little bit like putting a lid on a box. It's like, this is it. Whatever's inside that board is staying inside that board. And by tensioning some rope, you can clamp the two together. It's like a time capsule. What makes our boards unique are they are built right here in York. They're built using material that grows right here in the state of Maine. They're built 100% by hand by local craftspeople and surfers. There's a lot of time that goes into these boards, between 40 and 60 hours start to finish. We wanted to build surfboards that were as hollow as they could be, but still be strong enough to work well. Too light and they don't surf well, but too heavy and they don't surf well. So there's a balance point there, and that's where we try to be. Taking the board off the rocker table, once the top has gone on, that is by far one of my top favorite parts. It's just you and a shaping stand, a board, and a hand plane. Everything else is out of your view. It's simple, it's pleasurable, it's quiet. You can be with your thoughts and you can just kind of be present. There's something about taking a nice sharp edge tool to a beautiful piece of wood and feeling the curls coming off and knowing that every pass that you're making, you're kind of getting it closer and closer to what you have in mind. Once we've shaped it down and the board's looking like it's supposed to look like, time for it to go into the glassing room. 4-ounce fiberglass, laying it over the board, draping it over the edges, cutting it, applying epoxy, and on the board. Once both sides are lamb coated, it's time to put in the hardware. Drill and router and install the fin box. And on the other side, we drill and put in the leash plug and a vent. There's a lot of air just naturally inside the board, and that air wants to expand and contract with temperature changes. And that vent has a little piece of Gore-Tex fabric in it, and it allows air to kind of breathe both ways, but it doesn't allow water to get in. Once all that hardware is put in, it goes back into the glassing room. We brush a nice, beautiful, thick coat of epoxy over the whole surface, and that we call a gloss coat. That's supposed to look beautiful and glossy and shiny and flawless. You get to see that board come to life. Whatever the colors in the wood, they really come out. It just makes it look like candy. You just want to touch it and run your hands down it, and it's just kind of the icing on the cake. Once everything is hard, we put it into what we call the oven, get that epoxy to cure, really kind of bake it, and just get it to harden. Put in the fin, screw in the vent, and ship it out. We just love the idea of building something that's sustainable and long-lasting and made by hand. Kind of gives you a deeper connection to the product over something you might buy on a shelf. When a customer gets the board, they feel it. They 100% feel the amount of work and the amount of passion that went into the board. So I'm not really looking at hours and efficiency. We're looking at like doing it right and enjoying it as we go.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 30 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友，然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己，我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
Even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blued, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blued in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences' virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blued means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊，我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话，去改变他们的想法。我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，Blue能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同质互联网公司。
This is Rich Chiga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of like predominantly Asian artists, you know, really like making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but like for what was the question.
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness, residence in a parking garage. I was living in the Bronx. I'm just like, damn, where the hell do I go? So I just come up here and I I just kind of figure things out every single day. Being like, okay, what the hell is this thing? Coming here was kind of like my own kind of private office, basically. Like, to be honest, I would even go to the bathroom here. I would like take pisses here, you know what I mean? Like, it was, it's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy, and like just the shit that he was saying, like the memes he was making. But I didn't know that he rapped or anything like that. I really didn't, and he came up with that stick like 2 weeks later.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it, but the one thing that I noticed is the song was hard as hell. Just like everything about it, man. Just like, it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chiga on my phone, Rich. Brian, he gets like super pissed off that he's saved in my phone as Rich Chiga. He's like, dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I did the sound check.
How was it?
It was tight.
So, Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chiga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier. You know, and it's just more entertaining. We just edit it as tight as possible, put it up, and it really worked.
Yo, this nigga got a pouch on and a Reebok pouch.
This is the hardest nigga of all time. He said, when you come for a chigga like me, that was dope.
It's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, just like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral, and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chiga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it, like who cares? We were like, okay, let's just go crazy at the drop. So that video goes up, I go to sleep, and the next morning, everyone's doing it, like next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this,
It's just Taco Bell. What could possibly go wrong?
to creating something like this, the newest music video for his song Demons. Tonight, Rich Chiga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. I was the third person online.
So why'd you get here so early?
Because I want to see I want to touch him.
What do you guys think of Joji?
Oh my God!
That's my dad, son.
Did you guys cop the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But Idiot Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for Idiot's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store with customers, touch and feel products? And we created a concept called the connected rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror.
So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards.
Do you want me to turn you so you're looking outwards? Yes, please. How about there? First time we came out with B, Jade said it feels like I've been released from prison. Do you want these, missus?
Definitely.
Definitely. Right.
Yeah.
And she could say hello to everybody, people she hadn't seen for months.
It's
Hi, it's Jade.
Oh. So you can talk to Jade through this?
Hi, Katie. She's there.
Hi.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look.
Hiya. When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. have a condition called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time. A lot of the time, with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Yeah, me too. Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign, is incredible. Or being able to have that kind of chat in the car that most people would probably take for granted.
I'm going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in a house with just her carers. It's quite a small world, that.
Right, so there's one of them. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do.
Was that? Good.
It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go to those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably.
He's written it out bigger on the board. Thank you.
Today's the first day that I've been in school via B, and so far it's interesting. Still a few little things that we need to work out, but for the most part I think it's going fairly well. And it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well, and I was really tired afterwards and ended up having loads of seizures, whereas today I've been able to do all of the work, I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify root 8. The algebra test is next week.